Hello guys, today we'll see the marathon session relating to CMA final paper number 20A business valuation. So here under business valuation section, we're having total 5 units. So in that we are having fundamentals of BV, second one we are having laws and compliances, we're having methods and approaches, in BV, and we're having valuation of assets and liabilities, and finally mergers and acquisitions. Upon this, most of the questions will be covered over here. So from these 3 chapters, we're having from methods and approaches in business valuation, assets and liabilities valuation, and mergers and acquisitions. Almost 314 marks in the recent examination also they have asked. So here while coming to laws and compliances, you can study. It's like a theoretical. Till now they have not asked any question from this particular area. But if you want to check out, you can check what is international valuation standards and their numbers. So for MCQ purpose, that is most important. And also SURFACE Act you can check. At the same time, we're having IBC code, which is already covered in your law section. And coming to fundamentals of BV, if you are familiar under these methods and approaches, automatically fundamentals of BV you will cover. So what are the important topics and important methods and problems? So in these particular 3 chapters will be covered here under marathon. So we can see under mergers and acquisitions. The first one, mergers and acquisitions. So check out here, valuation of mergers and acquisitions. So here, what is the meaning of merger and what is the meaning of acquisition? So in general scenario, the mergers are generally 2 existing companies like X Limited and Y Limited. They merge together, they form XY Limited. So this is a call of merger. Okay. At the same time, if X Limited absorbs Y Limited, if X Limited absorbs Y Limited and X Limited is still in existence, Y Limited will close. So here also we can call it as merger. So here mergers includes absorptions as well as amalgamations. So 2 companies are amalgamated together to form a new company, or one company absorbed another company. In these 2 kinds, we can call it as a merger. So merger can be of 2 existing company combined together to form a new company, or one existing company take over another existing company. In the case of amalgamation, 2 old companies will liquidate it and new companies formed. While coming to absorption, existing company absorbs another existing company. Only one existing company will get liquidated, another existing company will continue, which we can call it as merger. And coming to acquisition, if any company acquires stakes of another company. In this sense, for example, X Limited acquires 70% stakes. If it is more than 50% of stakes when they acquired, so here X we can call it as acquirer company and Y we can call it as acquiree company or a target company. So here when X Limited acquires 70% of stakes in Y Limited, now X Limited have to pay purchase consideration. So for that particular stakes, how much purchase consideration he is paying, that we will see in this particular chapter. So here this is called acquisition. So we are acquiring 70% of stakes over here, or sometimes 100% of stakes also you can acquire. Still the Y Limited will continue the business. Here no company is closing. Under acquisition, no company is closing. So one company acquires another company. One company acquires another company. Both companies are doing their business operations under acquisitions. So when it comes to here, you can see in India, in legal sense, merger is also known as amalgamation, which is regulated by Companies Act. So acquisition is nothing but both acquiring company and acquired company. So acquired company is nothing but acquiree or a target company are still exist as a separate entities at the end of the transaction. Here no company is closing over here. So purchasing company we can call it as acquiring company or acquirer. Acquiring company or acquirer, purchasing company. And here selling company whatever we are having. So the company which we bought, so that company we can call it as a target company or acquiree company, or sometimes we can call it as acquired company. So here we can use the words acquirer, acquiree, acquiring company or target company, or we can say acquiring company or acquired company. So we can call it as acquisition. So what are the different kinds of mergers that we are having? So generally we are having here horizontal merger. So horizontal merger in the sense we can say same type of products, the companies which are producing the same type of products, if they merge together, we can call it as horizontal merger. They are under the same business line. So just example already you know, Vodafone and Idea, both are telecommunication services providers. So here these Vodafone and Idea merged together. So both the companies are comes under same type, and we can call it as here same products and same services. So here this merger we can call it as horizontal merger. This merger we can call it as horizontal merger. And we are knowing here vertical merger. So vertical merger means what? So we are saying about two companies together, they formed a new company. So here both companies under the same business line, we can call it as horizontal merger. Then vertical merger is nothing but, here also two companies we are having, here same line of business. Under vertical merger, two companies are there, they are also same line of business they are doing, but in the value chain either it will be forwarded or it will be backwarded. So let us see here, we are having vertical merger of two kinds, forward integration and backward integration. So for example here, if an acquirer moves up to the value chain, above the value chain, we can call it as forward integration. For example here, ice cream manufacturer we are having, ice cream manufacturer acquires a restaurant. So ice cream manufacturer acquires a restaurant and he served the ice cream in the restaurant. So which we can call it as forward integration, because here ice cream manufacturer generally what he have to do, so generally he can supply, if any restaurant want they can purchase the ice cream and they will serve. So here the ice cream manufacturer himself purchased the restaurant and he is serving the ice cream over there, we can call it as forward integration. It's a kind of value chain upwards. So backward integration is nothing but here, when ice cream manufacturer acquires a dairy farm, what raw material he required to prepare the ice cream? He required milk. So that one dairy farm if he acquired, we can call it as a backward integration. In simple language, we can say, so for example, we are having school acquired one college. School is acquiring one college. Now after completion of the schooling, the same students will be helpful as for this particular college. They will transfer their admissions to the college. So here is the sense, the school is acquiring the college. So school comes first or college comes first? School comes first. That means in the value chain, first we are having school, next we are having the college. So it is called a forward integration. Forward integration, because in the value chain school come first, next we are having college, next we are having university. Are you getting my point? So here when school acquires college or college acquires university, in the value chain it is going forward, so it is called forward integration. Or in the same sense, if college is acquiring school, if college is acquiring school, that means the college is looking backward and acquiring the school. In the value chain, so we are having that acquiring the down value chain of the companies, we can call it as here backward integration. If college acquired the school students will be a raw material for college. In simple, we can say the same students we can acquire in our college. So this is a kind of acquisitions that we are having. This integration we can call it as vertical integration. So under vertical integration, we're having forward integration and also we're having a backward integration. So here vertical integration means both are under the same kind of business. In college also they are producing, we can say in the college also they are giving the same kind of, we can say educational services. School also they are providing same educational services, same sector, educational sector. So here, but the value chain either it will be forwarded or it will be backwarded. Based on that, we can say it is a forward integration or backward integration. And last kind of merger that we are having, which is conglomerates and diagonal merger. So that means here two unrelated companies merge together. That merger we can call it as conglomerate or diagonal merger. Okay, so two unrelated companies, like software company acquired one real estate company. Software company acquired one real estate company. Both companies are not in the same line of business. So here we are having some other kind of business. So sir, what they will get if software company acquired a real estate? Is there really helpful for software company? No. So for what we can say, for diversification strategies, or they can create some value creation process and whatever it might be. So these conglomerates or diagonal mergers will be happen in between two unrelated companies. Okay, so generally they are having here. So the Reliance we're having the Reliance Industries. It's the biggest, we're having conglomerates. So they will acquire all the kinds of food businesses, that are different kinds of, okay, products and services and all. So here we can say the merging of companies neither into same products and services nor in the same business. If they merge together, we can call it as conglomerates or diagonal mergers. So whatever it might be, either it will be a horizontal merger or vertical merger or conglomerate merger. So here the accounting will be same. And benefits of mergers and acquisitions. Generally, why these mergers and acquisitions might happen? Because to create a synergy. Synergies might be an operational synergies or financial synergies. So X Limited acquiring Y Limited. X Limited is acquiring Y Limited. For example, both are doing the same kind of business. So they are giving some financial services company. This is also a financial services company. So what synergies they are getting here? If two companies merge together, before acquisition or before merger, two companies having two finance departments, two HR departments. Okay, so here we are having two sales departments and all. Now, when you merge together, only one finance department is enough, one HR department is enough, and one, we can say, sales department is enough. We can say here it is a creation of synergies, which is reducing your cost. Synergy can be reduce your cost or increase your cash flows. It will create as synergies. Is it clear, Nana? So here that is one of the case, creation of synergies, increasing of market power, increasing of market power. So whenever you're having the market share, for example, entire industry we are having X, Y, Z and A. So four companies are leading a product Z. We can say a product P. So only this product P is produced by only four companies. Their market share, all companies are producing and selling 25% each. Their market share is 25%. So that means overall total sales of P in entire India, if you take 25% of sales made by X Limited, 25 by Y Limited and Z Limited and A Limited. If X Limited acquired Z Limited, now the combination market share is how much, Nana? 50%. Out of 100%, they acquired here 50% of stakes. It will increase your market power. Okay, so mergers and acquisition might increase your market power and acquiring unique capabilities and resources. We're having different capabilities, different decisions we can take, and we're having resources. So target company resources we can use, and our company resources will be used by target company. So these things might happen, and diversification, different industries we can step into it. So these are the benefits of mergers and acquisition. Okay. So acquisition pricing. So in order to make here, so how much amount that you have to pay for acquiring a target? So in case of mergers and acquisition, the acquirer needs to pay some amount to acquire the target company. So how much amount we have to pay? The shareholders of target company will get compensation for dispensing their shares in the target against the cash or shares of the acquirer company. So X Limited, Y Limited is there. Now X Limited acquires Y Limited means X Limited have to pay purchase consideration to Y Limited. Now, Y Limited means to whom we have to pay? Shareholders of Y Limited. For the shareholders of Y Limited, either you can pay cash or you can give X Limited shares. We can give purchase consideration in the form of equity shares of X Limited. That means Y Limited shareholders will get equity shares in X Limited for giving up their stakes in Y Limited. Y Limited before merger, they are having some stakes. So, by giving up that stakes, they will acquire, either they will accept the cash or equity shares. Okay. So, for example, they want the shares. So, we are issuing most of the mergers and acquisition. We are giving purchase consideration in the form of equity shares. Sir, how many shares I have to give them? How many shares I have to give them to acquire a target company? So, my company is A Limited. I am acquiring B Limited. So that I have to pay purchase consideration in the form of equity shares. How many equity shares I have to give? So when I check that, equity shares we can give based on different types. The exchange ratio. Okay, so here for example, B Limited having 5,000 shares. Before merger, B Limited having 5,000 shares. For this 5,000 shares, how many A Limited shares we have to give to settle the consideration? Okay, so this exchange ratio we can take on the basis of earnings per share, based on BVPS, book value per share, based on market per share MPS, or fair value per share, or any basis we can calculate share exchange ratio. So here the share exchange ratio we can also call it as swap ratio. Simple Nana. Swap ratio, how to compute? Swap ratio is nothing but any basis you can take, either EPS or MPS or BVPS, whatever it might be. It's like intrinsic price or whatever of target company divided by EPS or MPS or BVPS of acquirer company. How many shares I have to exchange? For example, EPS of target company is 10, EPS of acquirer company is 20, which is nothing but 0.5, which is half. For every one share, so how can we make this? Now swap ratio is 0.5. I can write like 0.5 is to 1. For every one share in the target limited, I have to give 0.5 shares. For every one share in the target company, I have to give 0.5 shares as purchase consideration. Is that clear? No. So how much consideration we have to pay to purchase a company means it is based on exchange ratio or swap ratio. How can we compute swap ratio? Based on EPS, MPS, BVPS. Okay, so we have taken into consideration. Most of the question, if nothing is given, generally we will consider market price. Generally we will consider market price. And simply we can say target company having 20,000 shares. Now we have to give purchase consideration. So target company having 20,000 shares. In the market, target company each share MPS market price per share is 15 rupees. Is 15 rupees. So then we are having 20,000 into 15. We are having 3 lakhs. Now this 3 lakhs is the consideration I have to pay. Now in order to pay this 3 lakhs, I have to give my company shares, acquirer company shares. One share of acquirer company in the market is 30 rupees. One share is how much, Nana? 30 rupees. Then in order to satisfy 3 lakhs, how many 30 rupees shares I have to give? 3 lakhs. 3 lakhs divided by 30 rupees. So total 30,000 shares I have to give. Is that clear, Nana? 30,000 shares we have to give. 30,000, sorry, 10,000. Sorry. Here we are having total 3 lakhs shares. Sorry, 3 lakhs is the purchase consideration. We have to give each share is 30 rupees. Total 10,000 shares we have to give in order to settle 10,000 shares. Simple equation, we can say 20,000 shares are there in the target company. Each share in the market is 15 rupees. You have to pay total 3 lakhs. If they sell to the market also, they will get how much? 3 lakhs. Okay, so you're paying more than that sometimes. Generally, market price, whatever you're having, sometimes you can pay more than the market value. Okay, so more than the market value, why you are paying here? Sometimes we are paying a premium, extra amount to purchase that shares. Definitely they will ask you, we are asking them, so I want to purchase your 20,000 shares. Will they give you? In the market, it is 15 rupees. If you offer better than that, then only he will give you. So sometimes they will give you for more than 15 rupees. Minimum they will ask 15. More than that also, they can ask extra whatever you paid, which is called premium, which is called premium. In accounting language, which is called goodwill, more than purchase consideration, what extra amount you are giving called goodwill. But coming to business valuation language, we can call it as premium, acquisition premium. For acquiring the target, how much extra premium we are paying. That we will see later, premium. Now 3 lakhs in order to settle, how many 30 rupees shares I have to give? 10,000. The same thing you can take it on exchange ratio. What is MPS of target? 15. MPS of acquirer? 30. So what is exchange ratio? MPS of target divided by MPS of acquirer, which is nothing but half. For every one share, we can say half is nothing but 0.5. For every one share in target company, we have to give 0.5 shares. How many shares target company is having? 20,000. So 20,000 into exchange ratio 0.5 by 1. We can say for every 1.5 we are giving, which is nothing but 10,000 shares. Through exchange ratio, when it is going, it will be easy for you to understand how many number of shares we have to issue to the target company for acquisition. So here, like that, we can take the base as EPS or BVPS or MPS or sometimes fair value per share or any other basis. Swap ratio, relevant factor of target by acquiring company. Relevant factor can be EPS or MPS or whatever it might be. Now, if certain ratio wants to maintain, the exchange ratio is based on that parameter. Sometimes the target company will say, okay, before and after my share will not diluted. Okay, I will accept your shares. Before whatever EPS I am having, after the acquisition also I want same EPS. In that case, you can consider EPS as the base. If they are saying acquisition, before acquisition, what is my MPS is there, after acquisition also I want same MPS. The target company will demand. In that case, you can take the exchange ratio based on MPS. So, in order to maintain certain ratio, the exchange ratio is based on that parameter only. Okay, sometimes in the question they will give you, okay, their EPS should not diluted. EPS should not diluted after acquisition means take exchange ratio on EPS only. So then check it will not be diluted. So let us see some problems, you can understand that. If it is difficult to assess which parameter should be taken to arrive the exchange ratio of the company, normally using several of them or sometimes, okay, so it is reliable that we will take 2 or 3 bases and we can give the weights for that, and you can take weighted average also for exchange ratio. Weighted average exchange ratio also sometimes we can consider. While coming to here, we are having already the swap ratio formula, MPS or EPS or BVPS of target company divided by acquiring company. Acquiring company and acquirer company is one and the same. And MPS, how to get it? Market price per share. What is the market value of the company divided by number of equity shares? They will give you the market capital of target company is 10 lakhs. And number of shares held by target company is 1 lakh. Then MPS is nothing but market capitalization divided by number of shares. We will get total 10 rupees. Market price per share, MPS is 10 rupees. Likewise, we will take market value of the company divided by number of shares. EPS, how do you get? The total earnings available to equity shareholders. EPS, how do you get? Means earnings available to equity shareholders divided by number of equity shares. Then how do you get book value per share? The same thing, Nana. Equity shareholders for net worth. Net assets available for equity shareholders will take divided by number of shares. You will get book value per share. Book value per share. Here we are not considering any fair values. And most important formula in this chapter, mergers and acquisition, is PE multiple. The PE ratio is nothing but price to earnings ratio. So price to earnings ratio, we have to mention in times, which is nothing but MPS by EPS. I want PE ratio for acquirer company. Acquirer company MPS divided by acquirer company EPS. Target company PE ratio if you want, target company MPS by target company EPS. We will get the ratio over here. Sometimes they will give you PE ratio, they will give you EPS, they will ask you to find out MPS. Then formula you can interchange. MPS is equal to EPS into PE ratio. Sometimes they will give you MPS and PE ratio, they will ask EPS. Then EPS is equal to MPS by PE ratio. PE ratio will be given in times. This will come in times, multiples. PE multiple or PE ratio. So then, what is the earnings per share after mergers as per new EPS? They will ask you what is earnings per share after acquisition or after merger. So here, X Limited having some earnings, Y Limited having some earnings. Now, X Limited acquired Y Limited. Acquisition is completed. For that, X Limited having, for example, so far 1 lakh shares to their existing shareholders. To acquire Y Limited, extra 50,000 shares they issued. So, total number of shares outstanding after acquisition is 1,50,000. 1 lakh original shares with their existing shareholders, 50,000 we have given as a consideration to shareholders of Y Limited. Anyway, X Limited is issuing these shares, so that total share capital of X Limited is 1,50,000. Is that clear, Nana? And the total number of shares issued by X Limited is 1,50,000. Now, earnings will be there for X Limited and Y Limited. Now, the question they will ask you, what is the EPS after acquiring Y Limited, which we can call it as post-merger EPS. Post-merger EPS. I told you here EPS is nothing but what, Nana? EPS formula is nothing but what? Earnings divided by number of shares. Earnings divided by number of shares. But we want EPS, no. Post-merger EPS. Post-merger EPS means after merger, target company earnings also mine. That means earnings of acquirer company plus earnings of target company. Earnings of acquirer company plus earnings of target company. If any synergies are there, I will add. If any additional benefits I am getting, that I will add, divided by total number of shares after merger. Total number of shares after merger. After merger, total number of shares is nothing but shares already acquirer company is having plus fresh shares issued to target, which is here 1,50,000. In this 1,50,000, 1 lakh shares already held by X Limited shareholders and 50,000 is held by shareholders of Y Limited. Even though it is issued by X Limited, then it is in the hands of shareholders of Y Limited, old shareholders of Y Limited. Now there is no Y Limited. Okay, so are you getting my point? So here we can call it as post-merger EPS. We can calculate post-merger EPS, earnings of acquirer, earnings available for equity shares of acquirer company before merger plus earnings of target company before merger plus synergies divided by shares of acquirer company before merger plus shares were transferred to target company. If you add all these things, so then we will get post-merger EPS. We are having the problems in that particular scenario. So here equivalent EPS or equivalent MPS of target company is there. So new EPS of merged firm into swap ratio. This point you can remember. Okay, so we'll see when we are doing the problems. Rest of the thing, promoters and all the things that we will do. So one by one we'll see. You can see problem number 1. Anurag Limited considering the acquisition of Binay Limited. Now Anurag Limited wants to acquire Binay Limited with stock to stock transfer. Okay, that means PC they are giving in the form of stock only. So relevant financial information they have given. Anurag Limited and Binay Limited, what is the present earnings? Presently their earnings are 7.5 lakhs, 2.5 lakhs. Total number of shares outstanding so far, 4 lakh shares, 2 lakh shares. EPS is nothing but earnings by number of shares, Nana. Here earnings divided by number of shares. EPS already they are given. So here EPS we are having that 1.875 and 1.25. PE ratio they have given 10 and 5. Generally, MPS is not given, but you can find out, no. How can we find MPS? Sir, market capitalization is not there. If market capitalization is not there, we have one weapon. Which weapon we are having here? PE ratio. And a PE ratio formula is MPS by EPS. If you want MPS, we can do interchange of formula. Tell me, MPS is equal to EPS into PE ratio. Okay. So, PE ratio we are having, EPS we are having. If you multiply, automatically MPS we will get. Is that clear? So, let us see. What is the market price of each company? Each company market price, how can we find? We have PE ratio and we have EPS. You can check on it. PE ratio is equal to MPS by EPS. Therefore, MPS is equal to EPS into PE ratio. Anurag Limited, MPS how much? 1.875 into PE ratio 10, 18.75. So, Binay Limited, how much? 1.25 into PE ratio 5, which is 6.25. So, MPS we found. MPS we found. Simply, how do you find MPS? If you know this formula, PE ratio is nothing but MPS by EPS. We want MPS. Therefore, we can multiply PE ratio into EPS or EPS into PE ratio, whatever. So, we will get this thing to calculate MPS. Next one, they are asking market capitalization. I told you here, MPS is equal to market capitalization by number of equity shares. That they are asking what is market capitalization. Again, you can interchange. Market capitalization is equal to MPS into number of equity shares. Already MPS we know, and number of equity shares we have to. Market cap is equal to number of shares into MPS. So, here we are having that MPS already you found in step 1. And what is the number of shares in Anurag Limited and Binay Limited? 4 lakhs for Anurag Limited, 2 lakhs for Binay Limited. Just you multiply number of equity shares into MPS, we will get total market capital of Anurag Limited and Binay Limited. And third one, they are asking what? Point number C, they are asking if PE ratio of Anurag changes to 7.5. Previously, PE ratio of Anurag is 10. Now, if it is changed to 7.5, then what is the market price of Anurag? Just you change that PE ratio and make it possible. Previously 10 kadna. Previously how much it is? 10. You can say here EPS into PE ratio will get MPS. So, instead of 10 you can take it 7.5, then PE ratio changed. So, how much it is? 7.5 into 1.875. Automatically revised MPS we will get it. Revised MPS is 1.0625. And what they are asking again, PE ratio changed, so that MPS we got new MPS. And does market value of Anurag Limited will change because of MPS change? Definitely the market value will change. Yes. What is revised market capitalization? We are having revised MPS into number of shares. Previously 4 lakh into 18.75. Now 4 lakh into new MPS 14.0625. We'll get 56 lakhs 25,000. Now what is the difference? Will it change it or not? How much is changed? Yes. Here previously when it is of 18.75, my market capital is 75 lakhs. When it is changed the MPS to 14.0625, my market capital is 56 lakhs 25,000. Increased or decreased? Decreased. So, how much get decreased here? 18 lakhs 75,000. That is the change in market capital because of change in MPS. And what is there asking in the fourth question? What would be the exchange ratio based on market price? That means based on market price, what is the exchange ratio? If you take market price as the base, so market price as the base, that means the exchange ratio formula na, market price of target divided by market price of acquirer. Here target is B Limited, we can say Binay Limited, and we are having acquirer is nothing but we are having here Anurag Limited. Anurag Limited, which one we have to consider? Recently we modified MPS, a revised MPS you have to consider. So, here we are having MPS of target 6.25 by revised MPS of acquirer company, which is Anurag Limited 14.0625, which is 0.44. It is the exchange ratio. So then how many number of shares you can give? Target company number of shares into exchange ratio 0.44. We have to give 88,000 shares. So that is all about the first question. Okay. All mergers and acquisition questions, they will give you the data. They will give you the data. They will ask you like anything. The questions they can frame like anything. Just you have to interchange the formulas, what you have learned, and make them sure what they required. We have to give the output. Okay. So just like we have to make all these things. Okay. Let us go to the next question now. So check out here. We're having another model type. We're having, sometimes they will ask you post-merger EPS and post-merger MPS. Sir, what is post-merger EPS and MPS? Just before I told you, before merger, EPS formula is nothing but generally EPS formula is what, Nana? Earnings divided by number of shares. So here we are making post, here also post, here also post, which is nothing but post earnings divided by post number of shares, which is nothing but earnings after acquisition divided by number of shares after acquisition. So here we can say post merger EPS is nothing but earnings of acquirer company plus earnings of target company, both the companies, because after acquisition both companies earnings belongs to acquirer only. So earnings of acquirer plus earnings of target divided by total number of shares after merger. How do you get total number of shares after merger? Number of shares of acquirer already existing plus how many number of shares we issued to target as a purchase consideration. If you add, then we will get the post merger EPS after entering these things. Now when it is having synergies in the question, if it is given, so then earnings of acquirer plus earnings of target plus synergy divided by total number of shares after merger, we will get this. And based on that, what is meant by synergy? Synergy is nothing but some extra benefit that we are getting based on this acquisition. That means my earnings might improve, which is also caused because of synergies. X Limited acquired we can say Y Limited. No. So before merger, X Limited, what is the earnings? After merging of Y Limited, what is the earnings? So then if you get the difference over here, post-merger earnings minus pre-merger earnings, if any difference is there, which is nothing but a synergy. So synergy is nothing but post-merger earnings minus pre-merged earnings. So pre-merged earnings, we have to consider earnings of acquirer plus earnings of target. So post-merger earnings, automatically you know what is the number of shares that we are having post-merger into revised EPS. So we'll calculate that. So calculation of MPS after merger. Already we know this. PE ratio, based on PE ratio is nothing but MPS by EPS. We want MPS. So that PE ratio into EPS we will get. Okay. So acquirer PE ratio, whatever we are having, we can find like this. And calculation of market price without synergy. MPS without synergy. We are having that. What is the market value? Then a post-merger MPS. Before that we have seen post-merger EPS. Now we have to see post-merger MPS. Generally, MPS is nothing but what? MPS is nothing but market value of the company divided by number of shares. But we want here post-merger MPS, which is nothing but post-merger market value. Post-merger market value means market value of acquirer plus market value of target. Divided by number of shares means same. Okay, number of shares of acquirer plus how many number of shares issued to target. So number of shares after merger we have to be considered. Both are post. Then post merger MPS formula, market value of acquirer plus market value of target. If synergy is there, add synergy divided by total number of shares after merger. And generally this is without synergy, just to strike this. This is without synergy. With synergy means just we add synergy, that's it. So synergy is equal to post-merger market value minus pre-merger market value. Previously we found synergies based on earnings, and now we are seeing the synergies based on market value. So post-merger market value minus pre-merger market value. That means before merger market value something I am having 10 lakhs. After merger, what is my market value? Okay, whether it is increased or decreased is due to synergies over here. That we will see in the problems. Problem number 2, once you check. Raghav Limited is intended to acquire Saurav Limited by merger. So based on the merger, he wants to merge Saurav Limited, and the following information are available in respect of both the companies. So both companies, Raghav Limited, Saurav Limited. Acquirer is Raghav Limited, target company is Saurav Limited. Now acquirer earnings is 2,50,000 before merger, and Saurav, we can call it as target company earnings is 90,000. How many number of shares outstanding? 50,000 shares in Raghav Limited, 50,000 shares outstanding in Raghav Limited, and 30,000 shares outstanding in Saurav Limited. MPS, we are having 21 and 14. So 21 rupees is market price per share of Raghav, and Saurav MPS is 14. Now first what they are asking, what is the present EPS of both the companies? Now here EPS they are asking. So EPS, how do you get? Earnings divided by number of shares. So 2,50,000 divided by 50,000, 90,000 divided by 30,000. Automatically you will get what is the present EPS of both the companies. That is the first question. So total earnings divided by number of equity shares. So earnings for Raghav Limited, earnings for Saurav. 2,50,000 by 50,000, 5 rupees. 90,000 by 30,000, 3 rupees. These are the EPS, present EPS of both the companies, Raghav Limited as well as Saurav Limited. And the second one they are asking, if the proposed merger taken place, that would be the new earnings per share of Raghav Limited, assuming that merger taken place by exchange of equity shares, exchange ratio is based on current market price. So based on new market price, we can say that current market price based on MPS. And exchange ratio formula based on MPS clearly given. So we can say MPS of target divided by MPS of acquirer. So target company is Saurav Limited. MPS of Saurav divided by MPS of Raghav Limited. 14 by 21. So here exchange ratio will be 14 by 21, which we can call it as 7, 2 by 3. For every 3 shares, we are giving 2 shares. Okay. So this time we have taken as fraction. For every 3 shares in Saurav Limited, Raghav Limited have to give 2 shares. Then how many number of shares does Raghav Limited is having earlier? We have to issue. Raghav Limited have to issue. Now 30,000 shares they are having. Listen. For every 3 shares, we are giving 2 shares. Now, Saurav Limited having 30,000 shares. For 30,000 shares, how many shares we have to give? 30,000 into exchange ratio. So, 30,000 into, so 2 by 3. For every 3 shares, we are giving 2 shares, which is nothing but 20,000 shares. 20,000 shares, Raghav Limited have to give to Saurav Limited in order to acquire. Now, already he is having 50,000 shares outstanding, and now he is issuing 20,000 shares. After acquisitions, total number of shares outstanding will be 70,000. 50 plus 20. Is that clear? So that is what here we have taken 20,000. Total number of shares of Raghav Limited after merger. Initial 50,000 outstanding, present 20,000 you issued, total 70,000. Now, what is the earnings of Raghav Limited after merger? After merger, your earnings belongs to you, your target earnings also belongs to you. 2,50,000 plus 90, total 340. Now, we know combined earnings and we know total number of shares after merger. Simply will get post merger EPS how much? After merger of EPS, combined earnings divided by total number of shares after merger. 3,40,000 divided by 70,000, which is 4.86. New EPS is 4.86. So before merger, what is the EPS, Nana? The first step we have found 5. Before merger 5. After merger, post merger EPS, how much it is? 4.86. 4.86. Is that clear? After acquisition, your EPS is decreased. Raghav Limited, before merger, he is having 5 rupees earnings. A EPS is nothing but 5 rupees earnings per share they are having, and here they are having 4.86. Now, what is the third point they are asking? What should be the exchange ratio if Saurav Limited wants to ensure that same earnings to the members as before the merger taken place? Now, here Saurav Limited, you see over here. What is the EPS of Saurav Limited before merger? 3. After merger, he is having how much? 4.86. Okay. So generally, his EPS is increased. But sometimes if we want the same earnings before and after, generally no target company will ask like that. Before EPS you are having 3 rupees, after EPS I am giving 4.86. You will ask what is the 3 rupees? He want only 3 rupees. No, generally this is the problem, they are asking like that. Okay. So if they want to earn same earnings before and after, then how to consider this? Calculation of exchange ratio ensuring that Saurav Limited to earn same EPS, we can say same earnings before the merger taking place. In that case, I told you here, if you want to maintain same EPS, you can take exchange ratio on the basis of EPS. But previous in point number B, we consider exchange ratio based on MPS. It depends upon the question. Question clearly given. Take MPS as a base. And point number 3, point number C, he is giving that we don't want to dilute EPS. Before and after same earnings they want. You can consider EPS. Now exchange ratio is based on EPS. What is the earnings? So, EPS exchange ratio formula? EPS of target divided by EPS of acquirer. Now here target company is Saurav. Saurav EPS is how much? 3 divided by Raghav EPS how much? 5. For every 5 shares we are giving only 3 shares now. For every 5 shares we are giving only 3 shares, which is nothing but 3 by 5, which is point number 0.6 you can consider, or otherwise 30,000 into 3 by 5. We will get 18,000 shares we are giving. 18,000 shares. Now how much will be the post merger shares, Nana? Already existing 50. Present we are issuing 18,000, total 68,000. Earnings will be same before when we are taking the earnings of target company, or we can say earnings of acquirer after the merger. Earnings belongs to you and earnings belongs to target, both are belongs to acquirer only. So same 2,50,000, 90. Okay, so total divided by total earnings divided by number of shares to be issued. Sorry, number of shares after merger outstanding how many? 68,000. Then they will get 5 rupees. The total earnings after merger Saurav Limited is how much? 5 rupees into 18,000 will be 90,000. So before also he is having 5 rupees. So you have to consider the earnings, not EPS. So now EPS we are having here 5 rupees. Now here how many number of shares? 18,000. Previously how many number of shares we have given? Here 20,000. Now 18,000 into 5 rupees, which is 90,000. Now check out here, before how many number of shares he is having? 30,000 shares. 30,000 shares, and EPS is how much, Nana? 30, which is 90,000. Earnings are not diluted. You can check over here. We are talking about Saurav company point of view. Saurav company pre-merger and Saurav company post-merger. Saurav company pre-merger, they are having how many number of shares? So they are having, we can say 30,000 of shares. And earnings per share is 3 rupees. Total earnings will be 90,000. Now post-merger, how many number of shares we are giving to him? Based on EPS as an exchange ratio, 18,000. Now what is EPS? 5 rupees, which is nothing but how much, Nana? 90,000. And before merger and after merger, earnings is same. In order to get same earnings before and after merger, then take exchange ratio is based on EPS. Then earnings will not dilute. Earnings will not dilute if you take exchange ratio based on EPS. That is what the question they have given. They want the same earnings before and after. So take EPS, exchange ratio based on EPS. So that is all this question is all about. And you can see problem number 3. So check out here. Highland Company is considering the acquisition of Lowland Company in stock for stock transaction, in which Lowland Company would receive 90 rupees for each share. For every share in Lowland Limited, they will get 90 rupees per share of its common stock. Common stock means equity shares. Highland Company does not expect any change in its price or earnings ratio or multiples after the merger. So after the merger, they don't want to change any EPS or any changes in that. and chooses the value of lowland company conservatively by assuming that no earnings growth due to synergies. There is no synergies also. So here we need to check the data, whatever they're asking. See, so many points. Recent examination, I think they have given this question, this type question. Purchase price premium, they're asking. Exchange ratio, they're asking. Number of new shares to be issued by Highland Limited. This all we are doing in the basic level. Post-merger EPS, important. Pre-merger EPS of Highland already we will get. Pre-merger PE ratio. Post-merger share price, which is MPS. And post-merger equity ownership distribution. This is also important. So here, let us see. What is the data given? Highland Limited and Lowland Limited, we have earnings, number of shares and market price. All the things are given. Now we'll check what is the purchase price premium. Nana, each share in Lowland Limited is how much? 60 rupees. For every 60 rupees, you are giving 90 rupees. For every 60 rupees, you are giving 90 rupees. That means more than market price you are giving. So how much is the premium you are giving? In order to calculate premium, so we'll get over here. So for every 60 rupees share, you are giving 90 rupees. That means you are giving 1.5 times extra. In times, if you want, this is the purchase price premium. No, sir, I want it in percentage. Generally, they will ask you purchase price premium in percentage. Percentage means actually deal price is how much, which is nothing but offer price is how much? 90. But actual MPS is how much? 60. So we can get here deal price minus MPS by MPS into 100. And we can say 60 rupees value, okay, you are giving 90 rupees. So how much percentage of premium you are giving? Which is nothing but 90 is the deal price minus 60 by 60 into 100. Calculate here. So 30 by 60 into 100. So how much premium you are getting here? 50 percentage. 50 percentage. You can apply here 60 plus 50%, which is 90. So how much percentage of premium? No, 50%. If you want it on percentage, follow this formula. Deal price minus market price by market price into 100. Market price of target is 60 only, but you are giving 90 rupees. How much extra premium you are giving? 50% extra premium in percentage. Sir, you want it in times, directly 90 by 60, 1.5 times it is increased. Is that clear? So 60 into what? We can say 60 into 1.5, which is 90. In times we will get, in percentage we will get 50 percentage or 1.5 times. So we can consider here offer price of lowland stock divided by lowland, we can say lowland market price per share. What is here? Offer price is 90, market price is 60, it is 1.5. Percentage, we can say purchase premium, purchase price premium. We are getting, this is the premium, 1.5 times. And exchange ratio. Exchange ratio already we know that. So the same thing. And exchange ratio for every, he can say that for every 60 rupees we are paying 90 rupees. So here price per share offered for Lowland Limited divided by market price of Highland Limited into 100. So how much you offered here? 90. Okay, so you have to consider here 90. For every 90 you are giving your 50 rupees shares. So that means your exchange ratio is 1.8. Are you getting my point? And exchange ratio formula is what? Generally MPS of target divided by MPS of acquirer. When you are giving based on MPS, but you are not giving based on MPS, you are taking offer price. Then you have to consider price offered to Lowland company divided by MPS of Highland company, which is acquirer. So 90 by 50, which is 1.8, which is nothing but 1.8 is to 1. For every 1 share in Lowland Limited, we are giving 1.8 shares in our company. Once you check on it. So check out here. So what is the next one they're asking? Exchange ratio also we have completed. Now number of new shares to be issued, Highland Limited, already we know. So here issued by Highland Limited. Lowland Limited, how many number of shares they are having? 20,000. Having 20,000 into exchange ratio. So 20,000 into 1.8. We are having 36,000 shares. For every 1 share, we are giving 1.8 shares, which is nothing but here 20,000 into 1.8, 36,000 new shares. Now you tell me, Already Highland company having how many number of shares, Nana? Highland company having 1,10,000, and at present we are giving additionally 36,000. So 1,10,000 plus 36,000, 1,46,000 shares are given. We can say total outstanding after merger is 1,46,000. Now combined earnings, earnings of Highland Limited plus earnings of Lowland Limited, we are getting combined earnings. Combined earnings divided by total number of shares after merger, or we will get post merger EPS. So that is what the point number D they are asking. Post merger EPS of combined firms. So combined earnings divided by total number of shares after merger. So then we will get here 1,46,000. So post merger EPS of combined entities. So we are having that 3,22,000 divided by 1,46,000, which is 2.21. So EPS will be, new EPS will be 2.21. Now pre-merger EPS of Highland company they have given. So pre-merger, before merger earnings is 2,50,000, number of shares 110, which is 2.27. See here, before merger they are having earnings per share is 2.27. After merger their earnings is diluted. 2.21. Earnings is nothing but EPS is decreased. So that is you have to keep in your mind. And coming to what they are asking next, pre-merger EPS completed. Post-merger MPS they are asking. Post-merger MPS, how do you get, Nana? Post-merger share price. See here, we can use this formula again. P ratio formula. P ratio formula. MPS by EPS. Now, EPS, sorry, here we want what? Market price per share. MPS is equal to P ratio into EPS. Now we want post EPS, sorry, post MPS. Post MPS is equal to post P ratio into post EPS. Post EPS already we got 2.21. Sir, post merger PE ratio nothing is given. If post merger PE ratio is not given, we have to consider pre-merger PE ratio, whatever is there, it will continue. Sir, how can we know that? If nothing is given, we are continuing with the same PE ratio, PE multiple. Or sometimes they will give you PE ratio is decreased by this extent or increased by this extent. In that case, we will consider that. If not, pre-merger PE ratio, how much is there? Same thing will apply here. That means post-merger MPS, in order to get, we will get post-merger EPS into pre-merger PE ratio. Post-merger EPS is 2.21 into pre-merger PE ratio, already we are having 22. So PE ratio already we calculated. How much, Nana? Pre-merger PE ratio is 22, already low. So when you multiply, we will get post-merger MPS. So 48.60 as compared to 50 is pre-merger. Before merger 50. Now post-merger MPS is 48.60. MPS also diluted. Okay. So here, because of this merger. Now post-merger equity ownership distribution, let us see. So how this equity will be distributed? It's simple way, Nana. Lowland company, we are having number of new shares divided by total number of shares. So how many number of new shares we are giving to them? 36,000. Out of total 1,46,000. In 1,46,000, 36,000 is nothing but 24.66% of ownership lies with Lowland company shareholders, and balance ownership lies with Highland company shareholders. So their ownership distribution is 75.34% for Highland company, 24.66% for Lowland company. Simple. Already you know how many total number of shares? 146. In that 110 is own, 36,000 we are giving to target. Now we can take the percentage, 36,000 divided by 146, 1,10,000 divided by 146. We will get ownership distribution. But here you can see the acquisition results in 1.4 reduction in the market price of Highland Limited, because previously it is 50, now it is decreased to 48.60. So how much decrease? 1.4. Due to, why this is decreased? Due to decline in EPS. EPS previously how much? 2.27, but after merger 2.21. Sir, your EPS is decreasing, your MPS is also decreasing, your MPS is also decreasing post merger, and that means here acquisition is a favorable manner for you? We can say it's a favorable acquisition for us. No. So due to decline in EPS of combined companies, so whether the acquisition is a poor decision depends upon what happens to the earnings would have absence of acquisition. The acquisition may contribute the market value of Highland company. That means in the absence of this new acquisition, before acquisition only, we having more market capital, more market value, MPS is more, EPS is more. So it is a poor decision. So you can make a comment for that. That's the end of this particular question. Okay. So let us see the remaining questions here. Problem number 4. Check out Nana. Abhishek Limited is considering to take over Bikash Limited and Chitra Limited. So here Abhishek Limited is an acquirer and Bikash Limited and Chitra Limited is a target. So he wants to acquire Bikash Limited and Chitra Limited. So he is considering that the financial data of all the 3 companies they have given, acquirer company data given, and 2 targets also they have given. So equity, share capital, earnings, market price per each share, MPS they have given clearly. So they are asking here what is the price earning ratios, which is nothing but PE ratio. So in order to compute PE ratio, what we required? MPS by EPS. MPS already given here, we need to find out EPS. So EPS, in order to find, what is the EPS formula? Earnings divided by number of equity shares. Earnings already given, number of equity shares we can able to find out here, because here 10 rupees each share, 450 crores, which is nothing but here we are having that. So 45, 18 and 9 we are having here the earnings per share of this particular companies. So here the second point they are asking, earnings per share of Abhishek Limited after acquisition of Bikash Limited and Chitra Limited separately they are asking. That means A Limited acquired B Limited and A Limited acquired C Limited. What is post merger EPS? So what is post merger EPS after acquisition? We have to show it separately. And finally, you have to recommend whether to accept the merger or reject the merger. So we have to give the decisions here. Will you recommend the merger either of any one company or both the companies? So you can take out both the companies. We have to give the suggestion here. So let us see. First they are asking what PE ratio. So how to calculate PE ratio? MPS by EPS. So here MPS, how do you get? None already given in the question. EPS we need to find out. Earnings divided by number of equity shares. Earnings we are having 90 and 18 and 18. So number of equity shares we are having 45 crores, 18 crores and 9 crores. So when I've divided here, earnings per share we got here 2, 1 and 2. So EPS of Abhishek Limited is 2, EPS of Bikash Limited is 1 and EPS of Chitra Limited is 2. MPS already directly given in the question. So we have EPS and MPS. We need to find out PE ratio. PE ratio is nothing but MPS by EPS. So PE multiple, how much we are getting here? 60 by 2, which is 30, 37 by 1, which is 37, 46 by 2, which is 23. So PE ratio we are having in these scenarios. And second one, they are asking post merger EPS. So how to calculate post merger EPS? Post merger EPS is nothing but after the merger, we are having combined earnings divided by total number of shares. Total number of shares after merger. How do you calculate total number of shares after merger? We have seen lot of questions. What are the number of shares already existing with the acquirer, plus how many number of shares we are giving to the target by the way of purchase consideration. So in order to find out, we should know how many number of shares acquirer is issuing to the target. How many number of shares A Limited is issuing to B Limited? How many number of shares A Limited is issuing to C Limited? First you need to find that. So then already existing number of shares we are having. If you add that existing shares plus new shares, we will get total number of shares. So total number of shares after acquisition we required, and combined earnings, already we know earnings clearly given. Combined earnings also we can get it. Abhishek plus Bikash, combined earnings is 108. And Abhishek and Chitra we are having here also, we are having 108. So let us see here. First exchange ratio. So in order to find out how many number of shares to be issued, we need to find the exchange ratio. So what is here? MPS of target divided by MPS of acquirer. So based on MPS, we are calculating the exchange ratio. So calculation of EPS after acquisition we required. First exchange ratio we have taken. Now the MPS clearly given directly in the question. You can see here. MPS, first target is A plus B. Second target is A plus C. Now you tell me, exchange ratio, here target MPS is 37 and acquirer MPS is 60. 37 by 60. And here that we can say A plus C. So Abhishek Limited acquired Chitra Limited. In that case, what is the exchange ratio? MPS of target 46 divided by MPS of acquirer 60. 46 by 60. So when you do that, we will get the proportions over here. Target price per share divided by acquirer share, we can say price per share. That means MPS of target divided by MPS of acquirer. Then we will get exchange ratio over here. Now, how do you know how many number of shares we have to give? How many number of shares target company is having? How many number of shares target company is having multiplied with exchange ratio? Then we can understand that. In simple way, we can say 0.617 is nothing but what? For every one share in the Bikash Limited, Abhishek Limited is giving 0.617 shares. And for every one share in Chitra Limited, the acquirer company Abhishek Limited is giving 0.767 shares. Now, how many number of shares we need to find out? So, number of shares already given in the crores, already we have calculated number of shares. Here we are having 18 crores, here we are having 9 crores. For 18 crores, how many number of shares we have to give? 18 into 0.617 and 9 into 0.767. So, we can say target company number of shares multiplied with exchange ratio. So, we know how many number of shares? 11.10 crores and here 6.90 crores. Now, we will see combined shares. Before acquisition, how many number of shares Abhishek Limited is having here? 45. So, 45 plus 11.10. When you multiply here 45 plus 11.10, which is 56.1. And Abhishek and Chitra, let us see, 45 existing shares plus how many shares we have to give to Chitra Limited here? 6.90. So 45 plus 6.90, which is 51.90. So we got a combined number of shares. Total number of shares after acquisition is this much. Separately we are doing A plus B and A plus C. Now coming to here, combined earnings. So we know earnings here. Same 90, we are having earnings of Abhishek Limited and Chitra Limited 108 and Abhishek and Chitra Limited also 108. A to B and A to C. So, we are having the total earnings of acquirer company plus earnings of target. So, here earnings of acquirer company is 90 and earnings of target company is 18, which is 108. When you check on A plus C, earnings of Abhishek Limited is 90 and earnings of Chitra Limited is 18. Here also we are having 108. So, we have to consider combined earnings is 108. Now, combined earnings we know. How many number of shares after acquisition also we know. We can calculate post-merger EPS. Post-merger EPS is nothing but combined earnings divided by combined number of shares or total number of shares after acquisition. We got 1.93 and 2.08. Now, you compare previously what is the EPS, Nana? Abhishek Limited previous EPS is 2 and after that post-merger EPS is 1.93. That means before acquisition of Bikash Limited, they are having earnings per share is 2. After acquiring Bikash Limited, it is 1.93. So, his EPS is diluted because of acquisition. This is first proposal. Second one, when you go to Chitra Limited, Abhishek Limited acquired Chitra Limited. Initially, their EPS is 2. After acquisition of Chitra Limited, their EPS is 2.08, which is higher. So, we can conclude that which acquisition is better? Abhishek with Chitra is better or Abhishek with we can say Bikash Limited is better. Here Abhishek with Bikash Limited, your EPS is reducing. So, don't go with that merger. You have to give the suggestion. Okay. So, Abhishek with Chitra, your EPS is increasing over here. You can go for that merger. You can see the analysis after the merger of Chitra Limited with Abhishek's Limited, EPS is higher than Abhishek. We can say that 2.08. Hence, the merger with only Chitra Limited is suggested to increase the value for shareholders of Abhishek Limited. Previously, shareholders of Abhishek Limited, they are having only 2 EPS. Now, after acquiring Chitra Limited, their EPS is increased to 2.08. So, it is better that you can acquire Chitra Limited rather than Bikash Limited, where you are having lower EPS if you acquire a Bikash Limited. Is that clear? So, that is about that. You have to give the suggestion A plus B is better or A plus C is better. A plus C is better over here. So that is all about this question. And coming to problem number 5. XYZ Limited is considering merger with ABC Limited. Now XYZ Limited shares are currently traded at 25. Clearly given MPS of XYZ Limited at market price is 15 rupees at present, 25 rupees at market at present. Now it has 2 lakh shares outstanding and its profits is 4 lakhs. So they have given how many number of shares outstanding and profit after tax also. ABC Limited has 1 lakh shares outstanding and its current market price is 12.5 and profit after tax is 1 lakh. In simply they have given XYZ Limited and ABC Limited, 3 details they have given. One is number of shares outstanding, MPS of that particular company and earnings of that particular company, which is profit after tax. Earnings given, MPS given, number of shares given for both the companies. Now the merger will be affected by the means of a stock swap. So they want to do acquisition here by acquiring the stock. ABC Limited has agreed to plan under which XYZ Limited will offer the current market value of ABC Limited shares. Now they are taking the exchange ratio based on MPS. So they are asking over here, what is the pre-merger earnings per share? What is EPS before merger and what is PE ratio of both the companies before merger? EPS easily we will get. How? Earnings divided by number of equity shares. Both the things given, no? We can see here for XYZ Limited, for ABC Limited, profit after tax given, number of shares given. Profit after tax is nothing but earnings divided by number of shares. We will get EPS. 4 lakhs by 2 lakhs, which is 2. 1 lakh by 1 lakh, which is 1. We got EPS. PE ratio, how do you get? PE ratio is nothing but MPS by EPS. EPS already we found now. MPS already given in the question. What is MPS of both the companies? 25 and 12.5. Now PE ratio formula, MPS by EPS. So MPS we are having 25, EPS 2, which is 12.5. And MPS we are having 12.5, EPS 1, which is also 12.5. So PE multiple for XYZ Limited and ABC Limited is 12.5 times. So these are the things firstly they have asked. And second one they are asking, if ABC Limited PE ratio is 8, generally PE ratio how much we got here? 12.5. But here saying that if ABC Limited PE ratio is 8 instead of 12.5, if it is 8, what is the current market price? What is the exchange ratio? And what is the post-merger EPS? 3 things they have asked. Okay, if PE ratio is 8, what is current market price? Already we know the relation of PE ratio, MPS by EPS. They are asking if your PE ratio is 8, what is MPS? Divided by EPS already we know. So how much EPS we know? You can see here. If PE ratio is 8, what is exchange ratio, Rara? So before going to that, exchange ratio will be transferor, which is nothing but target company market price divided by acquirer company market price, transferee, which is nothing but acquirer. So here 8 divided by, here we need to consider. So here it is 8, Nana, listen very carefully. So what is the market price? If PE ratio is 8, market price is nothing but what? MPS is equal to EPS into 8. EPS, how much we got here? What is EPS of ABC Limited? 1. So 1 into 8, which is how much? Same, 8 only. So here 1 into 8, which is 8 only. So you can write down here, if PE multiple is 8, what is MPS? MPS is nothing but EPS into PE multiple. So EPS of ABC Limited is how much? 1 rupee into MPS is nothing but 8, which we can call it as 8. So we know here MPS is 8. So MPS of ABC Limited, which is target, is 8 and the MPS of acquirer company is 25. MPS of acquirer company how much, Nana? XYZ Limited, which is 25. Now we can say target divided by acquirer. So 8 by 25. 8 by 25, we got 0.32. This is the exchange ratio. That means for every one share in ABC Limited, we are giving 0.32 shares as a consideration. Now, how many number of shares ABC Limited is having? 1 lakh shares. For every one share, we are giving 0.32 shares. For 1 lakh shares, how many we are giving? 1 lakh into 0.32, which is 32,000 shares we are giving. 32,000 shares we are giving. Acquirer company, existing shares, how many, Nana? Acquirer company, existing shares 2 lakhs, and we are giving as a consideration 32,000 shares. Total number of shares after merger is how much? 2 lakhs 32,000. Old shares plus new shares issued. Now, total earnings, you can combine both the earnings. So, here we are having 4 lakhs plus 1 lakh. Combined earnings is 5 lakhs. Now, combined earnings we know, and total number of shares after merger we know. So, new EPS or combined, you can say post merger EPS will be combined earnings 5 lakhs divided by total number of shares after merger 2 lakhs 32,000, which is nothing but 2.16. This is the new EPS or post merger EPS, okay, for this problem. That is what they have asked in point number B. Okay, if PE ratio is 8, what is current market price and what is exchange ratio and what is the post merger EPS? All the things we have find out here. Okay, so first you find out what is MPS based on PE ratio. If PE ratio is 8, MPS is equal to EPS into PE ratio, which is 8. So likewise, and third one they're asking what must be the exchange ratio XYZ Limited pre and post merger EPS to be the same. EPS is nothing but here earnings to be the same. If they want to get same earnings, which ratio is preferable, Nana? If earnings of both the companies are not to be diluted, recommended exchange ratio is based on EPS. I told you, if earnings don't want to dilute, then you have to take the exchange ratio based on earnings, which is EPS. Okay, if your market price don't want to dilute, you can take a exchange ratio based on MPS. So here EPS we have to consider. So EPS exchange ratio formula, EPS of target divided by EPS of acquirer. So EPS of target company ABC Limited EPS how much, Nana? 1 divided by EPS of target by acquirer is 2. Target is 1 and acquirer is 2. So 1 by 2. 1 by 2, which is 0.5. For every one share, we have to give 0.5 shares. Is that clear? No. That means half shares we are giving. That means you can see 1 lakh shares they are having. 1 lakh shares they are having. We have to give how many number of shares? 50,000 shares. Initially, I am having 2 lakh shares. Freshly, I am issuing 50,000. Total 2 lakhs 50,000. 2 lakhs 50,000 is combined share. Combined earnings is 5 lakhs. 5 lakhs by 2 lakh 50,000, which we are getting 2. Okay. So here we are having that EPS is 2. Post merger EPS is 2. Here post merger EPS is 1. But this 1 is for how many number of shares? 1 lakh. 1 lakh into 1 here. And now after acquisition, how many shares we are giving? 50,000. 50,000 into 2, it is also 1 lakh. Same earnings they are having without having any dilution. So likewise, you need to compare. Is that clear, Nana? If your exchange ratio is based on EPS, then EPS of target divided by EPS of acquirer, which is nothing but 1 by 2, 0.5. For every one share, we are giving 0.5 shares. Now, how many number of shares to be issued? Target company having 1 lakh shares. For every one share, we are giving 0.5 shares. So, 0.5. 50,000 shares we have to give. Now, acquirer company already having. So, total shares already existing 2 lakhs plus now 50,000. Total 2,50,000. 2,50,000 shares. Total number of shares after acquisition. So, now what is combined earnings? 5 lakhs divided by total number of shares 2,50,000. So, which is nothing but 2. Post merger EPS is 2. Okay. Now, pre merger EPS is 1. 1 for how many shares? 1 lakh shares. Before merger, they are having 1 lakh shares. 1 lakh into 1, which is 1 lakh is the total earnings. And after earnings, after acquisition, how many number of shares they are having? Only 50,000, not 1 lakh. We have give only 50,000. But EPS is how much? 2. So, 50,000 into 2, that is also 1 lakh. So, before also they are having 1 lakh earnings. After also they are having 1 lakh earnings. So, earnings are not to be diluted, means you have to consider exchange ratio based on EPS. So let us see the remaining questions. So check out here problem number 6. Company X is contemplating the purchase of company Y. X wants to purchase company Y here. Company X has 3 lakh shares having the market price 30 per share. MPS of X Limited is 30 rupees per share. While company Y having 2 lakh shares selling at 20 per share. So market price is 20 rupees for company Y. And EPS also given 4 and 2.25 for company X and Y respectively. Management of both the companies are discussing two alternative proposals for exchange of shares as indicated. Now here X Limited wants to purchase Y Limited. Now X Limited have to pay purchase consideration. So they are paying purchase consideration as stock to stock. In this, which ratio will be applicable? So they are having two ideas. One is in proportion to earnings per share of two companies. That means here they want to take exchange ratio based on EPS. EPS means, so EPS of target divided by EPS of acquirer. This is one proposal. Another proposal is that 0.5 share of company X for every 1 share in company Y, which is nothing but for every 1 share in company Y, X have to give 0.5 shares. So ratio, exchange ratio will be 0.5:1. Two alternatives they are having. So we have to check out two alternatives and find out the reasons. What are the things? You are required to calculate earnings per share after merger under two alternatives. So based on two exchange ratios, we have to calculate post-merger EPS and show the impact on EPS of shareholders of two companies under both alternatives. In both alternatives, for two companies, you need to show what is the impact of EPS. Before merger, what is the EPS? And after merger, what is the EPS and what is the impact? Whether it is increases or decreases, we need to find out. So problem number 6, what are the details we had? So total number of shares outstanding in company X and Y, 3 lakhs and 2 lakhs, and EPS already given 4 and 2.25. So earnings will be, total earnings we know, when you multiply with that, you can get the earnings. The total number of shares into earnings per share. We get here total earnings 12 lakhs, 4 lakh 50,000. So combined earnings is 16 lakh 50,000. Now coming to first point. If EPS, when exchange ratio is proportion to relation of EPS. So here when exchange ratio in proportion to relative of EPS means exchange ratio based on EPS we have considered. So what is the formula, Nana? EPS based. So we are having here. So company X having total 3 lakh shares and company Y is having. So directly they have taken. Actually ratio how we have to consider? Exchange ratio based on EPS. What is EPS of target? 2.25 and EPS of acquirer which is 4. So how many number of shares Y is having? 2 lakhs. So 2 lakhs into, for every 4 shares we are giving 2.25. Sorry, here we are having that. For every 4 shares we are giving 2.25 shares. So based on that we are having 2.25 divided by 4. So how many number of shares we have to give? 1,12,500. Is that clear? No. So here company X is having 3 lakh shares initially, and how many shares we are issuing? 2 lakhs into exchange ratio EPS of target divided by EPS of acquirer, 2.25 divided by 4, 1,12,500. So total number of shares after merger is 4,12,500. Now we got total number of shares after merger, but we want what? Combined earnings. Both we had, no? So we can calculate here. So company X before merger EPS is 4. After merger, what is EPS? How do you get EPS after merger? Combined earnings divided by total number of shares after merger. So 16 lakhs 50,000 divided by 4 lakhs. 16 lakhs 50,000 divided by, here you can see, sorry. 16 lakh 50,000 divided by total number of shares after merger is 4,12,500 shares, which is 4. So before merger also they are having 4, after merger also they are having 4 here. So in these conditions there is no impact. Okay. So coming to when EPS, when exchange ratio is 0.5:1. For every 1 share we are giving 0.5 shares. Now combined earnings will not change, which is 16,50,000. So how many number of shares after merger? Initially we are having 3 lakhs. Now freshly we are issuing for their 2 lakh shares. For every 1 share we are giving 0.5 shares, which is total 1 lakh. 3 lakhs plus 1 lakh, which is 4 lakh shares. Total number of shares after acquisition. Now calculate 16,50,000 combined earnings divided by total number of shares after merger, which is 4 lakhs. So we will get 4.125. Here 0.125 is increased. Now we will see what is the impact of shareholders of X Limited and shareholders of Y Limited. Now here merger is taken place related to EPS of two companies. Therefore, both companies maintain EPS. There is no impact. If you take the exchange ratio is based on EPS, then there is no change over here. Before and after, they are having same EPS. Acquirer point of view. Acquirer point of view, before merger also 4, after merger also 4. But here acquirer point of view, when you have taken the ratio as 0.5 is to 1, 0.5 is to 1. So before merger they are having 4, after merger they are having 4.125, 0.125 increased. So here you can see EPS before merger is 4, EPS after merger is 4.125, increase in EPS 0.125. Now, impact of shareholders of company Y. This is very, very important. Most of the students are making the mistake over here. While you are comparing here, EPS before merger, how much, Nana? EPS before merger target company is 2.25. Now, here we need to consider not post merger EPS. We have to check out equivalent EPS after merger. Sir, why we have to consider equivalent EPS for target company? Because target company before they are having different number of shares and after they are having different number of shares. So before merger company is having how many shares? 2 lakhs. After merger we are giving only 1,12,500. In post merger EPS they will get a share of 1,12,500 but not in pre-merger. Pre-merger they are having 2 lakhs. So that we have to calculate equivalent EPS. After merger equivalent EPS, simple Nana, equivalent EPS whenever they have asked, simply post merger EPS into exchange ratio. Post merger EPS into exchange ratio. What is post merger EPS? We got 4.125 into 0.5 exchange ratio here. So we will get 2.0625 and difference between them you can check. Before they are having 2.25, after that they are having how much? 2.0625. 2.0625. Full EPS we should not consider, only by taking the exchange ratio. Why? Because we have taken the shares over here for target company. Previously they are having 2 lakh shares, but now they are having only 1,12,500 shares. So that is it clear? We are having only 1,12,500 shares. So here equivalent EPS will be 2.0625. So impact whether increases or decreases, it is decreased in EPS 0.1825. Okay, so this is very important. Once you check equivalent EPS formula, post merger EPS into exchange ratio. Simple. Okay, anywhere you can see equivalent EPS, you have to consider the same. So problem number 7. Through problems only need to understand the concept. Okay, you can check on, because in mergers and acquisition they can ask you the questions like anything. So they will include the concept in the question itself. They can ask you like anything. So here and there. So based on the interchanging of formulas, you have to make the answers. What the output they are asking, we have to provide. The following information is provided in relation to acquiring Mark Limited and the target is Maverick Limited. So Mark Limited wants to acquire Maverick Limited. Mark Limited wants to acquire Maverick Limited. Earnings they have given, number of outstanding shares they have given, PE ratio they have given, and by seeing that you need to understand. So here PE ratio given, EPS not directly given but indirectly given. No? So earnings divided by number of equity shares, we will get EPS. If you know EPS, if you know PE ratio, MPS easily we can calculate. Okay, so that is the relation of EPS, MPS and PE ratio. PE ratio is nothing but MPS by EPS. If you want to get MPS, PE ratio into EPS. EPS easily we will calculate. Earnings by number of equity shares. So they are asking here, you require to calculate what is the swap ratio based on current market price. Based on current market price, swap ratio formula. Swap ratio is nothing but exchange ratio. What is based on market price? MPS of target divided by MPS of acquirer. MPS of target and MPS of acquirer not given. We need to find out what is MPS of Maverick Limited and what is MPS of Mark Limited. For that, we can use this formula. MPS is equal to PE ratio into EPS. So, for that, first you need to find out EPS. Earnings given, number of shares given, PE ratio given. EPS we can find it or not. Yes, EPS is nothing but earnings divided by, so for example, this is A, this is B, EPS is nothing but A by B. Earnings divided by number of equity shares, 10, 4. Now, market price, MPS is equal to PE ratio into EPS. PE ratio into EPS. PE ratio already given 10 into 10, which is 100 market price. Here 5 into 4, which is 20 market price. Now, MPS of target is 20, MPS of acquirer is 100. So, what is the exchange ratio based on market price? MPS of Maverick Limited divided by MPS of Mark Limited, which is 20 by 100, which is 0.2, which is nothing but for every one share in Maverick Limited, Mark Limited have to give you 0.2 shares. So, here we need to calculate post-merger EPS. Now, post-merger EPS, how can we calculate? Combined earnings divided by total number of shares after merger. So, how many number of shares you can issue, Nana? You tell me here, how many number of shares does Maverick Limited is having? 10 lakhs. 10 lakhs into 0.2. 10 lakhs into 0.2, which is nothing but here 2 lakh shares we have to give. Okay. So, already 20 lakh shares we are having. Now, 2 lakhs we are issuing. Total 22 lakhs shares we are issuing. And coming to what is combined earnings? 200 for Mark Limited, 40 lakhs for Maverick Limited. 240 lakhs divided by 22 lakhs, which is post-merger EPS is 10.0. So, 91. 10.91. That is post-merger EPS. What is the next thing they are asking? EPS completed after acquisition. Next. What is the expected market price per share Mark Limited after acquisition, assuming that PE ratio of Mark Limited is remains unchanged? PE ratio before and after is same. Then they are asking what is the market price per share of Mark Limited after acquisition. After acquisition means we are having what? New EPS. What is new EPS, Nana? 10.91. Nana, PE ratio formula same, MPS by EPS. Now, we want to find out MPS is equal to EPS into PE ratio. We want post-merger MPS. Therefore, post-EPS into post-PE ratio. Post-PE ratio and pre-PE ratio is one and the same. As per the question, PE ratio is unchanged. And before and after, the same PE ratio we are maintaining. Now, but post-EPS we got changed, it is 10.91. So, it will be 10.91 into same PE ratio before and after. So, it is 10. So, total 109.10 will be the post-merger market price when PE ratio is same. And fourth one, they are asking what is the market value of merged firm? Simple. Market value of merged firm, how do you get? Total number of shares outstanding into market price. Total how many number of shares outstanding here? Initially 20 lakhs and now freshly issued 2 lakhs. Total 22 lakhs into market price per share, how much? New MPS, which is 109.10. So, this is the total market capital. Market capital, how do you get, Nana? Market capital, total number of shares into what is the market price per share in the market. So, what is MPS? Which is new MPS, which is 109.20. So, we are having 2400.2 lakhs, which is at present market value. So, lastly, they are asking gain or loss to the shareholders. Determine market value of merged firm completed. Gain or loss for the shareholders of two independent company after acquisition, they are asking. It should be very clear in this question. Gain or loss for the shareholders. Let us see. Number of shares after acquisition. Okay. Mark Limited, how many? 20 lakhs. Maverick, after acquisition, we are giving only 2 lakhs. And MPS after acquisition, the same without changing anything. What is total market value? Which is 2182 lakhs for Mark Limited, 218.2 lakhs for Maverick Limited. So, 20 lakhs into MPS, 2 lakhs into MPS. Now, we'll say existing market value before merger. What is the market value? At present, they are having that. How many number of shares they are having here? MPS we have found, no. Yeah, 100. 20 lakhs, see here. Existing market value how much? Before, that means existing means before acquisition, 20 lakhs the shares and MPS is 100. Okay, which is 2000 lakhs, and we are having 10 lakhs into 20, which is 200 lakhs. So here we are having existing is 2000 lakhs and 200 lakhs, 2000 and 200. Now take the difference. What is market value of the company before acquisition minus what is the market value of the company after acquisition minus what is market value of the company before acquisition? Simple, Nana. Post merger market value minus pre merger market value. So before merger 2000 lakhs is their market capital, but after merger their capital is increased to 2182 point, we can say 2182 lakhs. So which is nothing but how much increased? 182 lakhs increased. And coming to here, it is gain. It is a gain to shareholders. And coming to that, Maverick Limited before merger, their market value is 218 point. After merger, their market value is 218.2 lakhs. But before merger, they are having only 200. From 200 lakhs, their market value is hiked here up to 218.2 lakhs. So 18.2 lakhs is gain. So total gain is 182 plus 18.2 lakhs, total 200.2 lakhs is a gain to shareholders. So how much it got increased? Gain or loss, we need to find like that. In simple way, we can say gain or loss, how can we find? Pre-merger and post-merger difference. Post-merger market value minus pre-merger market value. So both the shareholders are getting gained by acquisition. So once you go through it, and we are having here 8th problem. So the following information is provided relating to acquiring from Sun Limited and the target company here Moon Limited. So Sun Limited is the acquirer and target company is Moon Limited. So profits after tax, which is nothing but earnings they have given, number of shares outstanding they have given, PE ratio they have given. So they're asking what is swap ratio based on current market price? The same thing, Nana. So we want to know swap ratio based on current market price means MPS of target divided by MPS of acquirer. So MPS of Moon Limited divided by MPS of Sun Limited. How do you get MPS? PE ratio we have and EPS we can find by these steps. So we can find out what is MPS. First you find out MPS here. So Sun Limited and Moon Limited we are having. So here we are having what is the earnings? 2000 lakhs, and here number of shares outstanding is 200 lakhs. So here we can say it is 10 and here we are having it is 4. So already we know EPS and PE ratio, we can find out MPS. So here PE ratio formula MPS by EPS. We want MPS based on this. So PE ratio into, we can say EPS. EPS is multiplied with PE ratio. So 10 into 10, we are having MPS is 100, 4 into 5, MPS is 20. Now, target company MPS we know, acquirer company MPS we know. Exchange ratio we can find it or not. So 20 by 100, which is nothing but 1 by 5. For every 5 shares in Moon Limited, we have to give 1 share. So how many number of shares they are having here? Total 1000 lakhs. We can say 1000 lakh shares they are having. For every 5 shares, we have to give 1 share. So how many number of shares we have to give to the target company? So that let us see. So check out here. We are having MPS over here 20 by, for every 5 shares, we are giving 1 shares. So here, how many number of shares they are having on a total? 1000 lakhs. So here, number of shares to be issued. Sun Limited have to issue to Moon Limited number of shares 2000. Sorry, here we are having 1000 lakhs into 1 by 5. For every 5 shares, we have to give 1 share. So total 200 lakh shares we are giving. So here, this is the first one they are asking about the exchange ratio. So second one we are having here. What is the EPS of Sun Limited after acquisition? Now, EPS of Sun Limited after acquisition. After acquisition means post-merger EPS. What is the formula for post-merger EPS? Combined earnings divided by number of shares after merger. Number of shares outstanding after merger, you tell me. Initially, Sun Limited having 200 lakh shares, and at present we are issuing to the target 200 lakh shares. Total 400 lakh shares is number of shares after merger. So combined earnings 2000 plus 4000. We are having total profits after tax after acquisition, which is 6000 lakhs. So here we are having that combined earnings is 6000 divided by combined number of shares is 400 number of shares. So how much you will get over here? Near about 15 per share. Post merger EPS is 15 per share. So what they are asking next, that is post merger EPS. What is the expected market price per share of Sun Limited after acquisition, assuming that PE ratio of Sun Limited is adversely affected by 10%? And previously we have seen one question, PE ratio remains constant before and after, but here PE ratio is adversely affected by 10%. PE ratio of Sun Limited is 10. It is adversely affected by 10%, means 10 minus 10%, which is how much? 9. So here we are having that. So if 9 is the PE ratio of Sun Limited, what is the current expected market price? Based on that market price, how much? So we can know that PE ratio formula, MPS by EPS. We want MPS. Therefore, PE ratio into EPS. Okay. If PE ratio is adversely affected, previously 10, now 10 minus 10%, which is 9. And EPS, post merger EPS, just before we have found that how much it is? 15. So total MPS, if PE ratio is adversely affected by 10%, then MPS will be how much? 9 into 15, which is 135. So that is the MPS here. And determine the market value of merged firm. So what is the market value of merged firm? We know that it is 135. What is the market value? So merged firm having market value of merged firm. Merged firm having total how many shares? 200 original plus 200 freshly issued, total 400 lakh shares. Number of shares into market value, in order to get, we want to multiply with MPS, which is 135. So 135 into 400, which is 54,000 lakhs. This is the market value of merged firm. And lastly, they are asking what is gain or loss of shareholders of two independent companies after acquisition. So gain or loss, how can we find, Nana? So gain or loss, how can we find pre-merger and post-merger things? So before merger, what is the market value, and after merger, what is the market value? This is very important for both the company shareholders. They are asking, two independent companies. So what is the market value before and after? Okay. So post merger market value we know 54,000. Before merger, what is the market value? Before merger means we are having two independent companies. We are having here Sun Limited before merger and Moon Limited before merger. So what is the market values here? We can consider, one second now. So post merger, we can say post merger market value minus pre merger market value. Pre merger market value of, we can take Sun Limited plus pre merger market value of Moon Limited, both. So we have to consider post merger market value, already in the previous step we have found. So what is that? 54,000 lakhs. What is pre merger market value? You can consider that before that we got pre merger market value. MPS we already found, Nana. So MPS we already found. How much we got? Before that we are having, what is the MPS values? 100 and 20, right? So you can consider here 200 lakhs into 100. This is for Sun Limited. 200 lakhs into 100 plus For Moon Limited, 1000 lakhs into 20. So which will be 20,000 plus 20,000 is 40,000. So 54,000 lakhs minus 40,000 lakhs, which is 14,000 lakhs. So where you're having post-merger is more than the pre-merger. So therefore, 14,000 lakhs is a gain. So what is a gain or loss? We have to find out in this scenario. So post-merger market value minus pre-merger market value. If it is positive, gain. If it is loss, we can say we will get the negative value. It is a loss. And ninth one we can see. Acquirer Limited proposing to acquire a Target Limited. Expected post-merger combined profit they have given. Pre-merger profit of acquirer separately given. Standalone number of shares of acquirer. Standalone means their own shares. Okay, so before giving number of shares to Target, what is the number of shares? They're already having 200. So we have here, we're having the 200. And new shares to be issued is 50. Not in rupees. Here 2200 shares and 50 shares, total 250 shares, not in rupees. So here tax rate they have given 25%. So combined EPS they're asking. Combined EPS is nothing but combined profit by combined number of shares. So combined profit is 2000, combined number of shares 250. So post merger EPS straightly we will get 8. Everything they have given straightly in the question. Now they are asking calculation of accretion and dilution. Sir, what is accretion and dilution? So accretion and dilution, which is nothing but comparative to pre-merger. If post-merger your value is getting better, we can call it as our share value is accreted. If it is decreases, we can call it as diluted. So how can we calculate this? Based on EPS, based on MPS, post-merger comparing with pre-merger. If it is better, the value is accreted. If it is worst, we can say the value is dilutive. So accretion or dilution, we can calculate in percentage or we can calculate in times. So if you calculate in percentage, we need to know what is post-merger value minus pre-merger value divided by pre-merger value into 100. If you want it to get in percentage, we are getting like this. Okay. In times, if you want the post-merger value divided by pre-merger value, we will get in times. So either accretion and dilution percentage we can calculate or in times we can calculate. So here we can see standalone pre-merger EPS, accretion and dilution. So already combined values we know. Standalone pre-merger EPS. So how can we get this pre-merger EPS? So what are the details they have given here? Pre-merger profit we know, which is 1200, and the number of shares standalone we having 200. So 1200 by 200. So which is 600. 1200 by 200, which is 600. Total pre-merger EPS is 600. Now, post-merger EPS is how much? Sorry, here 6. Pre-merger EPS is 6. Post-merger EPS is 8. Now, before merger EPS is 6. After merger 8. Definitely it is accretive, increased. So, how much is increased? So, if you take it on times here, so 2 rupees is increased. In rupees, if you want, 2 rupees is increased. So, in percentage, if you want, you can check what is pre-merger, Nana? 6 rupees. Now, it is increased to how much, Nana? 8 rupees. So, 6 rupees value increased to 8 rupees. How much percentage it is increased? Simply, we can say post-merger is 8 minus pre-merger is 6 divided by pre-merger into 100, which is 2 by 6 into 100, which is 33.33% accretive. It is accretion percentage. Like that, if it is decreases, you can find out the dilutive percentage also. And one more question we are having here. So problem number 10, Mohit Company Limited is studying the possible acquisition of Neeraj Company. So they want to check over whether they can acquire the Neeraj Company Limited or not by the way of merger. Earnings after tax. So they have given number of equity shares also they have given, and market value per share also they have given. So MPS they have given, earnings, and we can know easily EPS. If market, if so, you can say if the merger goes through exchange of equity shares, the exchange ratio is based on current market price. So current market price is the exchange ratio, MPS of target divided by MPS of acquirer. Then what is new earnings per share? Post-merger EPS they are asking. Sir, MPS already we are having 160 by 200. So we can calculate new EPS. So here number of shares to be issued. How many shares target company is having, Nana? 4 lakh. For 4 lakh shares, how many shares we have to give based on exchange ratio on MPS? 4 lakh shares into MPS of target divided by MPS of acquirer. Total 3 lakh 20,000 shares we have to issue. For their 4 lakh shares, we are giving 3 lakh 20,000 shares. So already our existing shares is 16 lakhs and we are issuing new shares 3 lakh 20,000. Total number of shares after acquisition is 19 lakhs 20,000. 19 lakhs 20,000 is the total number of shares after acquisition. So now what is the combined earnings? So here 8 lakhs plus 24 total 1 crore 4 lakhs we are having earnings clearly given 80 lakhs plus 24 lakhs which is 1 crore 4 lakhs. Combined earnings we know and total number of shares after merger we know. Post merger EPS will be 5.42. Combined earnings divided by total number of shares after merger. Second point, they're asking that Neeraj Company Limited wants to be sure that earnings available to equity shareholders will not be diminished by the merger. They don't want to decrease their earnings. Then what should be the exchange ratio in that case? If they don't want to dilute their earnings, target company shareholders, they don't want to dilute the earnings, which means before merger, how much earnings they're having. After that also, they have to get the same earnings. They're expecting the same earnings. In such a case, exchange ratio will be taken based on EPS, not MPS. So EPS of target divided by EPS of acquirer. So we can check out here. Calculation of exchange ratio will not diminishing the earnings. It is not EPS, earnings of Neeraj Company Limited after merger. So current EPS, how much they are having? So Mohit Limited total 80,000 by, so we can calculate what is EPS present and Neeraj Limited EPS. So exchange ratio is based on EPS. Neeraj Limited divided by acquirer company. So EPS not directly given in the question, earnings divided by number of shares. So Mohit Limited earnings divided by Mohit company number of shares. Neeraj company earnings divided by Neeraj company number of shares. We get total EPS before merger. EPS of target is 6 and EPS of acquirer is 5, 6 by 5 which is 1.2. For every 1 share in Neeraj Limited, now here Mohit Limited have to give 1.2 shares. So how many number of shares? They are having 4 lakhs. For 4 lakh shares, we are giving 4 lakh 80,000 shares. Already 16 lakh shares they are having. And at present 4 lakh 80,000 they are issuing. Total 20 lakhs 80,000 is the number of shares after merger. And you can check what is the earnings after merger? Same 104 lakhs. Okay, 80 plus 24. And divided by 20 lakhs 80,000 equity shares. So post merger EPS is 5. Post merger EPS is 5. Now you can check the total earnings. 4 lakh 80,000 shares we are giving. Each share is 5 rupees post merger, which is 24 lakhs. Before merger also their earnings is how much, Nana? 24 lakhs. So earnings is not at diluted. If you take the EPS is based on, exchange ratio is based on EPS. So that's all about here, and we're having some more questions. So problem number 11, let us see. Aruna Limited has signed a task of estimating the fair acquisition price for Money Limited. So for Money Limited, we want to find out what is the acquisition price. I want to acquire Money Limited. What is the price of acquisition? I want to find out. She decides to use the comparable company analysis to determine the fair acquisition price and gathers the following information of 3 comparable companies. Similar to Money Limited, if Money Limited is a textile business, similar companies like textile, similar companies we have taken into consideration for comparison purpose. Okay, similar to Money Limited, 3 companies I have taken, company A, B, C. Now, Aruna company, here, Aruna has assigned a task for the fair acquisition price for Money Limited. So acquirer company name not given. So Aruna is a person, we assigned her and to find out what is the acquisition price of Money Limited. So Money Limited, if I want to acquire, what is the price? Similar to Money Limited, 3 companies data I had. MPS given, EPS given. And she has also gathered the following information relating to recent acquisition of companies. So other than ABC, they know recent acquisition has happened, company P, Q and R. So comparative to P Limited, Q Limited and R Limited, their market price is 92.5, but they purchased it for 117, deal price. Recent acquisition, similar company recent acquisition details we had. So based on this, we can calculate what is acquisition premium. So they're asking here expected EPS of Money Limited is 15. So EPS of Money Limited is 15 and expected deal price that should be offered for acquisition, that we need to find out. So here we have to calculate that. So first of all, we'll check MPS is there, EPS is there. Immediately we can find out PE ratio. So PE ratio is nothing but MPS by EPS, 16.55 for company A, company B, company C. So three companies having three different PE ratios. I will take the average and the same average I will apply to my company. Average PE ratio I got 16. Accordingly, intrinsic value of money should be calculated based on PE multiple, which is nothing but we want to calculate what is the intrinsic price, which is nothing but MPS. So expected EPS how much, Nana? Already 15 we had, into normal PE ratio we don't know. So average PE ratio of comparable companies I am applying to my company, which is 16. So 15 into 16, here we are having the 240 point is 240. So 240 is the intrinsic price. So that means the market price of the company here is 240 based on expectation. So let us see here. It's not 240.6, it is 240. So acquisition premium we need to calculate. So now how much percentage of premium I have to give? So this is the 240 is the market price. Exactly 240 if I give, no problem, no acquisition. Here we are having that premium also. The average acquisition premium is calculated based on recent comparable transaction. Company PQR is there. Their market price is 92, but deal price is 117. That means a recent acquisition, someone purchased company P. Company P market value is 92.5, but they purchased it for 117. How much percentage of premium they have given? So take the difference. The difference divided by 92. I told you, no, we can say that deal price minus MPS by MPS into 100. Deal price is 117 minus 92.45 is MPS divided by 92.45 into 100. So acquisition premium 26.6% in company P transaction. Likewise for Q transaction and R transaction, we got the premium. One is 18.9, one is 29.5. See here, one is 26.6, one is 18.9, one is 29.5%. So I will take the average here. So average is 25%. So that I can apply 25% here in order to know what is the deal price. So intrinsic price is nothing but market price. How much I got? 240 plus 25% premium. Average premium I am applying. So based on comparable companies, I have calculated deal price of the company. So such kind of questions also they can ask you. So they will ask you to find out for how much price I can purchase this company. They will give you comparable data. Based on comparison of similar companies data, first you need to find out based on average PE, we are finding the intrinsic price or market price of Money Limited. And based on intrinsic, we can say that premium, acquisition premium average, we are finding what is the premium we have to pay to acquire this company. So 240 plus 25%, which is nothing but here 240 plus 60, which is nothing but 300 is the deal price. 240 is the market price I have to give. Extra 60 why I have to give to acquire? It is a premium I am paying to purchase that particular company. Why, sir, we are paying premium? The same company, they can purchase, they can sell their shares outside market also, they will get 240. Definitely they will expect higher price in order to sell their securities. So 60 extra we are paying to acquire the company. So such kind of questions. Sometimes they will ask you to find out what is the deal price. So we have to solve like this. And we are having here one more question. And one more comparison. So two more questions we are having in mergers and acquisition. Very important models. All we have covered here. Problem number 12. ABC Limited run and managed by an efficient team that insists reinvesting of 60% of its earnings in the projects to provide return on equity of 10%. So whatever the profits they are having, they want to reinvest 60%. If they reinvest 60%, in that 60%, we will get 10% return on equity. Despite the fact the firm's capitalization rate is 15%. The firm's capitalization rate So total capitalization rate is 15%. The firm's current year earnings is 10 rupees per share. So current year EPS how much? 10 rupees. That means in this 10 rupees, if you retain 60%, reinvest 60% is 6 rupees. Remaining 4 rupees I can give as a dividend. 6 rupees if I reinvest, I will get on this return 15%. By holding this capital, my cost is how much? 15%. Are you getting my point? So 15% is the cost, whatever I am paying. So return how much I am getting? 10%. Let us see. What is the dividend growth? So dividend growth is nothing but here. Return on equity into B. B is nothing but here, retention premium. So 1 minus payout ratio. Out of 10, 4 I am paying out as a dividend. The balance is 6, which is retention 60%. So out of 10%, 60%, which is nothing but 6%, I am having the growth. The growth you will get only when you retain the money in the company. Okay, if you distribute whatever the profit you are getting, how the company will grow? The company will grow based on reinvestment. When you are making reinvestment, how much return on equity we are having here? 10%, which is 6%. Now, what is the stock price? So we can calculate here. Already we know the things are present value of growth opportunity. At what is the stock price of ABC Limited wants to sell? If they want to sell, what is the price? And what is the present value of growth opportunities? Why would such firm will be considered as takeover target? If I want to purchase such company based on PVGO, okay, so we can consider whether it is a takeover target or not. So what is these things? So present value of growth opportunities, which is nothing but, so what is the growth? With the growth and without growth, we have to be considered. What is the present value of the company? What is the present market price of the company with the growth and without growth? So based on that, we will compare whether we have to take over that firm or not. Okay. So here whatever the retention that you are having, 60%. So what is the stock price that we have to make it? General formula we know, Nana. Cost of equity. So we are having here D1 by P naught. Okay, when growth is there plus G. So here, when we are finding what is the market price we want, so P naught is equal to D1 by KE minus G. So G will go that side and P naught will go here and KE minus G will come here. So D1 by KE minus G. So cost of equity we are having here 15% and growth rate is how much, Nana? 6%. So here what is D1 here? So which is dividend. So out of 10 rupees, how much you are giving as dividend? 10 rupees into 40% only. So 4 is the dividend I am giving. Divided by KE, which is cost of equity is 15%, my cost. Minus growth, how much I am having? 6%. So here 0.06 is the growth. Okay. In simple, we can say 4 by 15% minus 6%. Sir, why we have to deduct this? Because the cost will be recovered when we are having the retention premium. When you are making the retention of the money, so automatically the expected cost will get reduced. So here 15 minus 6%, which is 9%. 4 by 9% is 44.44 rupees P naught value. So which is price is how much? 44.44. The present value of growth opportunity is nothing but market price per share minus no growth value per share, with growth minus no growth. So if it is no growth, how can we calculate this? If there is no growth, so D1 by, so D1 will be how much here? So if there is no growth, entire we have given as a payout ratio. So 10 rupees there is no retention. If retention is there, growth is there. If there is no growth, entire 10 rupees I can distribute as dividend. 100% payout ratio. When it is of 100% payout ratio, my dividend entirely I am giving 10 divided by K is how much, Nana? 15%. So which is 66.66%. So with growth minus without growth, what is the market price? With growth minus without growth. Now tell me which one is better? Without growth, your market price is 66 point. That means entire 10 rupees you give as dividend, your market price is 66.66. Sir, 4 rupees only you are giving dividend, 6 rupees you are retaining. On that, how much percentage of return you are getting? 10%. But you are paying cost how much? 15%. Which is loss or not? Okay, you are holding the money. For that, you are paying 15% cost to outside, but you are getting only return 10%. You are losing the money or not? So here we are having that Okay, so which one is better decision? 100% payout is better decision. If I give 100% payout of my profits, then my market price is 66.66. If I hold 6 rupees from 10 rupees, 60% of returns on return earnings, so my market price is 44.44. Now based on that, you tell me which one is better, distribution of dividend or holding of return earnings. So general point of view, distribution of dividend is better. Now such company is there. Now what is present value of growth opportunities? We got negative PVGO is there. Okay, now whether you have to take over that company or not, that is the thing. Yes, it is a takeover target. You can take over that company, change the decision. Once after taken over the company, now previously the company's policy is that 60% retention. Now you make it 100% payout. Then here we can say reasons for takeover target of negative PVGO indicates that net present value of the firm's projects are negative. So why? Because whatever the money they are keeping, they are putting in the negative projects. They are getting less returns. The rate of return on assets is less than the opportunity cost of capital. 10% I am getting return, but how much cost I am incurring? 15%. 10 rupees I am incoming as a return, 15 rupees I am paying as a cost. It is negative. Such a firm would be subjected to takeover target because another firm could buy the firm on the market price of 44 rupees. So we can, for 44 rupees only, we will purchase that company and increase the value by changing the investment policy. Okay, so here now I will check what is the market price of the company. Based on this decision, market price is 44 per share, 44.44. I will purchase that company. Just I will make a change of investment decision. Instead of retaining 100%, I will give payout ratio. Immediately my share price will be go to 66. 44 rupees I purchased a company, just changing the investment decision, it will become 66. I can sell it. So here, for example, if new management is simply paid out all the earnings as dividend, the value of the company will be increased up to, with no growth, of 66.66 rupees. Easily we can maintain this. Okay. And we have only one problem left over here. So problem number 13 here. XY Limited is a retail florist. Is a sale and asking price of 62 lakhs. Now he wants to sell his company. Okay, he's a retail florist and asking price is 62 lakhs. Now you have been contacted a potential buyer who is asking you to give him opinion to whether the asking price is reasonable or not. Now you want to know, so I got one offer. So one retail florist wants to sell his company for 62 lakhs. Whether this 62 lakhs is a proper thing or not, or we can say it's a proper asking price or not. We are asking. The potential buyer has only limited information and XY Limited, about XY Limited. He don't have full information of XY Limited, and potential buyer so does not know the annual gross sales of XY Limited. They don't know the sales is about 82 lakhs. And also last year tax return reported an annual profit they are having, which is 8,40,000 profit before tax. Now we have collected the following information, financial details of several florists, so which were up to sale in the past. A recent sale transaction we have considered. Now total I have considered similar firms, 38 firms. 38 firms, and for PS ratio I consider. Now I want to go for any comparison multiple. Price to sales ratio, price to earnings ratio. Which one is best one? If company sales were good, price to sales ratio I will go. Earnings were good, price to earnings ratio I will take. So mean ratio they have given. And we can say that, you can see here. What are the top 10 players descending in PS ratio and PE multiple? So here we are having that. PS ratio, top 10 florists, okay, so we have taken into consideration. What is the PS ratio of their companies? So top 10 we are having here, highest to lowest. PE multiple also highest to lowest. Now which one I have to take? PS ratio I have to take the beta or PE ratio I have to take the beta? Simple, Nano. You know what is the profits before tax? P by S, P by E. If you know this value, automatically you know the price when you multiply sales with PS multiple or earnings with PE multiple. Now we will take average of PE multiple or PS multiple, but before that which one is correct? P by S is correct, P by E is correct. Price to sale ratio have to consider, or price to earnings ratio have to consider. So for that they have given the mean ratio they have given. So that average mean ratio is 0.55 and 3.29. Quotient of variation. This is most important thing in this step, which is 0.65. This is 1.52. Quotient of variation means how much it is dispersed. Dispersion. We can say that wherever you're having lowest coefficient of variation, the variation is very less. So here variation is very high. That means when I compared with the price to sales ratio, the variation is very less. Okay, so here that means the price and sales are consistent. One time I'm getting more sales, one time I'm getting less sales, not like that. Okay, so when we compare to price to earnings, the variation is more. Variation is more means every time I'm not getting same earnings. One time I'm getting we can say more earnings, next time I'm getting very low earnings. So like that we are having the variation. Where we are having less variation, that is the best possible estimate. So less variation where I'm having 0.65. That means where the sales and price are consistent. Every time the sales will not fall, every time will not hike at a time. So the variation is low in PS multiple, then PS multiple is the best choice. So leave it PE ratio, only PS ratio we can consider, and which one we have to be considered over here. So now for which company, for XY Limited I want to calculate. PS ratio is the best possible metric as far as I know at present. So I will calculate what is PS ratio for my company, XY Limited. So price by sales. Price how much they are asking? 62 lakhs. And sales how much, Nana? Sales, gross sales about 82 lakhs. 62 lakhs divided by 82 lakhs. So we can consider here 0.76. PS is 0.76. Now I will consider where it is matching 0.76 in PS multiple. Check out, this is 2.35, this is 0.68. Where it is covered here, 0.76 will be fall under 8 and 9. 0.7 to 0.85. Then take the PS ratio based on these things, 0.85 and 0.72. So take the average for this. It fall under here 0.75, 85, sorry, 0.85 plus 0.72 average I have taken. PS multiple is 0.785 we will get. Now I want price. Price is nothing but sales into 0.785. Sales how much I am having? 82 lakhs into 0.785, which is almost equal to 64 lakhs 37,000. 64 lakhs 37,000. So based on PS multiple, I came to know the best price is 64 lakh 37,000. But he is asking only 62 lakhs. Whether the asking price is in line or not? Yes. So we have to make it. We have to assume that the asking price is the best price, not an issue. We can take the decision that. So the buyer will believe that XY Limited is the superior retail florist market. The asking price is 62 lakhs, which is appear as a reasonable price. So however, the buyer should make sure that whatever the reflect, that means if they presented, you have to check out whether the true and fair or not. So based on that statements, how you know this 82 lakhs? They have presented in the statements. If they presented wrong, then this is not the correct price. So we are assuming that they are providing the information on true and fair basis. Therefore, whatever the price they are asking about 62 lakhs, which is a fair price. Okay. So what are the things you need to remember under this scenario? If you have two multiples and having confusion in that, you need to check where you are having less variation. Where you are having less variation, that is the best guiding factor for us. I am having less variation in PS multiple, I consider PS multiple as the base. Okay. Sir, if I have less variation in PE multiple, then you can take PE multiple as the base. Price 62 lakhs and earnings 84, 8 lakh 40,000. P by E. Now compare with PE multiple where it is matches and take the average and apply to find out what is the price and compare with 62 lakhs, which is near to 62 lakhs. We can say it is a reasonable price. Okay. So that's all about mergers and acquisitions. So let us see. So our next topic, we are going to discuss methods and approaches in business valuation. So how to value the business over here by using some methods and approaches. So here we are having majorly there are three valuation approaches. So market approach or income approach and cost approach. For example, for any kind of asset valuation or any kind of business valuation, whatever it kind. So for example, how can we value based on this usage of market approach, income approach and cost approaches. So here we are taking into, for example, as an asset. So if the asset I'm using from 6 years, the cost of asset is 10 lakhs. So after 6 years, I'm using this asset having depreciation of 1 lakh each year, 6 lakhs gone. Now the asset value is 4 lakhs. Now the same asset value in the market, what is the cost? So I have to compare with the market basis and finding what is the value of my particular asset. Such kind of valuation we can call it as market approach. For example, if you purchased a car 5 years back, now at present what is the value of your car means by using that the market of second hand cars. So same 5 years old car, same model and similar specification, what is the value in the market? The same value you can attribute to your attributable to your asset also. So like that we are finding what is the market value of an asset. Or for example, have a building. Now what is the value of this building? I want to know. So first, how much income this building can generate? For example, this building I can give as a rental. So this building when I am giving as on rental, so I am expecting that how much income this building can generate from the next 5 years. For example, I am expecting the useful life of the building is 5 years. Next 5 years, how much income this building will generate? All that income I will calculate to the present value. So here we are calculating based on income approach. Whatever the income it is generated, accordingly we will calculate, and we are having that market approach is based on the same market price of that particular building. Okay, so I will take it one example for all the three cases. So let us check. So I'm having a building. So under cost approach, if I want to value, so 3 years already completed. After construction of the building, 3 years completed. Now similar locality, so nearby premises, I will check in the market the same 2-story building I'm having. The 2-story building, how much is the value in that particular area? So the same building, how much is the value in the market? Same value I can use for the valuation of my particular building. Or second approach, we're having income approach. So this building, how much income it can generate based on rental. If I give it for rental in that particular area, so how much rent I will get? So I will estimate the rent for this particular building for how many number of years I'm expecting the rent. So here I will calculate what is the income this building will generate, the future income. I will calculate the present value of that future cash flows based on income approach. So based on income also you can calculate the value of the building. And based on cost approach is nothing but a replacement cost approach. So the 3 years old building at present, the same building if I want to construct right now, after charging 3 years depreciation, what is the value at present? That we can take it as cost approach. So total 3 approaches that we are having. In that 3 approaches, we are having different valuation methods. One of the valuation method we are having here, discounted cash flows method. So discounted cash flows means first I will calculate what is the cash flow generated by this particular asset or business in the future. So here I am expecting X Limited is my business. I am expecting next 10 years it will generate some cash flows. I will estimate this cash flows. I will calculate the present value based on a discounted factor. I will calculate the present value. Now that value is the value of X Limited. Likewise, we are having earnings capitalization method. So instead of following, we can say cash flows, I will take earnings. How much earnings earned by the company? So profit after tax. Okay. So how much earnings earned by the company based on capitalization rate, I can calculate the value. This is called valuation method under earnings capitalization. One by one we will see. And market price method already we have discussed. Like comparable companies multiple method or relative values multiple method. So based on comparable companies, similar companies, already we have done one question in mergers and acquisition. So based on PS multiple, based on PE multiple, based on EV to EBITDA multiple. So we will take we will take some other organization. If more than one company, if you take it as a comparable companies, take that average PS ratio or average PE ratio or average EV by EBITDA multiple or ratios, the same ratios which is applicable for our company, and finding the value. So that we can call it as comparable companies multiples or relative value method. And next one, we're having comparable transaction method. Sir, what is comparable transaction? The same in mergers and acquisition we have seen. Recent acquisitions, what happened? So that acquisition premium question that we have seen. So recent mergers and acquisition of similar nature of the company. So anything is happened, the same will be applicable for the company also. That we can call it as comparable transaction method. And net asset valuation method, based on net assets, not incomes this time, not cash flows, not based on the market. What is the asset valuation in my particular company? Net assets. Net assets is nothing but assets minus outside liabilities. I will consider what is the fair value of the assets and fair value of outside liabilities. I will take the difference. Assets minus outside liabilities, I will get the value. And I will calculate also the value based on economic value added. Economic value added is nothing but how much economic profit is earned by the company. This we will discuss when we are doing the problems. And market value added is a continuity of here economic value added. So in this first method, we are having discounted cash flows method. So first we have to estimate the future cash flows and we have to calculate the present value. So for example, so here I am taking, it depends upon the cash flows, free cash flows of the firm we are having, free cash flows of equity we are having, that we will discuss later. So let us check here how to calculate this cash flows. So first of all, arriving the future cash flows or forecasting the future cash flows, and we will determine what is the discounted rate based on cost of capital. So how much is the cost of capital, that will be considered as a discounted rate, and we'll find out the terminal value of an enterprise. Sir, what is terminal value here? So for example, my company is earning 100 lakhs this year and 120 lakhs is an estimation for second year, 150 lakhs for third year, 160 lakhs for fourth year, and from the fifth year onwards I am having the same 160, 160, 160 like that till infinite. So till infinite period, I am earning the same number of cash, same amount of cash flows. In that case, so up to here we will calculate the value, and for the fourth year we will calculate the terminal value. So terminal value is nothing but perpetual cash flows the company can generate from which moment. For that we can calculate the terminal value. And terminal value also we have to discount it to the present value. So first year ending 100. So what is the present value? Second year ending 120. What is the present value? Third year 150. What is the present value? And after finding the terminal value, present value of terminal value also we are finding. That is what here. Find out the terminal value of enterprise. Then find out the present values of both the free cash flows and the terminal value to interpretation of the results. Then after adding all these things, we will get what is the value of the business. Okay, so here free cash flows are of two kinds we are having. Free cash flows of firm, free cash flows of equity. So what is the difference we will see later. And types of cash flows. For example, I am company having only one cash flows. I am expecting seventh year I will get this much amount. No other cash flows I am expecting. In that case, straight away present value factor for seventh year I will consider it. So which is 1 by 1 plus r whole power n. If discounted rate is 10%, 1 by 1 plus 0.1 whole power, which year discount, which year present value I want? Seventh year. So I will calculate what is the present value factor for seventh year. I will multiply with how much cash flow I am getting after seventh year. For example, I am expecting 10 lakhs after seventh year. So 10 lakhs into what is the present value factor at the rate of 10% discount after 7 years. So 7 years, seventh year we can say the present value factor. When I multiply that, then what is the discounted cash flows I am getting? This is the value of the firm when we are having a single cash flows. So when we are having here value of the firm, even the cash flow for definite period. There is no infinite period, for a definite period. So for example, up to 7 years, I am having the uniform cash flows, for example, even cash flows. That means first year 1 lakh, second year 1 lakh, third year 1 lakh, fourth year 1 lakh, and like that. 7 years I am having 1 lakh. So each 1 lakh I cannot take it as a present value. Instead, you can consider directly the present value annuity factor there. So for 7 years, what is the annuity factor? So first year present value plus second year present value plus up to 7 years. So what is the present value annuity factor? Directly multiplied with 1 lakh. First year 1 lakh, second year 1 lakh, individually no need, directly 1 lakh into present value annuity factor you have to consider. Here we have considered what? Present value factor. Here we have considered present value annuity factor. When you multiply, you will get what is the value of the firm. When we are having multiple and uneven cash flows, not same 1 lakh, first year 1 lakh, second year 80,000, third year 40,000, fifth year 60,000, uneven cash flows if I am having, then you have to calculate every year. First year present value, second year, third year, fourth year. Individually, you have to calculate discounted cash flows and add, then you will get this is the value of the firm based on cash flows. So, value of the firm is even for cash flows for indefinite period without growth, indefinite period. So, indefinite period means I told you here we are having unlimited period, even cash flows we are getting. Just before example, I told you same 160 I am getting for unlimited period. I will calculate the terminal value. How can we calculate the terminal value? Either value of the firm or equity. So, I will take what is the annual cash flows. So, annual cash flows divided by weighted average cost of capital for value of the firm. If you want value of the equity, so divided by cost of equity we have to consider. So, firm if you want overall cost of capital you have to divide, and if you want only the equity, so divided by KE. Annual cash flows divided by KE. Is that clear now? So, next value of the firm when you are having even cash flows for indefinite period with growth. So, even cash flows only we are having. Now, this time with the growth you are having. So, here already we know KE is equal to D1 by P0 plus G. Here we want the value price. So, you can get KE. So, we can say D1 by KE minus G. So, here instead of dividend we are considering cash flows. So, cash flows divided by KE minus G. If you want equity value, if you want firm value, instead of KE I will take weighted average cost of capital. So, here D1 is nothing but present D0 into 1 plus G. The same annual cash flows into 1 plus G divided by overall cost of capital minus growth. And value of equity have to consider the same thing, but here instead of weighted average cost of capital we consider cost of equity only. Likewise we are presenting these things. And next, so let us see how to calculate free cash flows. We are having two types of free cash flows: free cash flows to the firm and free cash flows to the equity. So, free cash flows to the equity. So, here firm's point of view when we are taking, so generally we are having sales minus variable cost. So, we are having contribution minus fixed cost. We are having operating profit, earnings before interest and tax. So, minus interest, we are having earnings before tax, minus tax, we are having earnings after tax. So, here from earnings after tax, if you deduct any preference dividend or whatever, we will get earnings available to equity shareholders. So, generally interest you are paying to whom? Debenture holders. Tax you are paying to whom? To the government, so outsiders. So, preference dividend you are paying to whom? Preference shareholders. So, generally when we have considered here earnings available for equity shareholders, we have to deduct all these things. So, now here when you are calculating the free cash flows, only cash flows is required. Non-cash elements or any kind of working capital adjustments that we need to change. So, here when you are calculating free cash flows to the equity or free cash flows to the firm, so what is the difference between equity and the firm? The firm includes everyone, including debenture holders, but equity includes only equity shareholders. So, in relation here we are having that only equity shareholders availability that we have to consider. So, simply we can say we considered earnings after tax. For suppose there is no preference shareholding, then entire earnings after tax is belongs to equity shareholders or not. So, we are having call it as PAT, profit after tax, earnings after tax or profit after tax, which is available for equity shareholders. Now, I want this profit includes cash elements and non-cash elements. We want only cash flows. So, what we will do, same like cash flow statement, whatever we are doing, we will add non-cash expense. Non-cash expense like depreciation and amortization. Previously, if you debited to profits, so now you have to add back. Now you have to add back in order to get here the cash elements, in order to nullify this non-cash elements, we will get only cash elements. Previous deduction we have to add back. So now, is there any working capital changes, plus or minus working capital changes? So investment in working capital or reduction in working capital. Sir, working capital is nothing but current assets minus current liabilities. When working capital will increase, when current asset is increases or current liabilities decreases, then working capital will increase. That is called increase, investment in working capital. When current asset is decreases or current liabilities increases, simple. When current asset is decreases, working capital will decrease, or current liability increases also, working capital will decrease. So these are the conditions we are having working capital changes. Okay. So for suppose already we know, so debtors 10 lakhs is there. End of the day, we are having only 8 lakhs. That means what happened? This 2 lakhs realized into current year, which is cash inflow. Like we are having 10 lakhs creditors liability. Okay, end of the year 8 lakhs is there. That means 2 lakhs you paid to the creditors, cash outflow. So instead of adjusting the between elements, we are taking directly opening and closing elements. Automatically, the balance between the elements will be gets adjusted. So working capital changes we will adjust, and we will deduct capital expenditure, capex. If any capital expenditure that you have spending, so that we will deduct. So then we will get whatever the cash flows which is available for equity shareholders. And here one more thing we have to do, we will add net borrowings. When you are following free cash flows to the equity, net borrowings we have to add. That is the additional element. So what is, sir? Net borrowings is nothing but, net borrowings is nothing but when you are borrowing money, cash is inflows. Cash is inflows. When you are borrowing money, cash is inflows. When you are repaying any money, the cash is outflows. So here, whatever the cash inflows or outflows, whatever the cash is available here, entirely belongs to here equity shareholders. So we need to add what is the cash flows from borrowings. We can say inflows minus outflows. That we will add. Then we will get what is the elements, Nana? Here, whatever we are getting, this will be called free cash flows to equity shareholders. But free cash flows to the firm if I want, free cash flows to the firm if I want, in this profit after tax, already interest element we have deducted. Now I will add interest. If I add interest, tax effect will be there. So I will add interest after tax. Then I will get net operating profit after tax, which is no PAT. Always remember, free cash flows of the firm when you are finding, no PAT is the base. Free cash flows to equity we are finding, PAT is the base. Sir, here when PAT is not given, directly EBIT is given. EBIT is given, tax rate is given. You will get no PAT in these two areas. Sir, how? You can see here, EBIT minus interest, we will get EBT minus tax, we will get earnings after tax, which is PAT. For example, 100 we are having EBIT, 20 is the interest, then we are having 80. Tax rate, for example, 30%, 24, which is 56. Okay. Now we want here, in order to calculate the tax, definitely you have to deduct interest. Now for the firm's point of view, debenture holders are also firm's point of view, they are also having here. The firm includes not only equity shareholders, but also debenture holders. So this interest element we have to add here. So when we are having profit after tax plus interest already deducted, so we have to add tax I want, net operating profit after tax. So but before interest. Net operating profit I want after tax before interest, so that you have to give tax effect for this interest also. Then we are having 56 plus interest how much? 20 into 1 minus 30%, which is 14, total 70. Likewise, you can compute, or when you are having EBIT into 1 minus tax rate, which is 100 into 1 minus 30%, which is 70%. Like that also you can find out. In the question, if it is given EBIT, no PAT can be computed like this. If it is given PAT, you can add interest after tax like this. So here no PAT is the base. No PAT is the base for when you are finding free cash flows to the firm. Free cash flows to the firm when you are finding net operating profit after tax is the base. For this, remaining things are common. So we will add we can say non-cash expenses, and we will adjust working capital changes, and we will deduct capital expenditure. So net borrowings is not, we want firm's cash flows. Firm's cash flows includes everything here. So here we should not, okay, so specifically separate that borrowing. So we are having that this is free cash flows of the firm. So what is the difference of free cash flows of the firm and free cash flows to the equity? So let us see here. Free cash flows of the firm I want. Free cash flows for the firm I want. Profit after tax, add tax adjusted interest expense, which is 1 minus tax rate. Automatically we will get what? No PAT. For this non-cash expenses, we will add capital expenditure deducted, working capital investment, either add, investment, increase means add, decrease means deduct. Then we will get what? Free cash flows of the firm we want. Now, free cash flows of the firm, we are having cash flows from operations, we are adding interest after tax. So there you are having what? Minus capital expenditure. So this is another format. So just you follow this step format. And when you are having the free cash flows to equity, so when you want equity, we have to consider only PAT as the base. For non-cash expenditure, minus capital expenditure, working capital changes, we will adjust, increase means add, decrease means minus, and we will add net borrowings. This is important factor here. Okay. So here, based on this free cash flows of equity, when you want, if you have free cash flows of the firm, only adjust to two things. What is that things? In this profit, tax element is also there. First you deduct tax adjusted interest expense, interest after tax, and just you add net borrowings, only additional borrowings here. Automatically you will get free cash flows of the equity when it is given free cash flows of the firm. So it is useful for MCQs. And coming to earnings capitalization method, how can we value the firm based on earnings capitalization method? Expected annual maintainable profits divided by capitalization rate. So future maintainable profits we need to calculate divided by rate. Like different methods, we are having comparable methods. Let us see the problems now. A valuer has obtained the following information regarding Infolink Limited. Okay, this is related to comparable transaction method. Now you have to tell me. A valuer obtained the information regarding Infolink Limited. Infolink Limited data they have given. They are having number of equity shares 3 lakhs and market price per share, each share is 20. So market value of preference shares they have given, and market value of debt they have given, cash they have given. Now here you need to know enterprise value. Enterprise value, how do you get? Market value of equity plus market value of debt. Sir, here cash is there, but cash we should not consider as a value because it is not invested anywhere. So market value of equity plus market value of debt minus cash. Okay. So equity includes equity shares as well as preference shares. So there we are having here revenues. They have given in what is the revenue, depreciation and amortization expense, and interest, taxes, and net profit given. So what is calculation of here? Calculate EV by EBITDA multiple. Enterprise value is nothing but market value plus market value of equity plus market value of debt minus cash. That is a total enterprise value. So when it comes to EBITDA, what is EBITDA? EBITDA, which is earnings before interest, before tax, before depreciation and amortization. So, sir, why we have to consider this? When you are following earnings based valuation models, sometimes earnings might not be correct. Okay, my company having more depreciation sometimes. I am having more debt funds sometimes. I have to pay more interest. So this interest element and depreciation element affect my earnings. Then how can we calculate the correct value through earnings? So earnings is not the correct base. So that's why I'm taking a little, okay, nominal here. So I have considered earnings before interest, before tax, before depreciation, and before amortization. So that might have, I will get the correct value, accurate value. So I'm expecting that. So what is earnings before the things? Earnings, net profit given. This after all adjustments. Before interest means I have to add interest. Before interest, I have to add interest. Before tax means I have to add tax. And before depreciation and amortization, I will add. Then I will get EBITDA value. Enterprise value I know. EBITDA value I know. I can calculate the ratios the same way. Market value of equity plus market value of debt plus equity includes here. Market value of preference share capital minus cash and cash equivalents. We will get enterprise value. And EBITDA, how do you get? Net profit after tax. So before interest, before tax, before depreciation, before amortization. I will add interest, I will add tax, I will add depreciation and amortization, I will get EBITDA. Now EV to EBITDA multiple, which is 4.6. This is for which company, Nana? Infolink Limited. But we want here, second point, E-Link Limited is reported EBITDA is 27 lakhs. E-Link Limited company, EBITDA is 27 lakhs. And comparable company is Infolink. Whatever we have done Infolink Limited, that is a comparable company. But we want what? What is the value of E-Link Limited? E-Link Limited having EBITDA 27 lakhs. Now comparable company Infolink Limited, EV by EBITDA multiple I will consider. And I will calculate enterprise value for E-Link Limited. Sir, how can I consider this? EV by EBITDA multiple. EV by EBITDA multiple for same Infolink Limited I have considered here 4 point, how much? No, 4 point having 16. 4.16. I want enterprise value. Then I will get what? EBITDA into the same multiple I am applying for my company also. So what is EBITDA of my company, which is 27 lakhs, isn't it? Yeah, 27 lakhs. So I'll multiply 27 lakhs into 4.16, which is 1 crore 12 lakhs 32,000. Simply with the comparable companies, my company value I am finding based on considering EBITDA, EV by EBITDA multiple. Sir, here only one company is given, same thing, same comparable company I have taken. Like that Infolink, if it is given more than one company, calculate EV by EBITDA multiple for all the companies and take the average. So that is the base. Next. So current value per share. So accordingly, so here we are having the cash flows based on dividend cash flow. What are the forecasts they're having? 15 for next 3 years. Yeah. So I'm expecting some cash flows. Okay, so I told you dividend, we can having discounted cash flows techniques. So cash flows I'm expecting, for example, for 4 years, I'm having higher growth period. My growth is more. After 4 years, from the 5th year onwards, I'm having stable growth. For stable growth is nothing but the same growth I'm continuing for perpetual period. That means I will calculate the terminal value here, and up to 4, I have to consider the total cash flows. I will calculate the present value for whole. That is the formula we have seen earlier. Now we can see here how much they have given, Nana. So check out here. So 2 rupees, we are having the value forecast 15% growth for next 3 years. So 2 rupees. So next 3 years forecasting we have considered here plus 15%. So whatever the value you are getting here, which is 2.30 plus 15%. So next year value we are having 2.65 plus 15% growth we are having here 2.65, 3.04. So next 3 years. So 3 years I'm having 15% growth. Now fourth year I want to know what is the value. So here next 3 years followed by 4% growth perpetuity. So next whatever I am having 3.04, for this I have a growth only 4%. Only 4% for perpetual period. Perpetual period means I have to consider here that a total cost of capital. Here we are having what is the return we are expecting for this 13%. So you can calculate over here 3.04 into 1 plus growth divided by. So here we are having the return is 13% minus growth, which is 4%. We have to consider here stable growth rate. So we will get the terminal value over here. So they have considered here terminal value, and we are multiplying that things. We are getting 3.50 as a terminal value. Now all these cash flows we have to bring back to the present value. First year factor 0.8850. So we have taken which 15% rate. 15% rate we have to be considered. So 15% rate. So required rate of return, how much I'm having here? Let's check 13 percentage. Sorry, not 15 percentage. So 13 percentage. So discounting factor we're having 13 percentage. So based on that, we will get for all the values. First year, second year, 2 years, we are having third year, and fourth year we are having the same value. Fourth year beginning and third year ending, I'm having the same value. So same 6931 I have considered for the third year and fourth year. Is it clear, Nana? So here simply first year cash flows into first year present value factor. Second year cash flow, second year. Third year cash flows into third year. Now third year beginning only we are calculating the terminal value. So terminal value into free cash, we can say that present value for the third year only we have to consider. Third year beginning, second year ending, we are having the same values. So likewise, we are having third year ending and fourth year beginning, we are having the same values. The same value will be considered. Then we will get the overall, we were getting the what is the value of the business on that particular scenario. So instead of this, you can do one thing. So you can take cash flows. You can take year cash flows, and we're having present value factor and discounted cash flows. So first year, second year, and third year only we're having terminal value also. Third year beginning. So we can say third year ending. You can consider it. So we're having beginning. First year, second year, and third year ending itself, we're having terminal values. So then you will get the correct things. So first year 2.30, second year 2.65, third year we are having 3.04, and fourth year we have to calculate the present value based on here 3.04 into 1 plus 4%, which is growth, divided by 13% minus 4%. So we'll get the terminal value, which is 3.50. And the same thing we apply here, 0.8850, 0.7832, 0.6931, and 0.6931. 6931, the same apply. You can multiply the discounted values and calculate the present value of cash flows. Automatically we will get 33.15. That is the value of the company. Based on cash flows, we can calculate the value like this. So the following information available for Panther Limited. So they have given here revenue and growth in revenue every year. So for 25 is the base year. We're having 35% growth, 30% growth, 25, 20, 15 and 10%. And net profit margin they have given. So profit percentage will calculate it on sales. After getting the sales, on that profit margin we considered. And capital expenditure as increase in the sales adjusted for depreciation. So here increase in the sales. So there is no capital expenditure, means net capex. Adjusted for depreciation means net capex, which is 25% on increase in the sales. So if sales is increased from first year to second year, on that increase, how much is increased on that increase? So they have calculated 25% is the capital expenditure. Investment in working capital as percentage of increase in sales. This is also same. Instead of 25, you multiply with 8%, we'll get this. And long term constant growth rate, we're having constant growth rate 6%. Cost of equity given, debt ratio given. This is very important aspect. So debt ratio. So how can we consider? So first of all, we are having revenue is 25 for the base. So every year, how much it is growth? 35, 30, 25. So accordingly, we'll calculate the things. And last year, we're having the terminal value. So terminal value, we're having that long-term constant growth, how much? 6% over here. Okay. So here, so already they have given that growth period also, we can consider it. And net profit they have given. So net profit margin directly given, first year 8.5%. So you can apply sales into 8.5%, we will get the net profit for the year. And coming to capital expenditure is based on increasing of sales. Now sales from 25 to 33.75. How much increase? 8.75 increase. So that 8.75, so 8.75 into how much percentage they have given? So 25%, isn't it? 8.75 into 25%. So which is 2.19. Like that, if it is increases 33.75 to 43.88, difference into 25%. So like that, increase in the sales, how much? Based on 25%, if you get that capital expenditure is a net capital expenditure after adjusting depreciation, so directly we will deduct. And investments in working capital. So investment in working capital, what they have given? When you are making investment in working capital, so investment in working capital means cash is outflows. When it is outflows, we have to deduct over here. So how much? The same percentage of increase of sales into 8%. Now increase in the sales into 8% we have to do. Previously 25% I have done. Now I have to do 8%. Same 8.75 into 8%. Like that, 0 to 1, 1 to 2, 2 to 3, 3 to 4. Accordingly, we'll adjust the things. And this is most important note. Net borrowings we have to add. Okay. So the question they have given here, generally what are the elements they have given so far. So based on that, we need to calculate what is the value of equity, free cash flows of, we can say based on free cash flows of equity. When you calculate the present value, you will get value of equity. You can calculate here. Net borrowings is nothing but capital expenditure is outflow, working capital investment is outflow. This total outflow, debt ratio they have given. So how much carrying debt? That means you're having two funds, owned funds and debt funds. From debt funds, how much you're using? The debt ratio is given clearly 30%. So capital expenditure plus working capital investment. So capital expenditure and working capital investment, you add both 2.19 plus 0.70. When you add both and take 30%, we will get 0.87. So that is the net borrowings. When you add, we will get free cash flows to equity. After getting free cash flows to equity, now we will calculate the terminal value. So terminal value is nothing but 6th year, we have to make discount rate 3.25. So there is a growth, they have given 6%. Okay. So here again, don't go with the growth, because already the growth in revenue, growth in profit, everything you have considered, you can directly take the value. This is the including growth only. The final year value, whatever we are having, divided by KE minus G. So KE is 13% minus growth rate is 6%. So we will get for year 5 terminal value. Now all the cash flows you have to calculate the present value. 0.85 present value, 0.17 present value at the rate of 13%. The same last year we are having here 0.543. Last year, 5th year present value we will get over this. So then we will get the present value of cash flows here. Okay, Nana. So here you need to remember 3.25 whatever you are having, that is the value under the terminal growth. So before that, whatever we are having 2.64. So when you calculate the present value for all the years, we will get the value of equity. So free cash flows for the equity, when you calculate the present value, we will get free cash flows to the equity. When we calculate the present value, we will get what, Nana? Value of equity. So that is all about the things once you go through it. And yeah, so this question was also important for working capitals. Listen, with the given financial statement, extract working capital investment. So working capital investment year 2 and year 3. So when year 2 and year 3, current liabilities they have given. Now working capital means current assets minus current liabilities. Sir, all current assets I have to consider, or all current liabilities I have to consider. You can see current liabilities we are having short-term borrowings and other current liabilities, and trade payables we are having, and provisions also we are having. So in this, what we need to consider, and current assets we are having trade receivables, inventories, other current assets, cash and cash equivalents. In this, what we need to consider. So always remember, Nana, here we are having total current assets, how much we are having. In this, always working capital is nothing but non-cash working capital, because we are finding the cash flows. So here cash is also a current asset, but we should not adjust working capital changes, either cash as a current asset. So here cash and cash equivalents, whatever we are having, we should not consider while calculating working capital changes. So in total current assets, I will deduct cash and cash equivalent. Then I will get the balance current assets I have to be considered. From current liabilities, all current liabilities I have to consider. So here we have to consider, under current liabilities. Where is this? Yeah. Short term borrowings. Short term borrowings is nothing but you have to pay within 1 year. Now these liabilities, these current liabilities, immediately we are paying off. That means in this year only we have to pay off this. This is no more a current liability if you pay this element. So in this case, under calculation of working capital investment, we should not consider short term borrowings, and also we should not consider the provisions. This provisions, why we are keeping? So when in the future course of action, if anything is there, so we will adjust through the provisions. We have some route towards these provisions. In future we need to adjust. So we cannot use over here for working capital. So here these two elements whatever we are having, we should not consider. So from the current liabilities, total current liability, short term borrowings and provisions I will not consider. Then I will get remaining. So whatever the non-cash current liabilities I am having, non-cash current assets, non-cash current liabilities. Always remember, working capital means non-cash only. So here, change in non-cash working capital. Change in working capital is how much? Accordingly, first year, second year, third year. So they have considered from first year to second year, how much is the change? And second year to third year, what is the change? And fifth one we are having, Aditya Limited assigned the value of investment portfolio ABC Corporation. Again, this thing we are having in valuation of assets and liabilities. So there we will check. So normally financial reporting purpose, they are having portfolio. Reliance Industries, they are having total 1500 shares. For example, 1500 shares. So each share at the time of purchase is 2315 and the cost is 34,72,500. That means Aditya Limited, what he done? So Aditya is a person, he have invested 34,72,500, okay, for purchasing of 1500 shares, 1500 units in Reliance Industries Limited. Each unit price cost is 2315. Next, he is having another investment also, Mahindra and Mahindra. So there he purchased 2000 shares. Okay, so each share is 809. So he spent total 16,18,000. So total his investment in the stakes of both the companies is 50,90,500. Now I want to know what is the value of his investment. Calculation of value of his investment. Now here Reliance company, so last 10 trading sessions we have taken. Every day opening price will be there, during the year it will fluctuate and closing price will be there. So how can we calculate for this? So generally valuation when we are taking, this is for which kind of thing, Nana? For trading purpose. We are having that value per share calculation or value of investment calculation. So here when you are taking, if that particular stock is there in the stock exchange, we can take the last trading price. Last trading price will be the fair value for that particular share. If it is for not a listed company, it is a non-listed company, we have to value based on net assets, based on income approach and based on various techniques. So but coming to here, it is a trading organization. Last 10 trading sessions we have taken. Now we need to calculate the value. Sir, last 10 trading sessions when they have taken, you have to calculate the average. Sir, what average I have to consider? Listen very carefully. So last 10 trading session on 20th/12/2021, total number of shares traded here 1,17,794. So in Mahindra and Mahindra Limited, 817 is the closing price. Reliance Limited, total number of shares traded 11,04,898 and closing price is 2,277. This is the total turnover. So here if you multiply these two things, you won't get this value. You won't get this value. Sir, why? Here every share will be traded at closing price. Now from the morning to evening, each share will be traded at different prices. So when you have the total turnover here, always remember it is not the multiplication of number of shares into closing price. In the trading session, we are having different prices. Okay, afternoons different price we are having, morning different price we are having. Okay, it will fluctuate. So whenever you have taken the turnover, it is not multiplication of number of shares and closing price. So that's why we have to consider the total turnover is how much. total turnover, if you add all these things, total turnover will get, and total number of shares we will get here traded. So total turnover for Mahindra and Mahindra, total number of shares here. Volume weighted average price is the sum of total turnover divided by total number of shares. Very simple. Whatever the summation of turnover and summation of shares are there, sum of total turnover divided by sum of total number of shares. So we will get the value. This price will be considered over here. For so we can say Mahindra and Mahindra also we get that things, and we will consider the value here, which is 809. That means your at the time of purchase you spend 2315. At present, how much it is there, Nana? This is the cost. Sorry, this is how much? 824. 824.21. So this is the average price. So here at the time of purchase, Reliance company, so I got it for 2315. Now the fair value is 2343, a little bit increase. And Mahindra at the time of purchase cost 809 for 2000 units. So now it is 824. Now I can calculate the fair value. Reliance cost how much? 2315, units 1500. So here we have to consider what is the fair value rate. This is the cost value, this is the fair value. So same number of units into cost per script, you will get cost. Number of units into fair value, you will get the fair value. Like that, I spended cost here 50 lakhs 90,500. My value is at present 51 lakhs 64,060. So likewise, the investment can be valued over this scenario. So that is all about assets and liabilities approach. Sorry, we are having methods and approaches. So under methods and approaches, we are having different things. You have to concentrate on EVA aspect as well. And so EV also the same thing. You have to calculate NOPAT. From NOPAT, so we have to decrease, we can say, what is your cost of invest? We can say capital employed into weighted average cost of capital. So for that capital, how much overall cost that you're having? So in this profit, if you deduct, we will get what is the extra profit or value added profit. That we will discuss later after completion of the next unit. So there I have included the CVA patterns. And in this chapter, most importantly, we are having discounted cash flows when you are having that higher growth rate and stable growth rate. These two types are very important, and also calculation of value of the business. So based on different techniques, okay, that is also important. And earnings capitalization, net assets method, this all again we will study when we are doing valuation of assets and liabilities in the next chapter. Okay. So check our next topic. We are having valuation of assets and liabilities. Under assets and liabilities, we are having different kind of assets and liabilities, how to value the things. In that, most important for examination, such kind of assets we have taken over here. And we can see valuation of inventory. So how can we value the inventory? So generally, inventory we are having three kinds. So we can say raw material is also an inventory for a company, and work in progress as well as finished goods. Now, how to value the raw material, how to value the work in progress, and how to value the finished goods. Generally, you know, as per accounting standard 2 or Ind AS 2, when we are taking, the finished goods will be valued at cost or net realizable value, whichever is less. So we know how to value the finished goods. So here we need to know how to value the raw material as well as work in progress. Problem point of view, that is not so much important. For MCQs, it is important. We can go through here. So finished goods are nothing but it is held for sale in the ordinary course of business. Furniture dealer, sale of furniture is a finished goods. We can say what he is doing that. So purchasing of finished goods, selling of finished goods. We can call it as stock in trade. Or otherwise, if you are a manufacturer, you purchase timber as raw material and you do that work in progress and you produce the furniture, and furniture is your finished goods that you are selling in the market. Now, in the ordinary course of business, the thing which is held for sale, we can call it as finished goods. Work in progress is nothing but the result of production operations. Work in progress, it is as a result of production operations. What do you want to complete? So here furniture I want to complete. For that, what is the process? So that we are taking, we can call it as working process. And raw material means here raw material includes the spare parts, consumables which is held with an intention to consume the production process. So here raw material means not only the raw material which directly we are using for producing the finished goods, but also some consumables. We can say, so in order to manufacture something, the machinery is required. So for that machinery, you have to service that machinery, some consumables is required. So oiling, we can say grease we required. These are also we can consider as raw material. So we are having raw material, working progress and finished goods. Valuation principles already we know, cost or net realizable value, whichever is less. Now component of cost includes what? Cost includes purchase price of material. We can say either here raw material only we are purchasing. For a manufacturer, raw material he will purchase, or if you are a dealer, directly you are purchasing the finished goods, we can call it as stock in trade. So we are having two types of purchases, purchase of raw material or purchase of stock in trade. If you are a manufacturer, you will purchase raw material. If you are a trader, you will purchase stock in trade directly. So here the price includes the net amount paid or payable by the buyer to the seller. How much you are paying, in that trade discount or government subsidies, or if any duty drawbacks that you are having, so refundable taxes. So this all we are reducing from the purchase price. And after the purchasing of raw material, if you are a manufacturer, you have to convert that. So what is the conversion cost? The cost incurred to convert raw material into working progress or finished goods, that cost we can call it as conversion cost. So cost of finished goods includes here purchase price and conversion cost also. Under conversion, we are having raw material direct cost and indirect cost, labor direct cost, indirect cost, expenses direct, indirect. We are having all direct expenses directly, so we can allocate it to the specific product. So we are directly allocating for a specific product, direct expenses, direct raw material, direct labor or direct expenses. So whatever the indirect expenses are there, we can call it as overheads, and overheads will be apportioned by using reasonable and appropriate basis based on the ratio of the production, we can say that. So you are producing different materials. So now indirect expenses you are spending on a whole, in that you have to aggregate, we have to allocate that particular indirect expenses in the proportionate basis. And if any other cost that you have incurred to bringing the raw material to the current location, so transportation charges, handling charges, that also we have to include in the purchase price. What should not include in cost of inventory? Exclusions. Abnormal wastage of materials, labor or other production costs, that we are not including in the cost of inventory. So for example, fire accident has happened. So due to fire accident, some stock is destroyed, some raw material is destroyed. Now here, these wastage materials or any destroyed materials, that abnormal items, we can say abnormal losses, we are not including in the cost of inventory. And the storage cost, unless it is essential for production process. Now after bringing the raw material, entire raw material we cannot use into the production in the first phase. So some material we are using in the first phase, and balance material you will store. For that storage, you will incur some storage cost. Now that storage cost we should not include. Storage cost you will include only when if it is required for the production. So for example, some of the materials, some of the finished goods, for example, we are having raw material stage plus working progress stage. In work in progress, for example, we are having three stages. So working progress 1, working progress 2, working progress 3. So first you dump the material in 1. After that, the process is completed in 1, it will go to working progress 2, again some process will be there, and it will go to working progress 3. Stages of production. Now after completion of first stage, you want to send this material to second stage, you have to wait for 2 months. For example, some kind of goods that will produce, like medicines, drugs we can having. So such kind of medicines or any kind of pharmaceutical drugs that you are manufacturing, it will take some time to preserve for some period of time whenever they want to shift to another stage of production. Okay, like wine manufacturing, alcohol, we can say liquor manufacturers. So they have to do stage to stage, they have to wait. So for this waiting, they have kept this whatever that semi-finished raw material, we can say semi-finished finished goods we are having, they will kept in the storage. And this storage is necessary for production or not necessary for production? It is necessary for production, so that this storage cost also included in the cost of inventory. It's the cost of conversion. Okay, so if storage cost is not necessary, then don't include in the cost of inventory. And administration overheads that do not contribute bringing the inventory to the present location. So other administration expenses, salaries to employees, these all the things we should not include in the cost of inventory. Selling cost also we are not included in the cost of inventory. For selling this finished goods, you're having some, okay, we can say we can having some brokerage, you are giving some commission, you are giving for the distributors or dealers, such kind we should not include that selling cost. Next, what is net realizable value? So how can we calculate net realizable value? On the spot, if I purchase, if I sell the finished goods, how much is the estimated selling price? And to sell that finished goods, I will incur some expenses, estimated selling and distribution expenses. I have to deduct that. So for example, I produced one finished good, estimated selling price is 100. In order to sell this, I will incur selling expenses, which is 20. Now, how much is the net realizable? I will receive 100, but I already incurred 20 cost. So 80 will be the net realizable value. For work in progress, how can we find, sir? Work in progress is not at completed. Finished goods means already we have completed. We can understand what is the estimated selling price. For work in progress, we don't know how much is the estimated selling price. So how can we value the, we can say work in progress valuation. So net realizable value, how can we calculate for work in progress? So estimated selling price minus estimated cost to complete the product. This is the important thing. So now you are under work in progress. So first you will check what is the estimated selling price of finished good you have taken. So finished good, what is the estimated selling price? For example, 100, like previous example. And we have to deduct first how much cost you will incur to convert this work in progress into finished goods. Now we are in the work in progress stage. In order to convert it to finished goods, I have to incur, for example, 30. Now I have to deduct 100 minus 30. Now we will get the value over here minus same estimated selling and distribution expenses we will deduct. So 20 I will deduct from this, then 100 minus 30 minus 20. So it will be 50. So we can value the work in progress also like this. You can consider directly finished goods estimated selling price and finished goods estimated selling and distribution expenses. Here one thing you have to do, estimated cost to complete the product, because from work in progress to finished good, how much is the estimated cost that you deduct, you can get the value of work in progress also. Okay, so that is all about the basics. And the raw materials, when we are having the raw material valuation, so we have to consider there. So what is that reproduction cost, or we can say replacement cost accordingly. So we will value the raw materials. Okay, so here generally raw material is valued at cost, at historical cost only. So how much you purchase, the same thing will be the cost. Okay, now it depends upon raw material valuation is depends upon the finished good valuation. If finished good is valued at cost or NRV, whichever is less. Cost or NRV, whichever is less. So for example, cost is 100, NRV is 120. So you valued finished goods at 100 only, whichever is less. So that means cost. If you valued finished goods at cost, raw material also valued at cost. Sir, for example, if I am having cost 150, net realizable value 120. Now whichever is less, 120. That means finished goods you valued at net realizable value. Finished goods you valued at net realizable value. Then raw material you have to value at replacement cost. So what is replacement cost? On the spot, if you purchase the raw material for that particular units, how much cost that you have incurred, like that we have to value. Is that clear, Nana? So here raw material valuation is depends upon the valuation of finished goods. So here raw material valuation is depends upon the valuation of finished goods. If finished goods is valued at cost, raw material also valued at cost. If finished goods is valued at net realizable value, raw material is valued at replacement cost. Is that clear? So we'll go to, that's all about inventories and finished goods. Or sorry, we're having property, plant and equipment, you know, to value. And coming to important topic in valuation of assets and liabilities are valuation of investments. Now here valuation of investments. if I make any investment in shares, if any valuation of investments, I have an investment in a particular company. So how can we value the cost of investment? For example, I purchased 10 lakhs valued shares in another company. So purchase price is how much, Nana? 10 lakhs. Or acquisition charges, if any such brokerage or fees or duties that you have paid, so that also we have to include as an expenditure. So cost of investment includes purchase price plus acquisition charges. Here long term deposit you made 200 lakhs on 1st April and it incurs brokerage of 1 lakh. So what is the value of your investment? 200 plus 1, which is 201 lakhs. Now investment in quoted securities. Sir, investment in quoted securities. Quoted securities means the securities which is listed in the stock exchange. So for example, R Limited having listing of their securities in the stock market. Now, if you invest in this particular shares of R Limited, A Limited purchases 10,000 shares of R Limited in the stock market. Whatever the shares he is having, so in the stock market, we are having the quoted price. So for example, what is the stock market quoted price? We have taken into consideration, and into 10,000 shares, automatically you know what is the value of your investment. So for example, at the time of purchase, this 10,000 into 10, you invested 1 lakh. You invested 1 lakh, purchase 1,000, 10,000 shares. Now you want to know what is the value right now. Now in the stock market, what is the quoted price? You can take it and multiply with number of shares. Automatically you know what is the fair market value of your investment. So here, when I want to value the investment, I have to taken care. If the investment is of quoted securities, if an entity holds minority investment in quoted securities, such securities will be valued on their available market quotes. What is the available market price at present? While most of the cases, available market quotes on the date of valuation may be taken. So in which date you want to take the valuation? On that date, what is the value of the share in the market? You have to consider. Sir, which price I have to consider? Morning one price will be there, afternoon one price will be there, evening one price will be there. So you can take generally last trading price we have to consider. So which is closing price of the date of valuation. On 1/4/2022 you are doing the valuation. On that date, what is the closing trading price or last trading price? Last trading price will be considered as the fair market value. You multiplied with number of shares, you will get what is the value of investment. Now sometimes we are taking in different trading sessions. For example, last 10 trading sessions if I taken, in this 10 trading session, how many shares are traded at what prices? I will take the total turnover of that particular. So then I will calculate what is the volume weighted average price. Volume weighted average price is nothing but it's the sum of turnover of that particular trading sessions divided by sum of the number of shares traded in that 10 trading sessions. 10 or 15 trading sessions you can consider. So in the examination, they will give you the trading sessions. Already we have done one problem in the last chapter. Same. Total turnover divided by total number of shares traded. So then we will get one price. The same price will be used for the valuation. Sir, if it is of unquoted price, how can you value? I purchased a company shares, that company is not listed in any stock exchange. Then that investment of unquoted shares, so I can value based on that company's income approach, assets approach, or market approach. So anything I can follow there. So for financial reporting purpose, we can carry that cost in the financial statements. Valuers may carry out extensive valuations such as investment by using cost approach, income approach, or market approach, or combination of multiple approaches. You can take, so income approach one method, value we can say market approach one method. So they can take the average, anything they can do. In the absence of any information, valuers are considering value of such unquoted investment at net assets value under cost approach. Net assets value. So what is the net assets of that particular company? Net assets is nothing but assets minus outside liabilities at fair values. I will get net assets divided by number of equity shares. Net assets divided by number of equity shares. I know what is the value per share. So I am investing, I already invested 10,000 shares, 10,000 shares into value per share. I will get what is the value of my investment. And some of the common areas for adjustments for land or underlying investments or contingent liabilities will be considered while calculating net assets. Is it clear? If any adjustments are there, we have to check off adjustments. So before going to preferentials, let us see some problems. It's a very huge topics. the big chapter. So one by one we'll see the problems. And already same problem we have taken already previously. You can see here the share trading details of Reliance Industries Limited from the stock exchange, the available information they have given. If an entity holds 100 shares of Reliance Industries Limited, what is the value of investment as on 31st March 2022? How many number of shares you are having in Reliance Industries here? 100 shares. What is the value of 100 shares right now? As on 31st March, I am doing the valuation. Now, we have two cases here. One, you can consider last trading price. One, you can consider volume weighted average price from last 12 trading sessions. 12 trading session, all the details they have given. So, once again, I am telling you here, on 15th March, they have given the data. Closing price we are having, number of shares you are having. If you multiply, you won't get a turnover because it is closing price. All the shares will not traded at closing price. Okay. Some shares will traded in the morning. Some shares will be traded in the afternoon. We are having different rates on that particular rate. So that means if out of this number of shares, each and every price we cannot multiply. Okay. So here practically they have given only closing value over here and number of shares. So number of shares into all trading values they have considered. What is the total turnover on that particular date they have given. So here total 12 trading sessions they have given. First case is what we have considered last trading price. So last trading price is what we are valuing as on 31st March 2022. So 31st March 2022 closing price is 2633. How many number of shares I am having? 100. So 100 into 2633.95, that is the value. So you can check the closing price is 2633.95. Accordingly, what is the value of investment for 100 shares? 100 into 2633.95, it is 633.95 into 100, and this is correct. So we are having 2,63,395. That is the fair value of my investment. Okay. So here my 100 shares, what is the value right now based on last trading price? Sir, if I want to take weight by volume price when we consider, so total sum of the turnover they have given already. Okay, sum of the total turnover divided by sum of number of shares traded in 12 trading sessions. In 12 trading sessions, how many number of shares traded they have given? So already actually if it is not given, you add this. You add all 12 number of shares here. So you will get 30,25,060. 30,25,060. Now total turnover divided by total number of shares, you will get the value 2520.93. This is the weighted volume weighted average price. This weighted average price into number of shares 10 I am having. So my value of investment based on volume weighted average price is 2,52,093. If I consider last trading price, my value is 2,63,395. If I consider volume weighted average price, I am getting 2,52,093. So they can ask you such kind of questions over here. So next question you can see. Urban Electronics is selling 100 rupees per share today and he is expecting to sell 110 from the year now. Now here, so at present, what is the selling price of share? 100. Now, after 1 year, they want to sell this for 110. So how much he is expecting? Extra 10 rupees he is expecting from this share. So what is the expected return if the dividend for 1 year from now is forecasted to be, so they have given 5 rupees. So here, for example, I purchased X Limited. For example, I purchased one share for rupees 100. My intention is what? Not to hold. I want to sell this. I want to sell this in future for 110 rupees after 1 year. I am expecting how much? 10 rupees profit on this share. At the same time, I am holding this share for 1 year. I will receive dividend. How much dividend I am receiving? 5 rupees. Now here, what is the expected return? Two returns I am having here. Two returns. For example, if you have in CFR, you can check what is the intention of holding the investment. Fair value through profit and loss account, fair value through OCI and amortization cost method. If your intention is to hold, we are using amortization cost method. If your intention is to sell, you are classifying that investment as fair value through profit and loss account. If your intention having both, dual intention, either hold or sell. Here we are having either hold or sell. So my intention, I can hold the security, I will receive the dividend. And if I get the 110 rupees price, I can sell that investment. I am expecting that next year it will be 110. Now in that case, what is the expected return? Two returns. One is dividend, one is capital appreciation. So my value will be increased. If I sell this 100 rupees share for 110, 10 rupees, I will get profit. So what are the things I am receiving? 5 rupees in the form of dividend and 10 rupees in the form of capital appreciation in the future. What is my current investment? How much I put here? 100 rupees. For 100 rupees, I am expecting 15 rupees return, which is expected return is 15%. Expected return is 15%. Okay. So this is one thing. And already I told you here, we can calculate the value of investment or valuation of shares based on net assets method. Net assets method, I am using assets minus outside liabilities. Then I will get net assets divided by number of equity shares. I will get net assets value per share. So net asset value per share I can calculate based on this. So value per share calculation we are having. So here let us see. Panda Limited holds 4 lakh shares of AMGI Limited at a cost of 48 lakhs. So 4 lakh shares he purchased by paying 48 lakhs. Now, what is AMGI? So where you are having investment. So here AMGI Limited company's balance sheet they have given equity, share capital, other equity, non-current liabilities, non-current assets and net working capital they have given. Additional information, the face value of share is 10 rupees. So here face value of share is 10 rupees. So total 100 lakhs we are having 1 crore. So divided by 10. So we are having 10 lakh shares of 10 each. Non-current assets of AMGA includes land at a cost of 1 lakh, but the fair value of land is 1,75,000. Now, when you are calculating net assets value method, you have to consider fair value na book value na. If fair value is there, consider fair value. If fair value is not available, then you consider book value. Now here, non-current assets include land, the value of 1 lakh. First you remove that book value and add the fair value. Okay. So we can say 100 lakhs we are having here. Yeah. So 100 lakhs we are having that we have to deduct and 1 crore 75 lakhs is the fair value you have to add. And AMGA has contingent liability 12 lakhs which is not reflected in the balance sheet. Now that contingent liability is likely to be incurred. As a valuer, you believing that contingent liability likely to incur. So you have to recognize this as normal liability only. So current liabilities whatever you are having, here non-current liabilities whatever you are having. So this contingent liability also you have to consider. So you have to add that also. So then you find what is the net assets. So they're asking first what is the fair value per share of AMGI Limited. So next after that you have to value what is the value of investment of AMGI Limited in the books of Panda Limited, and they're asking CAGR also. So how much is the compounded annual growth? So when he made investment 4 years ago. So 3 questions, very important question. So first one, fair value. So I want to know assets minus outside liabilities, assets having adjustments. So I have to consider fair value. So non-current assets, we are having 2 crore 40 lakhs 13,129 minus book value of the land, and I am adding fair value 1 crore 75. It is easy for you. Take difference and add or subtract, not take like that. Simply remove the book value, add the fair value. So we are getting the things. And net working capital. Sir, net working capital is nothing but current assets minus current liabilities. Current liabilities is already adjusted. So here it is a positive balance. It is a net current assets. You have to add in non-current. We can say you have to add in current assets here, non-current assets and current assets. So total assets we are having value this much. 4 crore 37 lakh 78,008 rupees. Now you have to deduct outside liabilities. See here in the question they have given share capital, other equity we should not consider. Outside liabilities means only here we are having non-current liabilities. So deduct non-current liabilities, and also on contingent liability you recognized as liability right now. Now you have to recognize that also. So this is not there in the balance sheet, but you have to valuationary is saying about this contingent liability is definitely you will incur. So you have to consider it as liability for valuation. So I am getting net assets. Net assets divided by number of equity shares. So as we discussed, we are having equity share capital 1 crore. Each share is 10 rupees. That means 10 lakhs is number of shares. So 10 lakh shares. So net assets divided by number of shares, we will get net assets value per share. That is the first one they are asking. Second one they are asking what? In the books of So who is this? For Panda Limited. So Panda Limited hold 4 lakh shares. So one share value is 40.35. He is having 4 lakh shares. So 4 lakhs into 40.35. So his value of investment at present is 1 crore 61 lakhs 40,000. And we can see he invested 48 lakhs for 4 lakh shares. 48 lakhs he invested. At present, his value is how much, Nana? 1 crore 61 lakhs 40,000. 1 crore 61 lakhs 40,000. Now you tell me here, his value is increased. How much growth he is having? That is the third one, compounded annual growth. So generally we know future value, if you want to discount it to present value. So how you are taking? Present value is equal to future value. Present value is equal to future value into 1 by 1 plus r whole power n, discounted rate. But here 4 years ago, if you made investment 48 lakhs, now the value is 1 crore 61 lakhs 40,000. So here I want to know the future value. So then how can I consider present value into 1 plus r whole power n? How many years ago they are saying? 4 years ago. So here, what is the compounded annual growth? That rate we need to find out. R value we have to find out. So we know the future value, we know the present value. So what is the future value? We are having 1 crore 61 lakhs 40,000 is equal to, what is the present value? We are having 48 lakhs. That means 48 lakhs. 4 years back you invested, at present it is a future value for that 48 lakhs. So which is 1 crore 61 lakh 40,000. 1 plus R you have to find out, whole power how many years, Nana? 4 years. So you can consider that R is equal to fourth root of 1 crore 61 lakhs 40,000 divided by 48 lakhs minus 1 into 100. So here square root means you are taking 1 time square root. So fourth root means 2 times you can make. You will get this 1.3541 minus 1, 0.3541 into 100, which is 35.41 percentage. This is the compounded annual growth rate, CAGR. We can find out CAGR like this. Okay, so and coming to here CRD number, so we can say problem number 5. So here, before going to that, investments generally classified into 2 kinds. Investments generally classified into 2 kinds. One is long-term investment, another one is current investment. So current investments will be valued same like inventory what we are having, cost or NRV, whichever is less. But while coming to long-term investment, so here NRV is nothing but market price. So here long-term investment always recognized at cost. Always recognized at cost unless where there is a permanent decline in the investment. So generally if it is temporary declination we are having, the fair value prices increases, decreases, market value increases, decreases. If it is of temporary decline, no problem. If it is of permanent declination, for example, 1 lakh I invested in long-term investment, 1 lakh I invested in long-term investment, suddenly this investment value is decreased to 20,000. And again it will not go up. It is a permanent decline. When it is of permanent decline, then only you can value at market price, not at cost price. When it is of permanent decline, only at market price. If it is of temporary decline, you can consider only at cost. Temporary decline, which doesn't matter for long-term investment. But for current investments, whatever you're having, we have to consider cost or market price, whichever is lower. We can say Excel Limited has following portfolio of investments. So they're having current investments, they're having long-term investments also. So there are 3 current investments. They're having shares in A Limited, they're having some units of UTI, they have some shares in C Limited. So current investments, I told you it is valued at cost or NRV, whichever is lower. We can say 250, 265. We have to consider 250, whichever is lower. Cost of UTI investment 160, 160, no change. So we can say same 160 will consider. And coming to shares of C Limited 125, 100, we have to consider over here whichever is lower, 100 we have to consider. And moreover, it is very important, when you are valuing the investment individual basis, you have to value the investment. So for example, I have investment in 3 companies. So one is at cost and market price 100 rupees, 80 rupees. 100 rupees, 80 rupees. 80 rupees, 100 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 rupees, 1 And coming to B Limited, I'm having 100 and 100, and C Limited 80, 100. So you have to consider whichever is less, 80. So here we can consider 100, and here we have considered 80. So total value how much, Nana? 260. So value of my investments, we have to consider individual basis. If you take combined basis, it will be wrong. Combined basis how much? Here 280, here also 280. Cost or market price, whichever is lower, we cannot take. Because here 10 decreases, it is compensated, here 10 increases. Sorry, here 20 decreases, here 20 increases. One with compensating with another investments. Always remember, investments will be valued on individual basis, not on aggregate basis. Aggregate basis, you cannot do the value of investments. So here you have to do individual basis, 100 or 80, whichever is less, 80. 100 or 100, anything, you can take 100. 80 or 100, whichever is less, 80. Your value will be 260. Is that clear? So current investment total value will be 260. Here also aggregate basis you should not consider. Individual basis we have to consider. So 250, here we can say 125, 100, which is 100. So total 535, 525. If you take 525, that is wrong. Aggregate basis we cannot go for it. You can see here. So 250, 265, we can consider 250. Lower of A or B. Cost or market price, whichever is less. 160, 160, 160, 125, 100, 100, which is 510. Okay, so here 510 will be the value of current investment. If you take on total basis, it will be 525, which was wrong. Okay, 510 is the cost of current investments. Again, I'm telling you, current investment to investment, you have to do the valuation. Don't do aggregate valuation. So coming to here, long-term investments. I told you long-term investments always at cost until if there is a permanent decline. So here, cost of value of investment in the balance sheet purpose, assuming that, very important this point, the fall in the value of investments in Z Limited is temporary. Z Limited, it is a temporary decline. And what is the fall that having of W Limited is permanent. So when you're having permanent declination, you have to consider the total market value. So how much it fall, that falling, that means that slow, we can say that fall value only will be considered. Permanent decline. See here, long-term investments. I'm having shares in Y Limited at the cost 200 I invested, now it is 210. Cost or market value. Here we should not take long-term investment, don't take whichever is less. Directly considered cost. How much? 200. Now 150, 130, this decline is not permanent. Decline is temporary. Temporary means we can consider directly cost is 150. Now 80, 10, this decline 70 fall is a temporary or permanent? Permanent fall. When it is of permanent fall, don't consider the cost. We have to consider 10. Again, it will not go up. Once it fall, permanent decline means what, Nana? It will not go up. So you have to recognize at a 10 only. So how much it will be? 100 plus 150, 350 plus 10, 360. 360 is the value of long-term investments. So total value of investments we can consider 360. Is it clear? Why this is? Because of permanent declination. Permanent decline means again it will not go up, directly considered market value. For other long-term assets, long-term investments, you can consider directly cost. 100, 200 and 150. 200 and 150. Cost only. Market value doesn't matter. Now we're having 510 plus 360 total value of your investment in long term as well as current together is 870. Is that clear, Nana? Yeah. So next one is relating to share warrants. So here, let us see. So what are share warrants? Share warrants and shares are not same. Share warrants and shares are not same. Share warrants is nothing but, okay, it is a document that they have given by the company to the share warrant holder. So after a stipulated time, they can come and they can submit this warrant and they can get the shares. So for example, X Limited gave one share warrant to P, a person called P. In this share warrant, they will mention that predetermined rate and the future period. So you can come here after 2 years After 2 years, I will give you one equity share of mine is for 100 rupees. At present, it is trading at 100 and I will give you after 2 years also for 100 only. Now, 2 years completed. 2 years completed. After 2 years, the market price of this share is 900. But as per the warrant here, if you can submit this warrant over here, you will get the same share for 100 only. Okay. The share warrants are issued by the company at predetermined date and predetermined rate. Okay. Sir, why the company is giving this values? For example, so here the company will not give this for a free of cost, right? Okay. So the company can give this for a price. How it will be? For example, the company will say, in my company 10,000 debentures, or we can say 10,000 debentures combo price 10,000 debentures. If you want 10,000 debentures, it is 10 lakhs. It is 10 lakhs. 15% rate of interest I will give. 15% rate of interest I will give it for 10 lakhs. Now, the company also will say 10,000 debentures I will give you. You have to pay me 10 lakhs. But I will give you interest only 8%. Sir, what is this? Which combo is best? The first one is best always. So here, for 8%, they have declined the rate of interest. And they are saying about plus, I will give you 20 share warrants. This is the combo. So 10,000 debentures you purchase. You will pay 10 lakhs. Okay. But I will give you interest how much? Only 8%. Plus, I will give you 20 share warrants. Or second option also you're having. You can pay me 10 lakhs. I will give you debentures, 15% debentures. So interest rate you will get 15%. Now you can select. Okay. So if you are believing these share warrants, the future the company share will increase. You can opt the second option. And 10 lakhs you will pay 10,000 debentures. Company will pay only 8% interest on it. So what is the benefit for the company? They are paying lower interest. And this 20 share warrants, they will give you at exchange ratio. That means they will give you 1:2 exchange ratio. That means for every 2 share warrants, I will give you 1 share. That means 20 share warrants you can submit in the future period, you will get 10 shares in my company. At exchange ratio also they will give you. Okay. For every 2 share warrants, 1 share I will give. So like that. Now, sir, what is the beauty of this share warrants means? It is detachable. These 20 share warrants are detachable. So, for example, you know, convertible debentures. So, convertible debentures means this debentures is converted into shares in the future. Definitely, for example, 10,000 convertible debentures and 10,000 plain debentures. There is no conversion option, plain debentures. No conversion option means you cannot convert them into shares in the future. So here, convertible debentures. Now here, which one having more value? Plain debentures are convertible because we have one option, extra option, the convertible option. When you're having this convertible option, definitely the price will be high. So for example, 10,000 convertible debentures value is 1 lakh, we can say 15 lakhs. And 10,000 plain debentures value is only 10 lakhs. Here, why it is more? Because there is a convertible option. Now, this convertible option is taken to the shares, 10,000 shares. Now, if you sell this 10,000 shares, this option also you have to sell. It is convertible with convertible, we can say option. We cannot detach this both option and shares. But share warrants are not like that. This 10,000 debentures and 20 share warrants. I will keep 20 share warrants. I can sell 10,000 debentures. Separable, detachable. Or 10,000 debentures I will keep, 20 share warrants I can sell. Or in this 20 share warrants, 5 share warrants I can detach and I can sell. Or 6 share warrants I can detach and I can sell it. Is that clear, Nana? So here, that is the main thing over here. Based on exchange ratio, for 2 share warrants, you will get 1 share. So in the proportion of 2. So 2 share warrants you can sell, 4 share warrants you can sell, 6 share warrants you can sell. It is detachable. Okay, separately you can sell it. Okay. So here, why it is important? They will ask you what is the price of this share warrant. Now you tell me. So I'm having one share warrant, 1:1. One share warrant, 1 share they will give me. 1 share warrant, 1 share they will give me. What is the, here 2 questions they will ask you in the exam. What is minimum What is minimum price of warrant? And what is warrant premium? So what is the minimum price of warrant? So we are not paying anything for share warrant. We cannot say price. So how can we make this minimum price of warrant? Means what is the current market price? 2 years completed. 2 years completed or 3 years completed. Accordingly, what is there in share warrant? 5 years or 10 years, whatever. After completion of the period, what is the share in the market? If I submit this share warrant, I will get the share for 100 rupees. But current market price of this share is 900 rupees. 900. That means without share warrant, I will go to the company will sell me the share for 900. If I gave the share warrant, I will get how much? 900. So how much difference I am having? 800. This 800 is the minimum warrant price. 800 is the minimum warrant price. That means I will put 100 rupees and I will give the share warrant. Total the share warrant value is how much now? 800. Now both I will give and I will get 900 rupees valued share. Is it clear, Nana? So minimum share warrant is nothing but current market price minus exercise price. Exercise price means I can submit the share warrant and I will exercise for how much I will get the share. That is the exercise price. So the company is saying you submit this share warrant, I will give you the share for 120. Then exercise price is 120. For 180, exercise price is 180. So at present, what is the market price minus exercise price? We will get minimum warrant price. So what is warrant premium? So warrant premium in the sense, here we are having what is the current trading price of this warrant. This warrant also can be traded, I told you separately. This warrant you can sell it. What is the current warrant price trading in the market? So that we need to consider what is the current market price of this warrant. For example, the same share warrant, they are considering in the market over here. In the market, it is 500 rupees, for example. Now here, current market price how much, Nana? 900 minus exercise price how much? 100. For 100 only I am getting, no. So here minimum warrant price is 100. 800. Minimum warrant price is 800. So warrant premium, for example, warrant premium. Premium means more than 800 you have to sell in the market. Generally, it is trading in the market for 1200. So warrant premium, how do I get? Market warrant price, not market price of the share. So the same share warrant in the market, it is 1200. Why it is trading at premium? So we are selling this warrant for a premium because we are saying about the companies or whatever, the persons who wants to purchase the warrants. So we are saying that, okay, so this share warrant price at present it is 900. Okay, so here listen very carefully. So I told you this is for 2 years time, 1 year completed. 1 year completed, share price of this particular company is 500. We are saying about that now it is 500. Next year it will go up. Okay, at that time if you go to the company, you will get the share is for 100 rupees only. So this value at present is 1200. They are saying about. So at what is the trading price in the market? Share warrant trading price. Don't worry, this is also they will give you in the question. So here this is the share warrant trading price in the market. Minus minimum warrant price is how much? 800. Difference how much? 400 is the warrant premium. How much extra we are having in the market, that is called warrant premium. They will ask you only 2 questions, minimum price of warrant and warrant premium. So let us see the question here. HDC Limited has announced to issue the share warrants on 1:1 basis. 1:1 means for every 1 share warrant, we will give 1 share for its equity shareholders. The current price of the stock is 10 rupees. In the market, what is the current market price? 10 rupees. And warrants are convertible at exercise price 11.71 share. That means if you go to with the warrant and if you purchase the share, each share is 11.71. Sir, market price is 10 rupees, but exercise price is 11.71 rupees. Who will go? This is benefit for the company. So here they have given long back 1 share, Nano. Long back 1 share warrant they have given. Now exercise price they told that it is 11.71 rupees. If you come after 2 years, I will give you the share for 11.171. Now already completed 2 years. After 2 years, the market price is 10 rupees. If I purchased in the market, the same share I will get it for 10 rupees. Why I will go to the company, I will submit the warrant, I will purchase the share for 11.71. I'm getting it for 10 rupees only, no? Then warrant I will not exercise. So that is the benefit for the company. Okay. So here, now you tell me what is the minimum warrant price? I told you minimum warrant price is nothing but current market price minus exercise price. Current market price is 10 minus exercise price is 11.71, which is minus 1.71. The value should not be at minus, so it should be 0. There is no minimum warrant price. There is no minimum price for warrant because it is 0. It is negative. Now you tell me what is a warrant premium. The same detachable warrant is trading at 3 rupees in the market. Now what is the warrant price in the market? 3 rupees. So warrant premium means 3 minus minimum warrant price is 0. 3 minus 0, which is 3 rupees only. Warrant premium is 3 rupees only. Now you had a current price 16.38. Current market price is not 10. This is different case. They have given 16.38. Then what is the minimum price and what is the warrant premium? You have to tell me this. Now at present, what is the price? 16.38, not 10. Okay. Then minimum warrant price is how much? What is the current market price? 16.38. If I submit the warrant in the market, if I purchased, I will get one share for 16.38. If I take the warrant and submit with the company, then company will give me the share for 11.71. So that means what is the value of warrant? 11.71. If I want to get the share, I have to submit the warrant. What is the warrant value? The difference is warrant value. What is the warrant value? 16.38 minus 11.71, which is 9.75. Which is, isn't it? Now 16.38 minus 11.71 into exchange ratio 1:1 only, no, into 1. So difference is 4.67. 4.67 is the minimum warrant price. Minimum price of warrant is 4.65. Now how much it is trading in the market? They will give you, so check out, consider the warrant tradable at 9.75. 4.67 price, so 4.67 valued warrant is trading in the market for 9.75. 9.75. How much is the premium? So warrant premium will be 9.75 trading in the market minus minimum warrant price is 4.67. The difference. You can take the difference here. 5.09 is warrant premium. Only two things they will ask you, Nana. Minimum price and warrant premium. Minimum price is nothing but what is the market price of equity share or stock minus exercise price into exercise ratio. In this question, 1:1. Sometimes for every 2 warrants only you will give one share. Then 1/2 you have to consider. Okay, so that is the thing. So the recent examination they have given the same question. Okay, so that is all about the things. So next we are having. So next one we are having right shares. So when you're having the right shares, sometimes they will ask you what is the value of right and all. So here, what is the valuation of rights? So for example here, right shares are the shares that we are issuing to existing shareholders, for a concessional price. So why we are giving this for concessional price? So for example, suddenly company need money. So the company can ask the existing shareholders, first option. So the company is going for a specific project. So company wants to issue the shares. If I issue the shares to the public, definitely here the shareholding percentages get diverged. So first option I am giving to you, whether you will finance that for a particular project. So here we are asking to the shareholders, we are giving an existing shareholders additional shares to existing shareholders. So we can say existing shareholders at a concessional price. Now in this, what are the things we are having? Whatever the right shares you are giving to them. So either they can exercise the right shares, or they can reject the right shares, or they can sell the rights to someone else. So two things we are having here. So here whatever the right shares you are giving to them, you are offering to them. So they are having the option. The outsiders cannot purchase this. So for example, right shares I am giving for concessional price. This is for only existing shareholders. They will purchase and they can sell in the market. Okay. Or they can, that is called, we can say they can exercise this share, or they can reject this right shares, or they can sell this right option, whatever the right option they are having, that they can sell to someone else. Now here two things we are having. Either they can exercise the right shares, or they can sell or transfer. If the company wants, if the shareholders wants to transfer the right, they can transfer. So in order to transfer, they want to know what is the value of the right. So value of the right, how can we consider? One right value is how much? So we are doing the valuation here. So right value is nothing but we are having come right price minus X right price. Come right price minus X right price. So what is come right price? So including here, come right price is nothing but this is the market price of the share before right issue. Before right issue, what is the market price? So X right price is nothing but this is the market price of the share, we can say after right issue. Sir, before right issue, after right issue, why the value per share is gets changed? Because the market price is changed. Before right shares, we are having minimum number of shareholders. So you are having whatever the amount we are having, whatever the earnings earned by the company, it will be shared by minimum number of shareholders. Definitely the value will be more. So here, when it comes to after right issue, number of shareholders will get increased, number of shares will get increased. When number of shares is increases, definitely the price will be less. The market price will be less over here. So here, come right price is nothing but before right issue, what is the market price? X right price is nothing but after the right issue, what is the market price? The difference is called the value of right. The difference we can call it as value of right. Sir, in this X right price, how can we compute? I told you here X right price means what is the market price of share after right issue. After right issue, how much? No, here we are having already existing net worth will be there. Net worth prior to right issue. Net worth prior to right issue. Yes. So this is the net worth before right issue. Before right issue, what is the net worth of the company? Plus, generally net worth prior to right issue divided by number of equity shares, we will get what is the price of the share. Now here net worth prior to right issue plus, now when you are issuing the shares at a concessional price, new shares as a concessional price, you will receive some amount or not. So proceeds from right issue. Proceeds from right issue. So net worth prior to right issue, proceeds from right issue for new shares divided by total number of shares. Divided by total number of shares after right issue. After right issue means number of shares will get increased. Existing shares plus new shares whatever you are issuing. Now definitely the price will be lower while you are comparing to current market price before right issue. So here after right issue the price will be a much lesser. So here let us take a direct problem to understand it better. See, Suvo Limited plans to expand its business operations, estimates that total cost of expansion is 24 crores. They need how much? 24 crores. The same is proposed to finance by internal accruals 9 crores. They are already having some profits. They will use internal accrual profits 9 crores. So balance how much is required here? 15 crores is required. And balance through right issue. They want to get this 15 crores by issuing of right shares. The current share capital of the company is 2.40 crores. 2.4 crores current share capital is there. The share of the company currently marketing quoted at 345. In the market, what is the value of share? 345 rupees. The company proposing the price, the rights at 250 rupees. Array sir, we can say 345 in the market. For existing shareholders, if they want to purchase also, they have to pay 345 in the market. But as per right shares, I am giving for a concessional price. You will get the share for 250 only. You will get the share for 250 only. So they are asking, based on the information, compute the ratio of rights and calculate the value of rights. And third one, determining either gain or loss for the shareholder if he exercise the right shares or if he allow the right shares to expire without using it. And if he sell his rights, what is the effect on shareholders' net worth? We can say that whether it is gain or loss. So very important question. So we can expect this in the examinations. If they want to ask the right shares, this is the only question they have given. So here, a ratio of the rights. How much we need? 15 crores. 15 crores amount we need. So what is the ratio of the rights? So here, let me check. What is funds required for expansion? 24. Minus already accruals we are having 9 crores. Balance I want 15 crores. Now, right issue per price how much? 250. Now, 15 crores I want. Each share is 250 rupees. Means how many number of shares I have to issue? 6 lakh shares. 6 lakh shares I have to. Okay. Now, this 6 lakh shares I have to issue to all the shareholders in proportionate. Then what is the exchange ratio? That means the 6 lakh shares we have to issue for how many number of shareholders? The shareholders having how many number of shares? So, existing share capital how much? We are having 24 crores. 24 crores divided by nominal value, if nothing is given, you can consider 10. So, how many existing shares we are having? 24 lakhs. 24 lakhs shares we are having. So for these 24 lakh shareholders, I am giving 6 lakh shares. What is the proportion? For every 24 shares who is having, I am giving 6 shares. Simply 6 is to 24, which is 1 is to 4. For every 4 shares, I am giving 1 right share. If you have 40 old shares or existing shares, so you will get 10 the right shares. Is that clear? No. For every 4 shares, I am giving 1 right share. So in this proportion we are giving. That is what he is asking. What is the exchange ratio? So 1 by 4 or 0.25. Now the value of right, how do you get? Cum right price minus X right price. I told you X right price, how can we calculate? Net worth before right issue plus proceeds from right issue divided by total number of shares after right issue. You know already what is the total number of shares after right issue? Initially 24 lakhs plus freshly we are issuing 6 lakhs, total 30 lakhs. Now coming to numerator, what is the net worth prior to the right issue? So now this 24 lakhs, what is the current market price? Initially 345 rupees. So if you multiply, automatically you will get what is the market value? Yes, net worth prior to here 24 lakhs into 345 plus if I issue fresh shares, how much I will receive? 6 lakh shares freshly I am issuing, but how much I will get? 345. No, only 250 I will get. Concessional price I am giving divided by number of shares is 30 lakhs. So then we will get X right price is 326. Market price is 345. X right price is how much, Nana? 326. What is the value of right? 19 rupees. One right value is 19 rupees. If you sell 100, we can say, if you are having a right shares. So one right share you are having, if you want to sell this, you will get 19 rupees. Value of one right is 19 rupees. So next they are asking that calculation of gain or loss if exercise the right. Assume 100 number of shares you are having. If you are having 100 number of shares, 100 shares you are having, how many right shares you will get? What is the exchange ratio? 1 by 4. 100 into 1 by 4, which is 25 shares you will get. That means if you have 100 shares, you will get 25 right shares. Now here, what is the net worth before right issue? 100 into each share is 345, which is 34,500. Now after right issue, you will get how many right shares, Nana? 25 right shares. We are having only 25 right shares. Now, after right issue, what is the X right price? Each share is how much? No, 326. Now, 100 rupees into my share value is how much? 326. 326. Is that clear? 100 rupees into 326 plus I'm having here 1 second. So we are talking about after reissue. After reissue, how many number of shares you will get? 100 plus 25, total 125 shares. Now 125 shares after right issue, what is the price here? 125 into 326. 125 into 326 in the market. And how much you paid for this? For this 25 shares, you paid 250 rupees. So 25 into 250. So 40,750 is your value of share, and for purchasing that 25 shares, you paid 6,250. What is your value then? 34,500. Before also, I am having 100 shares with 345 market value, 34,500. After also, I am getting 125 shares, but 326 is the only price. But I paid in this, so then the value is more. But I paid no 250 rupees, I paid for each share. So 25 shares, I paid 6,250. I have to deduct that. What my net worth is 34,500. Before and after is same. If you exercise the shares, there is no change in the net worth. Okay. So then if you exercise the right shares, there is no change. If you allow to expire, that means previous also you're having 100 shares, after also you're having 100 shares. You have not exercised that thing. You are not purchased that thing. So here, then previously you're having 34,500. Now what is the share price right now after reissue? It is decreased. No, if you are not exercising, so someone will exercise. So 325. So 326, we're having 32,600. Now my net worth is decreased. How much is decreased here? Sorry, here. Yeah, decreased. How much is decreased over here? 1900 decreased. So if you allow to expire, your net worth value is decreases. Now I want to sell the rights. So previously I'm having 100. Now also I'm having 100. I want to sell the rights. So 34,500, 32,600. Now each, how many shares I'm having? 100. What is the value of right? 19. So I will add, that means I will sell this 100 rights for 19 rupees each. I will receive how much? 1900. My share price 32,600 and my net worth. So I have sold this right, how much, Nana? For 1900. So automatically it will become 34,500. So before and after one and the same. If you sell the rights also, you will get the same net worth. Is that clear? So that is all about right issues. Once you go through it. So next one we are having that preference dividend coverage ratio. Nothing, Nana, here. What is the earnings available for preference shareholders? Which is nothing but earnings available for preference shareholders, which is nothing but profit after tax, PAT. In this preference dividend we are giving, after that earnings available for equity shareholders will get. In this PAT, preference dividend, how many times it is coverage? For example, 10 lakhs is there. PAT is 10 lakhs. I have to pay preference dividend 2,50,000. So how many times? 4 times it is covered. 4 times it is covered. If you want to purchase any preference shares, I will take care here which is the highest preference dividend coverage ratio is there. I will go for it. Okay. Like that we are having that. So most appropriate method. So generally it means if the investor wants to buy a small lot or non-controlling interest. Small lot of shares if you want to purchase, the best method is dividend capitalization method. Or controlling interest if you want to purchase, the best method is we can say earnings capitalization method. Listen very carefully. So I want to purchase only 20,000 shares or 20% of stakes. In a company, I want to purchase only 20% of stakes. So in another company, I want to purchase 80% of stakes. Now, when I am having controlling interest, I am having non-controlling interest. If I am having controlling interest, my intention is always towards earnings of the company. You can take earnings as the base. Earnings as the base. If you are having non-controlling interest, we can not go for any kind of interest. Dividend, you can go for it. So dividend is enough. So by taking the dividend, so we can value the share. So here for non-controlling or buying small lot, we are going with the dividend capitalization method is the best. And coming to controlling interest holders, not dividend, earnings is important. So earnings capitalization is best thing because non-control interest holders will look after only dividend, but controlling interest holders will look after the earnings of the company. So here based on that we are having dividend capitalization, earnings capitalization. You know, dividend per share divided by capitalization rate, EPS means EPS by capitalization rate. So anything you can calculate market value. Always remember in the valuation the principle is this: return is equal to value into rate of return. But we want value always. Value is equal to return divided by rate of return. This return might be MPS, might be, we can say, this return might be dividend, this return might be earnings, this return might be cash flows, whatever it might be. So divided by what is required rate of return, automatically you will get the value. And coming to here, problem number 7, from the following information of two companies for the year 31st March, what they're asking, buying small lot, buying controlling interest. So I told you here, market capitalization is 18% and 80% of profits are distributed. 80% of profits is distributed and market capitalization rate is 8%. Share capitals, preference share capitals, profit after tax they have given. And what is your, if you plan to invest only in preference shares, the company prefers preference shares, would you prefer? And what is your rates difference from buying a small lot if the company retains 30% and company A retains 30% or company B retains 10% of profits? So let us see here one by one. First one, calculation of dividend per share and earnings per share, because small lot holders dividend per share base we can take, and for controlling interest holders earnings per share is the base. Profit after tax minus preference dividend. So preference shares we are having 6 lakhs and 4 lakhs. So 60,000 and 40,000 for company A and B. Next, we are getting earnings available for equity shareholders. In this, how much dividend I am paying? 80%, which is 1,92,000, 2,08,000. After deducting equity dividend, we get return earnings. Now, equity dividend per share I want to calculate. Okay, dividend per share. So, total dividend divided by number of equity shares. So, 1,92,000 divided by 80,000 shares. So, DPS I will get 2.4 and 2.08. Earnings per share, how I will get? Earnings available for equity shareholders, which is 2,40,000, 2,60,000. So divided by 80,000 divided by 1 lakh. So 3 rupees and 2.6 rupees. I have EPS and DPS, DPS and EPS. Now, if company wants to buy a small lot means which is the formula? Dividend capitalization, DPS by capitalization rate. So DPS how much? 2.4, 2.08. Capitalization rate is 18%. So then what is the value, Nana? Value or MPS we can say, the total value 13.33 or 11.55. So buying controlling interest, what is the base? Earnings is the base. I will take EPS here, capitalization rate, then I will get MPS. So based on EPS by capitalization rate, so we'll get this is the value. This is the value of the shares, so whatever we can say. Next one, preference dividend coverage ratio of both the companies are to be compared to market decision. I told you preference dividend coverage ratio, before paying preference dividend, PAT I have to consider. So preference dividend coverage ratio, PAT by preference dividend. So 3 lakhs divided by 60,000, 3 lakhs divided by 40,000. So 5 times company A will cover, 7.5 times B will cover. Which is the best for purchasing preference shares? B is the best. If you are planning to invest only in preference shares, we would prefer company B, as there is more coverage for preference dividend. And lastly, we are having DPS. So dividend per share, already we had this. Third one, what is the third one they are saying, Nana? Once you check. Would your rates will be different if buying a small lot, if company A retains 30%, B retains 10%. Nana, retains 30% means payout 70%. Company B retains 10% means payout 90%. So we have to consider in that scenario also. So PAT, say minus preference dividend. So then we will get here dividend payout ratio. So after preference dividend, these are the earnings available for equity shareholders. Preference dividend after taking off, earnings available for equity shareholders. Now in this, how much dividend I am giving? 70% payout, and here 90%. So dividend value we are getting here, and number of equity shares we know, and DPS will be, so it is not 2%, it is 2.1 rupees and 2.34. This is per, we can say dividend per share is 2.1 and 2.34. I told you return is equal to value into rate of return. So we want value, which is nothing but MPS. So MPS is equal to DPS by 18, 2.1 by 18%, 2.34 by 18%. So let's you check here, 2.1 by 18%, 11.67. So correct only. So likewise, we are doing the valuation over here. And coming to problem number 8, the balance sheet of Moti Industries Limited having 31st March 2021, the data. Equity and liabilities they have given, assets. Check out two types of equity shares are there. One is 10 rupees paid up and 5 rupees paid up. Now always remember, we're having two kinds. When they're asking value of equity shares based on earnings capitalization, we can say that earnings capitalization method or dividend capitalization method based on net assets method. So when you are calculating net assets available for equity shareholders divided by number of equity shares, then we will get what is the value. This is value per share, but it is fully paid up share or partly paid up share. When it is fully paid up shares, for net assets we have two techniques. First, you add notional call. Notional call is nothing but what is partly paid up. For example, 10,000 shares paid up only 8 rupees. That means remaining 2 rupees into 10,000, that will be considered as notional call. First, you make them into fully paid up, then divided by number of equity shares. This is one technique. Or otherwise, net asset value, whatever you are having, number of shares you can consider. If you are having 1 rupee 1 share, like this you can calculate, you will get 1 value per share. If you want 10 rupees value, into 10 you will make, or 5 rupees means into 5 you can make. So any kind you can follow over here. Okay, so here profits they have given, equity dividends they have given, land and buildings managerial remuneration will go up, future profits, so future expenses they have given, and income tax provided 50%. They're asking equity shares of a company in the same industry, dividend rate is 10%, quoted at par. Ignore goodwill, value for depreciation and all. They're asking that first, most important, appropriate value of equity share. Controlling interest is transferred, only few shares are transferred. When controlling interest is transferred, let us see here. Now, profit before tax for 3 years data they have given. We're having 2,20,000, 2,50,000, 3,20,000. When you are calculating future maintainable profits, if it profits are of increasing trend, you can go for weighted average. And if any adjustments are there, that we need to adjust. Any abnormal losses, generally it will not happen every time. So such things we have to adjust. Just like from this profit, if any accident has happened, fire accident, it is included. Now you have to add back, you have to reverse it. Any unnecessary income you have included earlier, which is not required and not earned in the future, that we have to deduct. And we can say that either abnormal loss or abnormal gains affected the profits, you have to reverse. Extraordinary items are affected the profits, you have to reverse. Nothing given here. So directly I will take direct to weighted average, which will be 2,80,000. And for future maintainable profits, you have to adjust the future profits or future savings. Now I am having here future profits. How much? So check out here, if any future profits or we can say future expenses or future savings we need to adjust. Managerial remuneration likely to go up in the future, 20,000 per annum. Now at present we don't have this 20,000, but in future profits this 20,000 is affected. So I will deduct 20,000. Now I will get whatever the profits before tax. So always remember this, always whenever you are calculating future maintainable profits before tax, only last only you have to deduct the tax here, 50%, which is 1,30,000. PAT will be 1,30,000. So preference dividend when we are deducting, so we are getting 1,21,000. So capitalization rate is 10%. Capitalization rate is 10%. Now we know here we are having, after deducting preference dividend, earnings available for equity shareholders divided by capitalization rate 10%. So value of equity will be 12,10,000. So for this 12,10,000 for equity shareholders, listen very carefully. Two types of equities we are having. One is fully paid up, another one is partly paid up. First we will make it entirely fully paid up. This is 10 rupees paid, 10 rupees share. But here 5 rupees only paid up, 10 rupees share, 5 rupees paid up, means unpaid is how much? Unpaid is 5 rupees. That means first let me check how many number of shares. 2 lakhs by 5, which is 40,000 shares. Now 40,000 into remaining 5 rupees is again 2 lakhs. So notional call, I will add 2 lakhs. So this is notional call. Notional call money 2 lakhs. Now this value is for entire fully paid up shares. Number of equity shares is 70,000. So we have to consider. So how many number of shares we are having? Let us see here. So 3 lakhs, we are having 10 rupees, which is 30,000 shares, and here 40,000 shares, total 70,000. Total 70,000 shares. So we will get 20.14. This is for fully paid 10 rupees share. 10 rupees share value is 20.14. I want 5 rupees value share. So we can say here, so directly you can consider 20.14 minus 5 rupees, which is 15.14. So 15.14 will be the value. Likewise, we are having dividend capitalization method, the same thing. Average dividend rate we have to be considered, and DPS we will calculate 1.6 capitalization rate. So market price is equal to DPS by capitalization rate, which is 16. So for partly paid up, for 10 rupees value is 16 rupees. So 5 rupees value is how much? We are having half of this. And MPS will be, we can calculate here, MPS by capitalization rate. So we are having that 16 rupees cross multiplication. 10 rupees share 16 rupees means 5 rupees how much, which is 8 rupees. And net assets method also we are having the same way we will calculate. So this is net assets available for equity shareholders. This is notional call money 2 lakhs we will add. 12 lakhs divided by same 70,000 shares, we will get fully paid up share value, and partly paid up if you want, just you have to put minus 5. So which is 12.14. Once you go through it. So let us see the next problem here, problem number 9. Before going to that, just we check valuation of intangibles. So here they can ask you the valuation of intangible assets, especially for goodwill. How can we calculate? So valuation of intangible assets like goodwills, brands, etc. So Ind AS 38, an intangible asset is identifiable non-monetary asset without having physical substance. So here we are having what is meant by asset. So our asset is a resource controlled by the entity arising from past events and giving future economic benefits. So any kind of asset definition is asset is the resource which is controlled by the entity. So the person or the entity which is controlling that asset belongs to them. Just like we're having leases. So here, even though as per the legal form, lessor is the owner of the asset, but lessee have to do the accounting for that leased asset because he is having the control. Past events, it is arising from past events. Earlier I may purchased or I may acquired, and it gives us future economic benefits. So for this, 3 other things when you have added, which we can get that intangible assets. So here under intangible assets, we are having identifiable, non-monetary, no physical substance. So together we can call it as intangible asset. So intangible assets is an identifiable. Identifiable means it is separately identifiable. I can sell intangible asset alone without combination of any other asset. Separately it can be sold. Then we can say it is identifiable separately. And it is non-monetary. Here non-monetary in the sense we don't have in the financial assets. You don't know here. As per Ind AS 109, we are having that definition of monetary and non-monetary. Ind AS 21 also you have get. So here, which is nothing but non-monetary is nothing but there is no fixed and determinable amount of money will be receivable from that particular asset. For example, if debtors is there 1 lakh, it is a fixed and determinable amount. I will receive this 1 lakh from debtors. So debtors is a monetary asset. But coming to fixed assets like property, plant and equipment and intangible assets, those are non-monetary assets. We don't have any fixed or determinable amount we'll receive from this particular asset. So it is a non-monetary and there is no physical substance that you know already here. It is intangible in nature. We can call it as intangible asset. So here In this, goodwill will be there, brands, patents, copyrights, customer list, so domain names, anything are the examples for intangible assets here. Goodwill. So majorly, so valuation of goodwill is important in these chapters. So we are having excess earning capacity of an enterprise. Within the same industry, how much excess they will generate. So for example, so I have a company, I am running it for 10 years. Now the same company which is dealing with same products, a new company, if anyone is started, now you tell me here, they are also doing the business, we are also doing the business. So here for 10 years of experience, how much profit I will earn? And without no experience over here, it's a newly startup company, how much profit they will earn? So here the difference in the profit, normally in the same industry, 10% return I will get. Okay, industry, as per the industry return, if you start a new company in this business, you will get 10% return. If you invest 1 lakh, you will get 10,000 rupees profit. But here my company is giving 15% profit. That means my profit will be 15,000. Why? How much extra profit I am earning, then we compared with the normal industry return, this extra profit, we can call it as super profit. So by earning this extra profit, why this profit, extra profit we are earning means this profit earning capacity we got because of goodwill which is having for the company, because of this experience and because of the treatment of the customers. Okay, so goodwill can be arised for by any kind of things. So after sale service is good. Okay, so treatment of customers were good, anything the goodwill can arise. So here I am getting extra earning capacity because of goodwill. So here goodwill is nothing but excess earning capacity of an enterprise in comparison with other enterprises of similar size within the same industry. So goodwill in excess of the value of the business over the aggregate fair value of the net assets. This is also goodwill, acquisition goodwill. Now another goodwill, X Limited acquires Y Limited. X Limited acquires Y Limited. Whatever the assets and liabilities of X Limited, we have taken over at fair value. Now fair value of assets minus fair value of liabilities. Fair value of assets minus fair value of liabilities, we will get net assets. For example, 10 lakhs. So here this 10 lakhs worth net assets, you are paying 12 lakhs to purchase it. Extra 2 lakhs, whatever you are paying, it is purchased goodwill. This is all extra amount is also will be termed as goodwill, but this goodwill is acquiring from business combination. So here the goodwill includes purchased goodwill as well as self-generated goodwill. So generally, you know, average profits method, how to calculate goodwill, average profits into, we can say number of years of purchase. How can we consider average profits? Simple average profits we can take it, or weighted average profits, depends upon the trend. And when you are calculating average profits, okay, so here this average profit place, we are replacing here with future maintainable profits. What is your expectation in future? How much profit you will maintain while calculating average profits? So profit for example, 3 years I have taken 10,000, 12,000, 16,000. Now I will take past year profits and I am expecting what is the future maintainable profits. I can take the average, I will get it. But what happened in the first year, that means 3 years back, what happened? One fire accident is happened, 2000 I got abnormal loss. And the same loss will be happened every time. No, if this abnormal loss will not happen in my company 3 years before, my profit would be 12 lakhs. Because of this abnormal loss, my profit is 10 lakhs. Oh, sorry, we have 10,000. Because of this 2000 loss, my profit is 10,000. If this abnormal loss is not happened earlier, my profit might be how much? 12,000. So that means such kind of things which is not recurring in future, it's a non-recurring thing, extraordinary thing, or we can say abnormal thing, such kinds we have to add. So while calculating average profits, I have to consider 12,000 instead of 10,000. Abnormal losses, abnormal items or expenses we have to add back. And second year what happened? Because of loss I incurred earlier, I got insurance claim 1,000. This insurance claim 1,000, whatever I am having, that will be included in the profit or not? Every year I will get insurance claim? No. So you have to deduct that abnormal gain. So second year my profit I have to consider only 11,000. Okay. So I invested some of the amount in the non-trade investments. That means which is not at all relating to my business. I invested in Reliance company shares. So that company gave me some dividend income from investments. I have included in my profits, it is increases. It is not at all related to the business. We have to deduct that interest from non-trade investments, which is not at all affected your goodwill. Okay, you're having Reliance company shares. Okay, so you have Reliance company shares, it affected goodwill. If anybody is purchasing by seeing that you are having Reliance company shares, I will purchase your products. No. So here we are having that. The 16,000 will be adjusted with any income from non-trade investments are there, that will be deducted. So then I will get, for example, 2,000 non-trade investment interest I received. Previously I have added, now I will deduct, I will get 14,000. These are the adjusted profits. After making adjusted profits, we will take the average. So then I will get average adjusted profits. And for this, if any future changes are there, till now I have some expenditure, in future I don't have. So in such a case, I will add that. Okay. So that means that is benefit, that is a future saving. So for example, I have debentures of 10 lakhs, I am paying 10% interest. Exactly on the date of valuation, I redeemed 6 lakhs debentures. Now I am having only 4 lakhs debentures. That means in future I have to pay interest on 10 lakhs or on 4 lakhs? On 4 lakhs only. My interest expenses decreases or not? It is savings for me. I will add future savings and I will deduct if any future extra expenses I had. Then I will get future maintainable profits. When I am considering profits, always remember, consider profit before tax. If after tax is given also, you have to add back and consider profit before tax. And the tax you have to deduct over here. For future maintainable profits, this is before tax. Now you deduct the tax. Sir, why? Why I have to consider here before tax? If you consider after tax, each and every element tax effect you have to give. That is quite difficult. That's why consider first itself profit before tax, then do the adjustments, and at last you will deduct the tax. Then we will get future maintainable profits after tax. This will be considered here for average profits. So here this is my future maintainable profit. Industry profit how much? Normal profit. So here average profits method, goodwill formula, average profits into normal rate of return. Sorry, we can say number of years of purchase. And coming to super profits method, second one we are having. Super profits is nothing but future maintainable profits. Here actual profit, what we can replace it with future maintainable profits minus normal profit. Normal profit, how do I get? Capital employed into industry return, normal rate of return. So capital employed, how can we calculate? Assets minus outside liabilities. While you are calculating capital employed, don't include non-trade investments. Non-trade investment, assets minus outside liabilities when you are calculating, don't include non-trade investments. Remaining capital employed we have to consider, because I want here operating capital employed. How much capital employed I am employing in the company for doing the business, not for investments. So here non-trade investments I should not consider. Then I will get normal profit over here. Okay, so the difference between future maintainable profit, normal profit is super profits. Super profit into normal rate of return. Sorry, we can say, super profit into number of years of purchase, automatically we will get goodwill. While considering capital employed, sometimes in the question they will give you consider closing capital employed, you consider direct closing capital employed. If not, we have to consider average capital employed. Sir, average capital employed means opening plus closing divided by 2. This is one way. But opening capital employed is not given. How can we conduct the average capital employed? So we have to consider it over here. So here opening and closing, what is the difference? Opening plus profit is equal to closing. Okay, so now I want to take the average over here. So opening I don't know, profit I know, so here closing I know. So based on that, closing minus half of current year profit, it have to be considered like that. Okay, so let us see, goodwill is equal to average profits into number of years of purchase. Super profits method, goodwill is equal to super profits into average number of purchase. In this, first you calculate future maintainable profit, next normal profit, and the difference take it as super profits into number of years of purchase. And for all the things, once you go through it, and capital employed while you are calculating, assets minus outside liabilities. Here we'll consider all the assets. And coming to investment, we have to consider only trade investment at its fair value. Non-trade investments, no need to take over. And what is the difference between these capital employed and we can say net assets? Sometimes they will give you the combination question. You have to calculate the goodwill and they have to ask, so what is the value per share? Value per share, net assets divided by number of equity shares. So already capital employed you calculated. Again, why you have to calculate net assets? So already capital employed, whatever you're having for the calculation of goodwill, simply add. Previously you have not considered non-trade investment. Now you consider non-trade investment. And presently we got goodwill. Goodwill is also an asset. Add goodwill. Then automatically you will get we can say net assets. Such combination questions also will have. So goodwill is equal to, we can say, capitalization method, capitalization of average profits, capitalization of super profits, capitalized value minus net assets. Capitalized value is nothing but future maintainable profit by normal rate of return. So into 100. Sir, what is this capitalized value and net assets portion? Simply, we can say industry return 10%. Industry return 10%. Okay, so my return 15%. Now here, industry return 10% means if I invest 1 lakh here, I will get 15,000 profit. If same 1 lakh I invest here, I will get only 10,000 profit. Is that clear? Now here we need to check out what is the capitalized value. So that means in order to earn 10,000 return in my company, in order to earn 10,000 return, or we can say my return is 15,000. In order to earn 15,000 return by that company. So which company? So similar company. This similar company, in order to earn 15,000 return, how much capital they have to put? Within 1 lakh they have kept, they are getting only 10%, 10,000. If they want to earn 15,000, what might be the capital? That is the capitalized value. What might be the capital here? So in order to get 15,000, they have to invest 1,50,000. 1,50,000 into 10%, which is 15,000. So capitalized value is 1,50,000 and my investment here it is 1 lakh. The difference, net assets. So capitalized value 150 minus 1 lakh. The value of goodwill is 50,000. Likewise, through capitalized value we can calculate. So capitalized value, how do you get? Simply future maintainable profit, my profit divided by normal rate of return, industry return. So 15,000 divided by industry return, how much? 10%. Automatically you will get the value. How much? Into 100. So then we will get capitalized value. And actually normal rate of return you can take percentage, again into 100 is not required. So how much I required? 1,50,000. So 1,50,000 minus 1,50,000 is a goodwill. Under super profits method, capitalization of super profits direct, no need all these things because already you have deducted. So here average profits minus normal profits. So directly super profits by capitalization factor or normal rate of return percentage. Directly you can apply. Again capitalized value, these all things are not required. So before going to the branch, so we'll see this question, the combination question. Ninth one. The following information is available for ST Limited. They have given equity share capital, reserves and surplus. We're having trade payables, assets, PPE, inventory, trade receivables, cash and bank balances. So they have given for 3 years separately. And additional information, capital employed as on 1/4/2024. That means opening of that 1/4/24, opening balance, which is 73,20,000. Now, normal rate of return is 12.5%. Normal rate of return on capital employed is nothing but industry return. So here fair values they have given, PPE having fair value, inventory having fair value. So net profit they have given separately. If goodwill is calculated for 5 years purchase based on average super profits, 5 years average super profits. So that means you have to calculate super profits and 5 years of purchase, then we'll get goodwill and they're asking value of business, both they're asking. What is the value of business? What is the goodwill? You can see first we'll calculate capital employed, assets minus outside liabilities. So here assets at a fair value, revalued value you have to consider. Fair value, two things. And we're having trade receivables. If a fair value is not there, consider book value here. So assets minus outside liabilities, we will get here capital employed. In these assets, any non-trade investments are there? No. If it is there, that we should not consider. So I have considered all the assets at fair values. and 2 assets fair value given, remaining assets not given. I considered book value minus one and only liability I'm having, trade payables. I got capital employed. But here you want what? Average capital employed. For that, what details they have given? Opening also they have given for April 1st. Then take the average. Opening capital employed plus closing capital employed divided by 2, average 62 lakhs. Now current year closing, next year opening, Nana? Yes, you can see 50 lakhs 80,000 is 2024 closing, and 2024 1st April also the same value, opening and closing. 50 lakhs 80,000 plus 59 lakhs 20,000 divided by 2, and next year, so current year closing, next year opening, so again opening plus closing divided by 2, average capital employed we got. So average capital employed into normal rate of return 12.5%, I will get normal profit. Normal profit, no problem. So here what I had, I want normal profit I got. I want what? Future maintainable profit. So here net profits we are having, and adjustments they have given. So fair value of inventory when we are checking. So 20 lakhs is become 24, 24 is become 28, and 32 we are having here 32. So adjustment over here, undervaluation of inventory. Can check the balance sheet. Check here, 24 lakhs is the fair value, but how much I have shown? 20. 28 here, I have shown 24. 32 here, we have shown 28. So 4 lakhs undervaluation of inventory I have taken. So because of that, profit is affected or not? So how much profit is affected? 4 years. Because of undervaluation of inventory. That means if you check trading account, if closing stock is undervalued, gross profit is also undervalued. Opposite, we have same relation. Closing stock decreases, profit will be decreases. Closing stock increases, profit will be increases. And opening stock valuation, if it is there, opening stock decreases, gross profit increases. So there will be an effect over here. So here undervaluation of stock individually we have taken. So we have added all the undervaluation of inventory for net profit. So adjusted profit I got. So then super profit is nothing but adjusted profit minus normal profit. So I got here total super profits. Now I want average super profit. Average means you can take the average of all these three things. We will get 8,77,500. Now goodwill is 5 years of purchase into 5, we will get goodwill 43,87,500. So first of all, goodwill is calculated based on super profits method. Next they are asking what is the value of the business. Now already you calculated net assets at fair value. So total assets minus outside liabilities. Net asset value how much? 72 lakhs 80,000 in the balance sheet. And we have to add what goodwill you got here. That is also an asset. I will add goodwill. There is no non-trade investment. So these all are my net assets. So net assets is nothing but value of business over here. So total net assets is equal to, this is based on net assets. If they are asking what is the value per share, net assets divided by number of equity shares, you can go for it. This is one kind of thing. And coming to that, brands. If you remember brands, okay, so here we're having different kinds of brands. Self-generated brands will be there. Brands are of two kinds. One is self-generated, another one is purchased. So purchased brands and self-generated brands. Generally, as per Ind AS 38 of intangible assets, self-generated brands will not included in the balance sheet. So here, as per Ind AS 38, because we don't know what is the cost that you have incurred to generate that brand. My company having this much brand, how much cost you spend for that brand? We don't know. So here, that can be generated automatically. So brand valuation is quite difficult, self-generated brands. So that's why clearly it is saying about that, don't recognize as intangible asset. But if you purchase the brands on the way of business combination, that means, see here, under business combination Ind AS 103, the balance sheet of parent company and balance sheet of subsidiary is there. Now, it is a balance sheet of subsidiary. When you are taken over all the assets at fair value, even though brands are not recognized by subsidiary company as per Ind AS 38, if you recognize the fair value, this brand also we have to recognize that fair value. If you consider fair value or if you ignore the fair value, based on that you have to check the value. So here based on that I will consider what is net assets. Net assets includes brands, net assets might not include brands. So minus purchase consideration, the difference I will take it either goodwill or capital reserve. So here we are having Marico Limited acquired 100% Nihon Limited for 2000 lakhs, 100% acquisition. So what is the PC? 2000 lakhs. As on the date of acquisition, net assets given. What are the net assets? Tangible fixed assets I am having, and brand also I am having some asset here, and net current assets. So they are asking compute goodwill on acquisition date. First case ignore brand value, second case consider brand value. If you ignore brand value or if you consider brand value, what is the difference? So here if you ignore brand value, then net assets will be how much? 500 plus 380, which is 880. So 880 lakhs worth net assets you purchased by paying 2000 lakhs. So how much extra you paid? 1120 lakhs, which is goodwill if you ignore the brand value. If you consider the brand value, so then I have taken over 500 plus 380 including brand 120. So total net assets will be how much? 1000. For 2000 PC that you are giving by acquiring 1000 valued of net assets, then your goodwill will be 1000. Always remember, whatever the brand value you have considered, it will be adjusted in the goodwill only. Okay. So listen very carefully. If your brand value, so for example, it is 1000, right? Total assets is 1000. If your brand value instead of 120, so we are having plus, you can consider 1220. Okay. So additionally, I have added 1100. Okay. So that means my asset valuation, how much it will be? It is 2200, isn't it? 1100 I have added. If your brand is this much. Now here when you consider net assets, you acquired 2200 and you are paying only 2000. Okay. So that means it is a capital reserve. So here how much? 200, but it should not created. Whatever the brands you acquired, it should automatically adjusted to the goodwill only. So that means how much goodwill is there, to that extent you have to make this. For example, net assets account debtor to net assets, here only assets given, net assets account debtor to PC consideration. So here net assets acquired 1000. So PC I am paying 2000. Goodwill how much? Here goodwill 1000. Now check on it. So net assets account debtor. In this net assets, we are having another assets. Apart from brand value, how much is net assets? 880. And brand value, we are having 120. To PC, 2000. Now how much goodwill I am having here? 1000. Listen very carefully. This is goodwill. If brand value, if you consider maximum, how much brand value you have to consider means to the extent of goodwill. If brand value instead of 120, if the brand value instead of 120, if it is we can say 1500. So that means total value will be 2380. So PC 2000, difference where I am getting 380. Capital reserve should not create. Maximum it should be set off against the goodwill only. So that means goodwill or brand, anything one you have to show, but it should not cross the capital reserve. So that means maximum how much brand valuation I can make? 1120. That means if my brand valuation is 1120, then it will be total how much, Nana? 2000. PC how much, Nana? 2000. So goodwill will become 0 minus 1000. It will be 0. Okay. So maximum brand valuation, how much value you have to show? Maximum 1120. It will be adjusted in the goodwill only. If there is no brand value, goodwill will be 1120. You can see here how much goodwill I am having, 1120. If I ignore the brand value. So if I consider the brand value, it should not cross the goodwill. Goodwill maximum it will become 0 also, not an issue, but it should not fall below that. Okay, so that means no capital reserve should be created out of it. That is all about once you go through this. And coming to 11th one, you are having relating to the same brand valuation. The following data is given regarding the company having a share in branded portion as well as unbranded portion. Now you want to know what is the brand value. So they are dealing with branded products and they are dealing with non-branded products also. On branded products, they are getting per unit 500 rupees. Unbranded, they are selling for how much revenue? We are getting 120 rupees per unit. Cost you incurred for branded and unbranded separately given. Research and development will be there only for brandeds. You have to research and development, you have to get it for branding elements, brand products only. And how many brand products you sold? 1 lakh. Unbranded products you sold 40,000. Tax rate is 39.55. Capitalization rate is 18%. Calculate the brand value. First, let me check what is the net revenue from branded product. Revenue minus cost into quantity sold. What is the revenue I am having here? 500 per unit. Cost per unit, how much? Branded cost per unit. Branded cost per unit is 350. So 500 minus 350, 1 lakh. Total revenue is 15 lakhs. From this revenue, unbranded revenue how much? Net revenue of unbranded. So revenue minus cost, only 20 rupees I am getting. 40,000 units I sold, 8 lakhs. Now here, total profit after tax in the company. So we are getting how much? Total revenue minus total cost. Is it clear? So this is the net revenue. Net revenue is nothing but profit. So here profit. So we are having only for branded product PAT I want. So in that consideration I have taken 150 lakhs whatever I am having the branding revenue. From that I will deduct what is the research expenditure? 20 rupees. For how many units? 1 lakh units. Total 20 lakhs. I will deduct 20 lakhs and revenue from unbranded product I will deduct, and then I will get what is the PAT only for branded product. That means here PAT includes, profit after tax includes revenue, net revenue from branded 150 lakhs plus unbranded 8 lakhs. Now I want only for PAT for branded revenue, and cost is also there none. So cost also have to incur minus 2 lakhs. So here this is the net revenue with brand and without brand we are having. So here total how much I am having? 208, sorry, 158. So 158 minus 20 is the cost and minus 8 lakhs is for brand unbranded. So automatically you will get only branded revenue, which is 122. Is it clear? So this 122 whatever you are having, this is after tax. I want for after tax. This is before tax whatever I am having. Now I want after tax. I have to adjust the tax. So then I will get 73, 74, 900. That is the brand revenue. Only returns from the brand. Now I told you here value is equal to, so generally return is equal to value into rate of return. I want value. So return by rate of return. How much return I am getting from branded revenue? Branded returns 73 lakh 74,900 divided by rate of return, capitalization rate given directly, divided by 18%. So this is the value of brand. Brand value we can value like this. This is one thing. Okay. So that's all about problems, and we'll see the remaining elements where you have to cover in this particular chapter. We're having bond valuation. And always remember, 1 or 2 problems are there in human resource. You have to check it. And also 1 or 2 problems you're having in real estate, that also you have to check it for MCQs or for complete problems. So just one time reading is enough. And economic value added. So economic value added, how do you get this? Simply. So first of all, economic value added is nothing but, so what is extra return? We can say, for example, I have 1 lakh rupees. Nana. If I have 1 lakh rupees, either I can invest this in, we can say, risk-free investments. So risk-free investment, if I invest, I will get 10%. 1 lakh if I invest in 10%, 10,000 return I will get. No sir, I want to do business. 1 lakh I will invest it in the business. So then also, after doing all the hard work in the business, you are getting 10% return. Is there any use? Instead of doing business, risk-free securities like government bonds anywhere, if you invest, you will get 10,000 return. Here also you are getting 10,000 return. No use of doing the business. because same returns you are getting. If you get extra return when you are doing the business, so here we can say instead of 10%, I am getting 15% in business. 15% in business. So here, how much extra return I am having? 5%. That is your value added. How much extra you are getting than whatever the risk free. In simple, we can say economic value added. First, you have to calculate net operating profit after tax. I told you when we are doing the free cash flows. So, NOPAT can be calculated based on two ways. One is through EBIT into 1 minus tax rate, or if PAT is there, NOPAT can be calculated PAT plus interest after tax. So, you can consider here PAT plus interest after tax adjusted with the tax, we will get net operating profit after tax. So, this is your return. Now, how much cost you will incur? So, total capital employed, we can consider operating capital employed into weighted average cost of capital. This capital can be get by the way of equity shares, by the way of preference shares, by the way of debentures, by the way of loans, whatever. I will consider first what is weighted average cost of capital into this. So, how much cost I will incur for this capital I will get. That means by using the capital, how much return I am getting. For using that capital, how much cost I am paying. If the difference is there, that extra difference we can call it as economic value added. So, you can calculate economic value added based on that. So, formula average capital employed, average cost of capital, weighted average cost of capital, how do you get? Cost of equity into weight of equity. Okay. And cost of debt into weight of debt. When we are considering here post-tax cost of debt, we have to be considered. And cost of preference into weight of preferences. Accordingly, we will calculate that weighted average cost of capital. Simple formula. NOPAT is calculated based on same operating profit into, which is operating profit into 1 minus tax rate, which is EBIT into 1 minus tax rate. So, ultimately, you will get how here NOPAT minus overall cost of capital, how much you are having. The difference we can call it as economic value added. And these EVAs will accumulate to form MVAs. Market value added. Sir, what is market value added? So, in your balance sheet, you are having capital, equity share capital, preference share capital, debentures. In your balance sheet, for example, 1 lakh shares, equity shares are there 10 rupees. Preference shares 2 lakh is there 20 rupees. And debentures we are having 3 lakhs. Each debenture is 50 rupees. But in the market, this is all are the issue prices. But in the market, what is the price? The difference we can take. So, market equity share capital minus book value of capital. Market preference share capital minus book value or debenture. Same thing we have to consider here. Total market capital minus total book capital. The difference is market value added. And one more thing we have left with brand already we have completed. So, let us check for bond valuation. So, basically the problems from bond valuation they will get. So, for example, the face value of bond already they will give you. Coupon rate is nothing but interest rate. So, whatever you have given for this particular bond. So, here now how much I am getting by purchasing of this bond. Okay. So, generally we are having that if I purchase this bond, I will receive interest and I will get a redemption value at the time of expiry of the bond, maturity of the bond. So, if the bond is matured, 5 years bond I am having. So, up to 5 years I will receive interest and after 5 years I will get redemption value. Now, I will calculate what is the present value of this interest and what is the present value of this redemption value. If I add, then I will get what is the value of bond. So, here we are having different kinds of bonds. So, types of bonds we are having here. Plain vanilla bond, we are having zero coupon bonds, perpetual bonds, so based on plain vanilla bonds we can say, so just like that we are having interest and a redemption value, you can calculate the present value and add, you will get value of the bond. And while coming to zero coupon bonds, in zero coupon bonds we don't have any coupon rate of interest. So then how? They will issued at a discount, the redemption at par. So they are issued at a discount. So I will purchase this for 94 rupees. At the time of redemption, I will get 100 rupees. So the difference here, 6 rupees is the gain. We cannot call it as interest, but indirectly we can call this as gain. So under zero coupon bonds, how can we value? And perpetual bonds, so there is no maturity for it. If any perpetual bonds are there, how can we value this? So generally, while coming to plain vanilla bond, in case of plain vanilla bond, we can take one example. Generally, how to calculate present value interest into 1 minus 1 plus r whole power n plus redemption value into 1 by 1 plus r whole power n, present values. Present value of interest, present value of redemption value. So here, what is the value of bond? If value of bond is more than the current market price, you can buy the bond. If value of bond after calculation which is less than current market price, then you can sell the bond. Okay. So not to buy, simply we can say nobody will purchase. We can say here not to buy. Okay. So first calculate what is the value of the bond and the comparing with the current market price. If bond value is more than current market price, you can purchase it because value will be more. In opposite, don't buy it. So that is the decision. So one example I can consider here. So the face value of the bond is 1000 and we are having coupon rate is 10% or 11% you can consider. So life is 5 years. So after 5 years the bond will be matured and you have to pay that redemption value at premium 1050. Current market price is 945. So required return is 15%. So how can we make this? So first you calculate interest is how much? Interest coupon rate is how much? 11%. So that means interest amount will be 1000 into 11%, which is 110 rupees. So interest annually I will receive how much, Nana? 110 rupees. So I will calculate what is the present value of interest. So this interest I am receiving here, this is 11% per annum. So here 110, 110, 110 I will get up to 5 years. So I will take 110 into what is the annuity factor for 5 years on 15% return, which is almost equal to annuity factor I have to consider, which is around 3 point something, 3.352 or 368. Okay, you can consider that. We will get the present value of interest, annuity factor for example it is there. So 110 into 3.352 is the annuity factor for 5 years under 15% return. So my value of only interest is 368.73. Sir, I am receiving interest 110. For 5 years means how much I have to receive? 550. But I am calculating present value of your future 550, which is 368.73. Because today I want to know what is the bond value. So present value of principal, which is redemption. How much you will get redemption? Here 1050. So 1050 into 5th year factor 0.497, which is 522.03, which is almost equal to 891. Now this is the valuation of bond. Now here, what is the current market price of the bond? Which is 945, isn't it? But value of bond is only 895. Now value of bond is less than the current market price. So here 895, which is less than 945. So definitely don't purchase such kind of bonds, because if you purchase for 945, actual value of bond is how much? Only 895. So likewise, you can take the decision whether to purchase a bond or not. Okay. So next we are having zero coupon bonds. When we are having zero coupon bonds, here no coupon rate of interest, no interest we will receive. At a time we are receiving the redemption value. Simply, how can we calculate the value here? Redemption value into 1 by 1 plus r whole power n. So redemption at par means not an issue here. So for example, we are having issue price is 400. Redemption period is 10 years. Redemption value is 1000. Redemption value is 1000. I told you zero coupon bond generally issued at a discount and redeemed at par. So this value is 1000 only. They issued for 400, 600 discount. But at the time of redemption, I will receive 1000. I have to wait for 10 years. So here we are having required rate of return. So rate of return, which is 10%. Now you calculate what is value of bond. Only redemption value, 1000 into 1 by 1 plus, we can say 1 by 1 plus 0.1 whole power 10, which is around 385 something. So valuation of bond here we having 3.385. So here now you check the value of bond is 385, issue price is 480. So we can say it is overpricing not to purchase this at a price. We can say like that we have to calculate zero coupon bonds. Zero coupon bonds, always remember, we don't have interest. Don't calculate any value for interest. Only redemption value, calculate the present and compare with issue price. Whether to purchase or not, you have to take the decisions. When we are having perpetual bond, so perpetual bonds we are having, there is no unlimited, we can say unlimited period we are having. So that means interest payable for unlimited period. In such a case, how can we calculate the value? So there is no redemption value. If you remember, when we are doing the cash flows for unlimited period, we are calculating terminal value. Here also we are doing the same. So I told you return is equal to value into rate of return. Now I want value. So return by rate of return. So how much return I am getting over here? So here face value, which is 1000. Coupon rate is 12% per annum. And a required rate of return which is 15% per annum. So coupon rate how much? 12% per annum. So how much interest I will receive on this 1000? 12 rupees I am sorry, here we are having 120 rupees I am receiving. So interest will be 1000 bond value into 12% interest, which is 120. For unlimited period I am getting. So here 120 whatever I am having, 120 I am having here, it is written, divided by, so required rate of return is how much? 15%. So directly what is the value here? Return 120 divided by required rate of return, which is 15%. Now you calculate this value is around 800. The value of the bond is 800. For perpetual bonds, we will calculate like this. So here, if any non-conventional bonds are there, okay, another type, non-conventional bonds. So they will give you this non-conventional bonds. That means the cash flows are uneven and not equal for every year. So in such a kinds, we will calculate the value the same. Present value of cash flows, future cash flows plus present value of same redemption value. One example I will give you for this. Face value of the bond is 1000. Interest rate. So different coupon rates I am having. 12% per annum for 1 to 5 years. Very rarely it will be there. That's why it is non-conventional bonds. So and interest rate, here we are having 14% per annum for 6th year to 10th year. 1 to 5 years 12% interest, 6 to 10 years 14% interest. So required rate is 15% and the redemption value is also same, redemption at par, 1000. So calculate value of bond. So here you can check face value we had, different rate of interest we are having. So it is simple, we can calculate the present value of interest and present value of redemption. So we can consider like, so interest will be how much? 1000 into 12%, which is 120. This is for first to 5 years. So next to 5 years it is, we are having 1000 into 14%, which is 140. This is 1 to 5 years. This is 6 to 10 years. I will calculate the value factor. We can say annuity factor for first to 5 years. So first to 5 years, what is the annuity factor? Based on required rate 15%, calculate annuity factor. That means I will get 120 is a even up to 5 years into annuity factor for first to 5 years. 1 to 5 years, you can take it M plus and you will get, so 3.3521, which is around 402.2586 we are having. So next, Is it clear? Yes. Next interest I am having 140. Now for 6th to 10th year you have to do the accumulation. So present value factor for 6th to 10th year you have to accumulate and you will get the value 1.666. That means you will start doing M plus after 6th value, 6th to 10th. So you will get the value here 233.325. So then we are having interest portion over here up to next. You're having a redemption value also 1000 into last year 10th year factor to 0.284, 284 or 247, 1000 into 247.18 something. So 247.18. You can add all these things, you will get the value. So near about 800 change. So once you check 882, which is the present value of future interest as well as redemption value. Non-conventional bonds, if it is given also, you can calculate the value based on that. Okay. And remaining for MCQs, it is important for bond valuation. You want to know what is current yield. Current yield is nothing but it is return on market price. So current yield, how can we compute? Coupon rate of interest, or we can say coupon or interest. So divided by current market price into 100. How much interest I am getting for this market price at present? That is called current yield that will be generated by the bond. Okay. So that is one thing you have to remember. And so zero coupon bonds already I told you. So yield to maturity. Yield to maturities, it is nothing but it is an expected return on investment. So how many years I will hold this bond, till then how much amount I am getting here. So whatever the interest you are receiving, if you regenerate, we can say that again if you reinvested, again you will get some interest on that particular interest portion also. So total yield, how much we are getting, that we can call it as yield to maturity. So here we can calculate interest plus selling price minus purchase price by end divided by selling price plus purchase. Selling price not with redemption value. So divided by 2 into 100. Okay. So here whatever we are getting, this difference is nothing but gain, capital gain. That means you are getting interest and you are getting capital gain. Okay. So based on that, have to consider selling price or purchasing price, means average I have to consider. Then you will get yield to maturity. And remaining all discounted cash flow technique you can use and you can solve this. Okay. So that's all about valuation of assets and liabilities. Here one more thing important is that law and compliances chapter, just you check what is international valuation standards. International valuation standards refers 101 IVS, 102 IVS. So that you have to check out. And IBC code outline once you check before going for the examinations. And also SARFAESI Act outline you can check. So that is enough for the second chapter. And most important, you have to concentrate on mergers and acquisition, assets and liabilities, and methods and approaches. And whatever the topics that we have covered, I almost covered each and every topic in that particular areas. Okay. So just you go through it. Okay. So all the best for your examinations. Thank you.